everybody, to day 4 of the TraderLion conference. Super excited to have you guys here, and we've got an absolute stacked lineup today. Starting things off, we've got Mark Minervini, Mark Ritchie II, and Brandon Hedgepath discussing Superperformance setups, risk management, and strategies. It's going to be kind of a roundtable discussion, as well as they'll be going through a couple trades right here for you. That's going to be excellent. Following things up, we've got at 10:30 a.m. Eastern, Lance Breitstein discussing the limitations of backtesting, as well as alternatives you can follow. That's going to be excellent as well. Then at 12 p.m., we have Leif Soreide discussing building a stock universe, as well as trading high-tide flags, his bread and butter. And then at 1:30 p.m., we've got Haber discussing how to study past winners and build model book stocks. If you're looking to improve your trade performance, you're in exactly the right spot. Let us know in the chat right now who you're most looking forward to hearing today during the presentations. Now, we do work very hard to put this together every single year, so please go ahead and pay it forward. Help us spread the word about this resource. Go ahead and click the link that's appearing right now in the chat. Tweet us out, and we'd really appreciate it. And it just kind of helps, bring this resource in front of more new traders that can get most of it and help improve their performance as well. So please go ahead and do that. We are immensely thankful for everybody who's tweeted it out already, and thank you guys all for doing so. I do want to mention and thank our sponsors, DeepView, StockTwits, Interactive Brokers. Without this, it wouldn't really be possible. DeepView, of course, is the same team behind TraderLion, is creating the ultimate trading tool, screening, watchlist management, unique features such as heat map, as well as bubble charts. Everything, we're kind of dreaming up, we're bringing to life here in DeepView. So we've got a special offer, 2 months for $39. You can visit deepview.com to sign up. I'd recommend that. Then, of course, Interactive Brokers is the brokerage that I personally use. I'd recommend it. And if you want to support the channel and pay it forward, again, scanning that QR code and checking out IBKR is also a great way to do so. And StockTwits, can't thank them enough for helping push the conference and getting this resource in front of more and more traders. I definitely couldn't do it without them. Now, I wanted to include this slide because I know some people will ask, as has happened, the previous days, will this conference be recorded? Yes, it is currently being recorded. You can actually scroll back in time at any point to revisit, a speaker, or if you want to hear me speak again during this, intro, you can. And the recording is available at this exact same URL that you're currently watching, and we'll also be uploading each individual presentation as a standalone video over the course of the next few months. You won't miss anything. If you have to step away, get a drink of water, what have you, just go ahead and do that. And if there's anybody who asks in the chat, please let them know kindly that yes, this is being recorded. Here's a little bit about how to get the most out of the experience. First, go ahead and subscribe to the TraderLion channel. Not only do we put this conference on every single year, we also post regular interviews with top traders, tutorials, webinars. You don't want to miss that. So definitely go ahead and subscribe. We're trying to approach 100,000, which is an amazing number, and you can help us get there. If you're not already subscribed and you've enjoyed this conference, please go ahead and do so. Second, I really want to emphasize this, to access the slides of presenters and have the ability to take notes right there as you're kind of reviewing the material. Scan the QR code right here and sign up for the free VIP access. It just gives you access to special giveaways, extra resources, and really helps you get the most out of this entire experience. Then I highly suggest that everybody engage in the chat with others, as well as the speakers. Share notes, key takeaways on Twitter. Tag us, tag my handle, Richard Moglen, as well as TraderLion, and we'll go ahead and retweet that. We love people sharing their notes, as well as favorite quotes, that type of thing. So go ahead and do that. Then, as I mentioned before, you can scroll back anytime to rewatch certain parts that you want to rewatch or just kind of missed the first time. So go ahead and take advantage of that. Rewatch Stan Weinstein's presentation from yesterday as many times as you wish, and you'll get new golden nuggets every single time you watch those type of videos. Also, I highly recommend checking out the TraderLion University free resources. If you sign up for the VIP right here, you're automatically registered for an account, and you have access to model books, price cycle mastery with Oliver Kell, the 2023 annual trading conference resource, the podcast resource, the Ultimate Trading Guide. There's so many free resources to explore that can really help you level up your trading. So go ahead and scan here, and this will bring you right to the ability to register for a free account and get access to all these courses and free resources. Then when you're ready to kind of upgrade to your graduate level education, we've got you covered there as well. We've got the Stage Analysis Masterclass with Stan, the Swing Trade Masterclass with Oliver Kell, the IPO Masterclass with the Life Cycle Trading team, the Trade Psychology Masterclass with Jared Hendler, and of course, John Boyd's Historical Analysis Masterclass. All of these are fantastic and cover different aspects of trading. And if you're looking to level up your trading and learn from proven experts, these are the places to go. And you can explore that at TraderLion.com/university. Also, if you are enjoying the conference so far, we do ask that you pay it forward and consider a donation to St. Jude's. I think this is an amazing cause, and I think everybody can agree on that. If you're able to donate $1, that's fantastic. $5, $10, that's even better. Tag me on Twitter. I'll thank you personally if you donate. So please go ahead and do that. We just broke 5,000, which is amazing. But let's try to get to 7,500 today. That would be amazing. So if you haven't donated yet and you've watched a ton of the conference so far, please go ahead and take the time right now to donate. And a huge thank you to everybody who already has done so and is currently donating. It's so cool to see that. Finally, just another reminder to go ahead and subscribe to the TraderLion channel. We're trying to reach 100,000, shortly within the next month or so. You can help us get there. Again, we've got podcasts, tutorials, free webinars, key clips. You don't want to miss that. We're working very hard to make this the best resource for trading education out there, and I think we're well on our way. So please go ahead and help support us. If you've got a friend who hasn't subscribed yet, let them know about the channel, show them a video, and encourage them to subscribe. It really helps support us immensely. And with that, enjoy, and thanks so much for joining us. Get your notebooks ready, and we'll get started with Mark and his crew very shortly, and I'll see you guys right there. Take care. All right, welcome back everybody to the TraderLion conference. I'm very excited to welcome our next speakers. Joining us are Mark Minervini, Mark Ritchie II, and Brandon Hedgepath. Mark Minervini, as many of you know, is a market wizard, author of foundational trading and mindset books, a two-time U.S. investing champion, and a 40-year veteran of Wall Street. He is also the founder of Minervini Private Access and the creator of the Master Trader Program Superperformance Workshop. Mark Ritchie and Brandon are both experienced portfolio managers who teach through Minervini Private Access, and they both attended the first Master Trader Program back in 2010 with Mark. And over the 13.5 period working together, they achieved an outstanding compounded total return of 5,667%. And today, I'm really excited. We'll be discussing a wide range of topics based on your guys' submitted questions. And we'll be covering setups, trading mindset, position management, sell rules, progressive exposure, and much more, as well as covering a few of their key trades. Mark, Brandon, and Mark, welcome. It's a real pleasure to have you guys here.
Thanks for having us.
Yeah,
Yeah, it's great to be here, and I'm really happy to be here with my team, with Mark and Brandon. So I think everyone's going to get a chance to meet some really great traders that I respect more than anybody probably in the world. That probably the only two guys that I would trust my own money with.
yeah,
Yeah,
perfect.
thanks for having us, Richard. Good to see you again. So it should be a lot of fun.
Yeah, perfect. And yeah, I think it's excellent to get all your guys' different perspectives and all your nuances that you guys will share. To start things off, I want to kind of bring it back to the very beginning of your trading careers. A lot of people watching maybe kind of just starting out a few years into this. Looking back at your early years of trading, and Brandon, I'll kind of start with you on this one. What were some of the key mistakes that you found yourself making over and over again? And what were some of the key steps and improvements that you made to kind of correct those and work towards improving as a trader?
Sure. So style drift, I would say, was a key one. So I would, I think I spent, I don't know, maybe $10,000 jumping from one strategy to the next. Whether it first started with options, then it was selling options, right? So I was trading options on the long side. Then it was selling premium. I jumped to, I mean, I don't even remember. I traded Forex. I paid a guy $4,000 to teach me how to trade Forex. That didn't pan out. And it was like every 3 months or so, I'd have success and then I'd give it all back. And I'm like, all right, this isn't working. Where do I go to the next thing? And then it was over a 2-year period before my Marky turned me on to what Mark Minervini was starting. So I had a good, I don't know, 2-year experience of screwing things up, put it that way. So this idea of I was always committed, but for some reason I just had a sense like I was missing some pieces.
Yeah, and
And
was yeah, go ahead.
Rich, just to point out,
Hmm.
Brandon calls Mark Ritchie Marky, and I'm Mark.
There you go.
That's a good point, Mark. Thank you for that. Yeah. So Mark Ritchie's Marky to me. So
Well, that makes it easy to differentiate. So thank you. And I also want to kind of touch on for and hear from each of you guys kind of some aha moments. And it sounds like the Master Trader program for you, Brandon, and Mark Ritchie, of course, or Marky, what was kind of one of those turning point moments. So would you guys kind of touch on, what were the key takeaways from that experience that, really set you on that path towards getting super performance and really improving as a trader?
Can I just give a little setup here
Sure.
because it's really inspiring when you hear about Brandon, in particular Brandon, but Mark and Brandon together, what they've done. And Brandon came and Mark came to the very first my first master trader program. I think there was 25 people in the room. It was simply an experiment at the time. I was for me to try my material that I was using to write my book, and I wanted to see what would resonate with people and if it should go in the book or not. And so I said, let me do a seminar and that I'll get to see, people's visceral response and questions. And that's how it all started. And now it's, it's 15 years later, we're still doing it. But Brandon at the time couldn't afford to come to the Master Trader program, so he sold his car to pay for it, which you want to talk about commitment. He said he was committed. He certainly was committed. And they came, and collectively they left and started trading as a team with, a relatively small amount of money, 25 or 30, $40,000. And now they manage together their own money over 25 million, I think now. They're in the tens of millions of dollars that they've grown it. So, and they were a customer of Minervini Private Access for a decade, where they traded on their own. And it was after all that, and we, of course, over time became friends and so forth, and I was real proud of them. Then they started working for me and been with the company now for a good number of years. So it's just a great story, and I just wanted everybody to know what incredible dedication. These guys are amazing.
so Marky, you wanna lay the backdrop or you want me to?
Sure. Well, the original question was, mistakes and those types of things, and just taking it back to there because, a lot of people know, obviously, or maybe familiar. My dad was a retired trader, but I never actually worked for him or did anything like that. Worked for an old associate of his. That's actually how I met Brandon, and really got off to a terrible start. So even the idea of that it's in your blood or it's in the genetics or that it's really not the case. Even I think it was talking offline, Sean Ryan made the comment in an interview with you, Richard, the markets don't care who your dad is. Couldn't be more true. there is no gene for trading, in my view. But anyway, I didn't have a process. I didn't. Discipline is something that did come easy. I don't want to say easy, but something that I understood that, listen, if you can apply a process or tactics and discipline that work, I just didn't have that. So you did what a lot of people did. You tried different things. And then, to fill in a little of the details, Mark had just started doing a few things, even on Stock Twits, and had a blog, and then started the MPA thing. And I told Brandon, I was like, look, I'm making money and just kind of learning, what this guy's doing, but he's doing sort of this seminar. Very similar. I made a little bit of profits, and I just took some of the profits and said, I'm paying for a trip to, Myrtle Beach to go figure out, how he makes the sausage, if you will, and, to me, it was really more like I said, I think one of the biggest things I took away, I still talk about this, is this idea of not being in too big of a hurry, where I felt like, armed with the knowledge that we learned there, and then of course you get a workbook and all these things saying there's a real path forward if you can continue to be disciplined and get good at this. Most people don't. I don't care what it is, what the the discipline or the avenue is. They don't spend enough time really getting good. They just want to be successful. One of the things Mark talks about is you get the skill first, then the money and the success come later. And to me, I actually felt like, that was really what the course provided, was like, this is a consistent approach to the market that is timeless, that isn't just a one trick pony, or is going to, go in and out of vogue and then not work anymore. It was working before any of us were around. This approach will be working long after we're dead and gone. So it was this idea of, for lack of a better word, this is the brass ring as far as trading is concerned. It's just going to require consistent application and discipline, some hard work. And it doesn't feel like that was 15 years ago, but I can't believe that was actually almost 15 years ago in 2010. And then, so we just got put our heads down and did the work. It was actually years later when Mark was like, you guys have done a really good job. And Fran and I were like, I guess so. We're just, again, heads down, trying to do the work. Good things happen.
I got to say something. I got to jump in because it just reminds me of certain moments. We were all together one time, and this is after these guys have been trading for like a decade and a half, and they've, amassed tens of millions of dollars. And I said to Brent, you guys are, massively successful. And he said, I'm just starting to feel like I'm successful. I'll never forget that, Brent.
That's right.
Like, I'm just starting to feel like I'm successful. So.
Yeah, go ahead.
The humility and the discipline, and these guys are really purists, and now we're seeing lots of, we've got the U.S. Investing Championship, Norm Zeta restarted a number of years ago. I guess it's maybe 6 years now or so, 5-6 years. And we're just seeing, our members dominate. This last quarter, we had all 4 divisions were our members. So it's just these guys and all these people that are entering the contest are showing that it's teachable, and I think O'Neill did the same thing. O'Neill had David Ryan and had Lee Freestone, and it's duplicatable, it's teachable, and these are principles that are timeless, and there's going to be people long after us, and these guys are the next generation, and the people watching here are also the next generation.
Yeah, and I love that. Like that's one of the things that really stuck out to me, Mark, when the first time I met you, because you did say that. You said timeless principles, and I really thought about that for a long time, because I'm like, well, what does that mean? And I think one of the things I always struggled with when I was bouncing around to other places was I had so many unanswered questions. And not that when we started doing the Minervini style or approach that Mark was teaching at the time to us, even leading up to that seminar, was, he gave you everything you need. The process was there. And I never saw that from anywhere else. And it was like, I had this aha moment, like, holy cow, here is the Holy Grail. And, the risk management alone, which is what we talk about, is the Holy Grail. No one taught me that. I didn't stumble across that, but that was something I knew in my mind I needed, because I'd always ask these questions of like, well, how do I know when to not trade? Like, I would have success and then I'd give it all back. Like, was I trading too small? Was I trading too big? Well, it was like, I knew the market changed, but I couldn't put my finger on it. because clearly what I was doing wasn't working. And when we went to that first, well, leading up to that, we actually, Mark, we were subscribers to the platform under someone else's name actually, and Mark sidestepped the flash crash in 2010, and we were like blown away. And so leading up to Marky and I actually had lunch, and he's like, "Hey, I'm going to go to this thing. I think you should come." And I was like, "I can't pay for that." And that's when I was like, well, I guess I could sell my car after thinking about it for a little bit. And so, yeah, I did. I sold my car for, I think, $14,000. I took the 4, paid for the seminar. And, it's funny, Bob Weissman told me too that this might be the last one. So it was one and done. So I'm like, all right, well, there's no next year.
We truly thought that we were just going to do it just to, do an experiment to get data for the book, to figure out, what material should go in the book. I wanted to make sure the book was good, but another thing too, I mean, it shows a great commitment, but the real commitment, I think this is a real, we'll get to some of the tools and the important things that people want to hear of how they can be successful. And the real key is that we're 15 years later, and these guys have been doing the same thing. I've been doing the same thing for 40 years. They've been doing it for 15, and I will assure you 15 years from now, they'll be doing the same thing. And they'll be able to say what I'm saying now, and sticking to that strategy and becoming really good at it. And it's not just my strategy. Our strategy is not the only strategy that works. There's other strategies. There's people doing option spreads and value buying and all kinds of things and day trading. But whatever strategy it is, you need to make a commitment to it more than a year or two. And you got to think in 5, 10-year increments as opposed to 1 or 2. So that's the real key. That's the real, and with me, I didn't do well for 6 years. I didn't make any money for 6 years. I mean, these guys you guys were quicker to get, to do well.
Well, and to be honest, I mean, we struggled too. I mean, there was some periods where Mark and I, I mean, listen, if we weren't taking the approach that, hey, what did we learn versus how much money we made, we really valued of taking the wisdom that we gained from the market versus, okay, well, we didn't make what we wanted, so we should just quit or what. So Mark's key too on like you're gonna have rotten days, right? And if you take that approach, and I think a lot of people don't understand, 6 years is a long time to not give up and not make money.
Yep. It felt like a long time. Hey, Rich, I'm just going to let you know that the three of us could rattle on for hours.
I'll jump in. I'll try to guide you
better
guys.
Get to like people's questions.
Sorry.
No, that actually leads me right back to the question I want to ask you now, Mark, about those 6 years where you struggled. And you mentioned in your book the realization you made when you looked at your data and you calculated if you capped your loss, I think it was at 10%, that you would have been up, I think, multiple double digits, maybe 80% versus being down. Was that the key aha moment for you where everything changed? And what kind of specific changes did you make going forward to get on that path towards profitability and, of course, super performance?
There's been a lot of aha moments, and that was the main one that I realized that cutting the losses and what O'Neill was saying was even more important than I had understood, and that I didn't really understand risk management very well. And I had a 15% loss. I normalized everything to a 10% stop, and my account would have been up 72%. And I said, wait a minute, that has to be wrong. I obviously did a calculation wrong. I calculated it again, came back the same. I calculated it a third time. Lo and behold, it was correct. So then I went and I said, well, let me look at survivorship bias and see if, if it would have knocked me out of some of the winners. And, there's got to be something here that it's wrong. But it wasn't. Even with accounting for all of that, it was still right around that same number. So that was on that day, I'll never forget it. I said to myself, never, ever again am I allowing a loss to balloon. I'm cutting a line in the sand, and that's it. A loss, unless it's going to have to gap through, and I'm taking the next best price after that. But I'm never, ever holding a loss. This is a hard, fast rule that I'm making, and I'm sticking to it. And they're going to have to if they're taking me out, they're taking me out by a little death by 1,000 cuts. I'm never getting taken out by a big loss ever again, because every now and then I'd have a stock blow up. Or I'd fall in love with a stock and I'd buy more of it when it's down, and I just kept distorting my returns, and any little progress that I made would just get destroyed. So I made that change and everything changed from that point forward. It was just amazing. I started getting consistent returns, my drawdowns, and I just started perfecting the risk management. And before you know it, I went into the 90s. I had that stretch that people read about in Market Wizards, 36,000% in 5.5 years. And you could do the math, regardless if you start with $2,000 or 10,000, it turns into a lot of money, and that was the beginning of a career. So yeah.
And what are your goals right now for risk management in terms of, average stop? I know you track your numbers quite diligently, and Marky and Brandon, I'd like to hear your perspectives as well with what you guys like. But starting with Mark, what are your goals right now in terms of capping your losses and
Right.
keeping very strict risks?
So we all work together, and we actually at Minervini Private Access, we have a called a Minervini Select Trade portfolio that we manage as a team, and then we have our open positions where we put breakout stocks and all that. So you'll see that in real time, and and also manage our own money as well. And these guys, if you looked, and I don't know what they're doing with their own money, they don't know what I'm doing with my own money. We don't really talk about that much, but if we go back and we look at their losses, my loss, they're about the same. We're averaging anywhere between, if we're really tight, 3%, 3.5%, 4% in a market that's not very good. We might be 5%, 6%, averaging 4%, 5%, 6%, line in the sand at 8%, but we stagger stop sometimes. So we'll
Right.
put like a 4 and a 12. Usually it's not even a 12. Usually it's a 10 is the max. And we might use, a staggered stop. And from there, you will still average that 8%. That 8% is a number that goes back to O'Neill, and it's a number, it's a very important number for a few reasons. Number one, if you just do the math, once you start going over 10%, the math starts working against you because losses work geometrically against you. So now, you're down 20%, it takes 25% to get even. You're down 50%, it takes 100%, right? Everybody knows this. Well, 8% is about 8% to get even. And also, when you look at charts and you go back and you go all the way back to the 1800s, we've looked at charts. I've looked at millions of charts, literally millions of charts. And we've got the research, and O'Neill had the research, and Love had the research. And going back to all the way to Jesse Livermore, when you look at these charts, you don't need more than that. Like that, if you back into the way charts fluctuate and stocks fluctuate, if you know how to enter properly, well, then it will be abnormal. If you start getting 10, 15% moves, that's abnormal fluctuation, and you'll know it. So that's what's necessary, and that's what mathematically works.
Yeah, perfect. Brandon, Mark, anything to add there?
Yeah, I'll just add, obviously, in terms of the risk management, we're all cut from the same cloth in that regard. And the tighter the better, Richard, is generally when people go like, well, how tight do you like to be? Well, depends upon the setup. But the one thing I will just add, where Mark was talking about post-trade analysis, and that process, though, is something that no one can do for you. But if you faithfully do it, where Mark was saying, I had this aha, where it was like, all right, I am drawing the Maginot line in the sand. Like I'm never crossing it again. I had a similar experience on the upside, 5 or 6 decent years. And I'd gone to my 3rd or 4th, 5th master trader program, came back and did a big study of all my biggest winning trades and actually found out that they were in the same groups that Mark had written about in his books, that O'Neill had written about, that I was like, my own results were bearing out that like, I should be, if anything, more aggressive. What did all my biggest winners have in common? They either had earnings or sales, or they were part of some of the classic growth areas, minus the biotech. And so I just said, I'm not going to play favorites, but if that's where I've made all the money, and then going into the next cycle I think it was 2016, 17, we did something like 200% in the next 18 months, armed with that information. And this is where, again, one of the things, we learned and we teach is that process of grading yourself, going through, studying your results. That is one of your best teachers.
Hey, let me just say two points. One is the results bearing out the research, as Mark just said. That's what happened with me too. As I started getting the results, it was confirming the O'Neill research. It was confirming the Richard Love book. It was confirming Jesse Livermore. It was confirming all these people who I had concluded were onto timeless principles, that principles that will work forever because it's a law of supply and demand is like gravity. It's not going to change. So here's, and you asked about the haha moments. There's two more. Well, and the one, and this is something I've said many times that I learned from O'Neill. O'Neill was a man of personal responsibility. I mean, he really was. And I met him a bunch of times, and he said some things that were just so enormous that just lasted for the rest of my life. And one thing he said was, look, if you lose on a trade, it's because you missed something. All right. Either the market, the stock, it wasn't set up properly, something you missed. Because when you do it right, it works perfect. And when the market conditions are right, that might sound obvious. That's a big statement. That's a big statement. And that means that there is a certain time to do this and there's a certain time not to, and it's up to you to learn and get the skill to be able to do that. And you're not going to be perfect. So then not only do you have to get that skill to do it well, but when it's not working and things aren't going well, you have to have a mechanism to mitigate the downside, right? So what I did is I just listened to David Ryan. I went, just like these guys came to my seminar, and David Ryan actually he was my instructor for 8 years at the Master Trader program. I went and saw David Ryan when I was a young kid, and I saw O'Neill, I saw David Ryan. David Ryan said, just take a green pen and a red pen and mark where you bought and sold on a chart. And that's your best teacher. And that was the big aha moment. I reckon, and it's funny because originally the mistake that I found that I was making very often, besides holding losses, I corrected that, but then I was selling too soon. I was constantly selling stocks way too soon, and I'm still doing it to this day. Fortunately, I selling them too soon, I still make enough where it pays for the risk, and I've been able to build a fortune off of that. But we can go over NVIDIA, and I sold NVIDIA both times too soon. Just these last couple trades, bought it as perfect as you can possibly buy it, and both times sold it too soon. But so yeah, doing that post analysis, and you will find common denominators, things that you do over and over, good and bad. So you'll see, these are my strengths. You'll see your weaknesses. And when you start to see something you're doing over and over and over, that's what really tells you what you need to work on and what you need to exploit.
And how often would you guys suggest for traders watching this to do post analysis? And what would be kind of the key steps? There's calculating your numbers, and then there's, as you mentioned, going over the charts and the trades and marking them up. What would be kind of your guidance there?
That's a great question. The way you partitioned it into two things, where it's the numbers and it's the charts and the trades, and they're two completely different things. One is the math, and I'll let you guys talk about it too, Brandon and Mark. They don't do it any differently than I do, where we do it the exact same way. But looking at the charts, there's a couple general rules of thumb. One is I find it's best to look at it later, to let some time go by, months go by. When you do that, when you go back, it's kind of like I'm grading your trades, Rich. Like you start to look at them as objectively and not emotionally. You're away from the trade. You kind of forget about it. And then you can really honestly identify, and you could be more objective about it. With the numbers, the math is the math. And the math, this is the thing I think that people have a hard time with, is bringing the two together. I always say, let the spreadsheet make its way into your trading. So you got to be cognizant of your numbers, and then you know where your average loss is, your average gain, and you see the math. Well, this math isn't working. My losses are bigger than my gain. Obviously, you don't have to be a rocket scientist to figure out you're going to lose money, right? So you got to get that math right. But then you've got to back into trades and back into the risk, into the charts, that math works. And that's the hard part. That's why I'll leave that up to you to explain, Mark and Brandon.
Go ahead, Brandon.
Oh, you want me to jump in here? All right. So yeah, so that's what I did. In the early days was 3 months and 6 months. I would always review the trades. And I think for me, before Mark and I officially formed our partnership, we would trade in the same office, but my trades, were sometimes different than his. So yeah, I was always selling too soon because I was very risk adverse to the point where I was choking everything off. So to me, the math making sense with, how the chart, where I want to be the last week holder, meaning when the chart sours, that's when it matches with my, our percent stop. That makes mathematical sense. Typically for us, we run our win rate's a little bit lower because our average loss is like what, around 3%. So we don't have a problem taking, stepping aside quickly, but we'll also look to get back in quickly. So for me, that aha moment, or doing the hard work, because it is hard work, seeing how well you've played versus in your mind how well you think you did is two different things. So
Yep.
yeah, for me, the just understanding that I don't want to stop out something that's not doing anything wrong, without the idea of like, okay, well, if I do, I got to get right back in if it starts to go in the direction I wanted it to.
Yeah, and that's where we learn. That's where in my book I talk about confirmations of violations. So if you read Think and Trade Like a Champion, you'll basically what Brandon's referring to are violations. If there's no violations, then you want to stick with the trade. But go ahead, Mark. I'm sorry, I interrupted.
I was just going to say, I'm not going to add a whole lot of color other than just, I can remember though, it was, I think at the very first seminar when Mark called it knowing the truth about your trading, which is what he refers to in his book too. And he said, how many of you are tracking your trades in here? And it was like, I think our two were the only two hands that went up. I couldn't believe the number of people that weren't doing this. But because it really is an exercise in seeing your own it's the way you look at yourself in the mirror, in terms of the numbers don't lie. But I would agree. I think we try and log them right away and then come back to grade them later. So I have buys and sells and then come back and grade them.
I have seminars where, we have 400 or 500 people in the audience to say, how many people right now, raise your hand. How many people know your average gain, average loss, percentage of winning trades, biggest loss, smallest, biggest win, biggest loss? Raise your hand. 5% of the room, 10% of the room, the hands go up, and that includes the people that are lying. So, and then I say, I'm going to call on you. So you better, if you raise your hand, I might ask you your numbers. One time, one guy raised his hand. I said, well, okay, what are your numbers? And he's like, okay, you don't know. So, but yeah, it's very few people, do the math and actually know their numbers. So my question always is, well, how do you know where to cut your loss if you don't know your gain? If you don't know, like, how do you know the math behind it? If you don't know what's going on in your trading, well, how would you know how to manage your risk against what? So knowing the truth is the very first thing, drilling down to the truth of your trading. And that's, for most, that's painful, and it's even painful to look at the, we have some really great tools on my platform, on the MPA platform, for analytics. We have where you can put your trades in. It gives you, breaks down all numbers. It gives you these bell curves and so forth, proprietary stuff. We've got a grader where you can grade your trades. Surprisingly, a lot of people don't use it. They don't use it. Way less people than I would think and should. It's not the most favorite part of the platform, and that's the part that is the most important.
And to add to that, if for instance you do your calculations and your average gain is around 10%, where would you, using that information, where would you say, all right, given that average gain, where should I cut my risk now? Are you shooting for 2-to-1, 3-to-1? It definitely depends whether you're more of a swing trader and turning things over faster versus more of a position trader. But I'd love to hear your guys' thoughts with that, and maybe start with Mark Minervini.
Well, we're shooting for a minimum of 2-to-1. We'd like to have, the gains cover the losses by 2-to-1. And that gives you some room, to be wrong. 3-to-1 to 5-to-1 is, where I'd like to be on my better trades on the bigger winners. And sometimes you get 8 or 10-to-1, 8 or 10 or 12-hour trades. But on average, this is the thing that people have to understand. It's all about what happens on average. It doesn't matter what one individual trade does. It matters about what you do on average. When it all comes down to it, it's going to be your average gain divided by your average loss times your batting average. And that's it. That's the holy grail. Manage that, keep that a positive number, and you're a winner. The bigger that number is, the less trading you have to do. So if it's 1.1-to-1 and you're making $1.10 for every dollar you risk, you're going to have to do a lot of trades. You have to turn that over. If it's 3-to-1, you're not going to have to do a whole lot of trades, and you're going to be able to be wrong a lot more. So that's the balancing act that that you play, and that is going to depend. If you're a day trader, you could have a 1.1 to 1 reward to risk, and you're going to turn that edge over. I mean, I have a couple friends that are day traders, very successful, and one of my friends, he does in one day sometimes 5,000 trades. I mean, can you even? It's almost unimaginable how that is possible with the amount of time that's in a day. But I've seen it with my own two eyes. Thousands of trades in one day. So think about that, turning that edge over, even if you're making, $1.01 versus what you're risking. If you did it 5,000 times a day, that can add up.
And one thing that I've struggled with, especially, say you do it quarterly and looking back at a trade that was a few months ago, is it's a little bit tough. Of course, you can add an index to the chart, but it's a little tough to know the context surrounding that trade. Because we all know that if it's a semi trade and, it starts pulling in, it's still above the moving averages, but all the other semis that are also maybe in your portfolio are pulling back in the same time, putting pressure on your equity curve, that type of thing. So my question is for you guys, how do you take into account the context of a trade to identify maybe those hidden mistakes that you're making, selling something too early, just because everything's pulling in when the chart is still not broken, and still, fine overall? And maybe I'll start with Brandon on this one.
Oh, you want to start with me on this? Okay.
Yeah. No pressure.
So well, that's a tough question because, listen, we always want to try to expand that average gain as well. So it's like, you could be a strict 2-to-1 trader. That's fine. And your goal is to turn that over as much as possible. What Mark and I learned, though, is we got some really good stocks that we sold up 10% that we should have held for 20-30. Right. So it's like you got to, again, this is going back to the post-trade analysis to understand how a stock fluctuates. Right. So if you get 10% and you haven't even sat through a first natural reaction, maybe you don't want to sell yet, or maybe you just sell a smaller piece. Right. And then you want to hold for a bigger move. And that's typically what we try to do. Again, I think, Richard, the idea of like, what is the market? What's the environment, right? Because we do stock tactics feedback, right? What's the feedback from the market? So it's important. But if you're just coming out of a bear market, that, or you don't know, but your thinking should be, I want to hold maybe a few of these if they have the earnings and it's coming out of the right pattern for a bigger move.
Right.
We always, this again is something, in my opinion, is hard to have a good answer for because each stock is kind of unique in its own. So like, this is where we talk about, hey, give us an example, right? And this is where Mark's from the MTP, the trading book that he gives us, which is a model book, is so valuable. And I will still, to this day, Marky and I both will review these charts if we're just not doing anything. And I have one on my desk from the first one, and I'll just flip through it because I want to see how just the natural flow of a stock acts. And we want to maximize, obviously, the most gain we can in the shortest amount of time. And that's something that stood out for me that Mark taught us originally too. Would you rather have a 60% gain that took a year, or 10% gains that actually compound and equals more than 60%? That happens all the time.
Yep. Real quick too, you asked about context, and I don't, Mark, if you have anything to share too, but you asked about context. And I don't generally worry too much about like if another stock in the group, unless it's a key stock and it has a major break. Nvidia, has a major break. It has the biggest down day since the last 5 years and the biggest down week on the largest volume. That tells you something. That's what we call the axe in the group. So, but I tend to stay stock by stock, right? But here's the real key. Are you in a bull or bear market, right? Are you in the early stages of a bull market or the late stages of a bull market? What kind of traction are you getting in your own trading? So now if I'm in the early stages of a bull market, we've had a bear market, right? And now all of a sudden, stocks are breaking out and we're coming off the lows. And this is the first sign of stocks breaking out of really great high RS names or coming out of bases. Well, I might have a monster by the tail. You might have Nvidia, Amazon at the beginning of a big move. Even if you keep a tiny position, you sell 90% of it and you keep 10%, it could be life-changing. So at that point now, I have a different tactic, right? I'm going to maybe, even though I might short-term trade some into strength, I'm going to finance my risk and now I'll play the rest for a big move. And some of these stocks go up thousands of percent. They don't even close below their 50-day moving average, let alone the 200-day. So you start backstopping them. Now let's say we're in a late stage. We've been in a bull market for 2.5, 3 years. Your stocks are coming off there, and the groups are coming off their fourth, fifth stage base, and you're running up. That's a gift. Those are gifts that you have to take, sell right into. And now I'm short-term trading. I'm getting shorter and shorter and shorter as the bull market gets older and older and older. That's really the key, and the traction is the real important part. Mark, Brandon, we're everything that guides us, and whether we get aggressive or not, is all based on our own trades working. Doesn't matter. The whole world could be doing well. If our trades aren't working, we're not increasing size.
It's pure gold right there.
Yeah. Mark, Ritchie, did you have anything to add on this?
The other thing I would just add back to your original question was, because you had asked about, hey, what if I sold the stock for other reasons or things like that? I would just put that in your notes, or, in our grader now we have this annotations where you can say, hey, maybe I was getting stopped, and so I just reduced overall risk. But generally, when we're grading stuff, we're just looking at the chart. Like, in a vacuum, even to Mark's point about you want to be in your own little echo chamber in terms of your own trading. That's what you should be hearing. How are my tactics working right here, right now in the market? And that should be the only thing really driving, am I getting more or less aggressive? The same thing though, like that trade has to stand on its own. So yeah, I may have, I got stopped on a few other positions. I was raising a little bit of cash, so I sold this one a little early. I might make a note for that, but that still doesn't mean it was a proper sell on that chart.
Right.
If that stock was acting really well, I might rate that as an early sell or a bad sell. I'm still going to be honest in terms of how I do, the grading of each one trade on its own.
Yeah, perfect. I think that's what I was looking for. And to everybody watching, some of this might seem theoretical, but we're going to actually jump to some trades in just a minute. I just have a few questions on mindset first, where everything hopefully will come together.
Yeah. And very little of what we say
Yeah.
is theoretical. I mean, it is practical. We use it in real life, but you're right, Rich. It will sound theoretical. It can sound theoretical. Yeah.
Yeah. Just to start with, Mark, for you, what are some kind of mindset shifts that traders can make to unlock the belief that they can achieve super performance and be very successful? Is there something that you've noticed over time, teaching many, many traders at your workshops as well as through MPA?
Well, to me, the human superpower is choice. Is the power of choice, and the power of making the choice to believe and to believe in yourself. The way I looked at it was, and again, it sounds corny, but when I was a kid, I watched the movie Rocky, and there's a part in there where they say, he's great. Rocky says he's great, and then his cornerman says he's just a man. Just be more man. And I started thinking about it, and I said, when I was going to see O'Neill and these guys, I said, these are just men. These are just people just like me. If they did it, I could do it too if I learn. And so I took that personal responsibility. One of the things I got from O'Neill was that personal responsibility. I mean, also Dr. Wayne Dyer, who people know I'm a huge fan of. It was like my life coach. He passed away, unfortunately, but there's someone who I spent a lot of time with and studying his work. It was all about taking really, 100% personal responsibility and saying that, I can do this because someone else did it. The 4-minute mile, after they broke the 4-minute mile, a whole bunch of people broke the 4-minute mile. That's the way it works, right? That's why we do this, is to inspire. That's why I write books, is to inspire others. When I see these guys winning the U.S. Investing Championship and I had a little to do with it, it makes me way more happier than me winning it, to be honest with you. I probably wouldn't have, 30 years ago, but now it does. So yeah, the mindset has to be where you need to be open-minded to, number one, that if you're not doing well, you probably suck at it. And you're gonna suck at it because you don't know shit. And that's the bottom line, all right? And you don't know shit for 5 or 10 years. And you got to realize that that's the way it is, and find somebody who knows what they're doing, shut up, listen, and make a commitment to something. You can't go to a coach and give it a half-ass effort for a couple months and then go to another coach. There's no magic coach. You've got there's coaches that coach different ways, and some coach with a lot of positive motivation, some coach like Bobby Knight, scream and yell, and there's different ways, right? So, but you got to make a commitment to that coach. You got to make a commitment to a style. You got to make a commitment where you spend a lot of time not being very good at it and working and working and working. And I think that's the mindset, is that I think that's my strength, is my unconditional persistence. These guys, again, I don't know why, if I had anything to do with convincing them to stay with something for 15 years straight and doing it over and over, and a lot of other people too that have followed in my footsteps. But I know O'Neill did a great job of convincing me that this was the way to go, and that if it doesn't work, it's because of me, not because of the style of the strategy. And that was the key. The key was convincing myself that it wasn't the strategy, it was me. I think that's the ultimate mindset, is the responsibility.
And Mark Ritchie, I know you won the 100% challenge after 2010. Attending the MTP. Was there a mindset unlock that you made there, or kind of a realization? What kind of led to that, shift in performance there?
Well, I was just, again, armed with all the things that we're talking about, and the idea of, we talk about this when preparedness meets opportunity. Well, that is essentially what we do in this business, in my opinion, is just making sure you're prepared for those good periods in the market. There's so many things. We're all complicated individuals, right? And we all struggle with different things. The reality is that the market has a way of exposing our weaknesses, and through a number of the things we just talked about, post-trade analysis, you're never going to perfectly remove those things. The key is but you can manage them. And even the idea of, look, whether it's, holding losses, selling too quickly, style drift, is getting over those kinds of things, and realizing too, all the way back to, this isn't a business about, I've got to be right. My goal is to make money. If your goal was real, and you have to, it's very humbling, even when Mark goes like we have people now complimenting Brandon and I, going, you guys are, helping us change our lives or whatever. And that means a lot to me, because I was broke when I came to the first Master Trader program. So I know what that feels like, to try and figure this out, where, okay, I didn't work at an investment bank or a big hedge fund or anything like that. And to be able to go from, very barely getting by to being quite successful is humbling. But yeah, I would just say, I think it's, once you start to realize, I've seen this and I've seen this. Okay, there's a setup here and it's working, and I can do this repeatedly. Or as I remember Mark first saying, like, the best sign is there going to be more setups than you have money to buy. I have that like written in a little margin, my very first Master Trader program. That was probably my first aha. And then I remember seeing, it was maybe a month later, 2 months later, I can't remember. It was like, holy cow, there's just these setups, like, they're everywhere. And I remember saying that to Brandon, and it was like, I was just buying every one of them so aggressively. And it was again, using that whole progressive exposure though. I was at new highs, things are working. And it was like, wham, you made a ton of money in a very short period of time with what seemed very low risk.
There's silent gold there, by the way. There's because right now we're in a situation, and you heard what Mark said, a lot of setups, right? But you also heard him say they're working. So right now, just last week, I just did my weekend report, and it was how there was a lot of setups last week. Lots and lots of stocks were on our focus list, but a lot of them didn't work. There was a lot of reversals. The Qs, obviously, they went tagged that high and reversed. If you take a look, even the equally weighted Qs tried to break out of a base, had a big reversal. So, but a lot of stocks were failing. So yes, the setups are the setups there, and are they working? Those are our two gauges. If they're setups and if they're working. And if they're not working, even if there's lots of setups, we're not going to get aggressive until they actually produce results. And then we'd start, progressively exposing, which I'm sure we're going to get into progressive exposure, because that's the most popular question that we ever get, is the progressive exposure.
Yeah. And Brandon, before we move on, was there anything else you wanted to add mindset wise about, key things that unlocked a belief in yourself that allowed you to push past what you thought you were able to do and really get stronger performance?
Yeah, so what's that saying? Feelings are great servants, but terrible masters, is something that comes to mind. And that's something that I think we all have to battle. Some of us are better at it than other, but it's like anything. The more you practice and build that muscle, the better you're going to be, where your feelings don't get to play a role in this. And when, Mark, laid the groundwork, he was just another iteration from O'Neill, right? And now he's passing this on to us. And it's just like, so at some point you have to surrender what you think to the guy that knows more than you, and focus on what he says is the process and refining the process. Who cares about the results? And that once you do that, and that's exactly what I had to do and what Mark and I have done, that has led to our successes. We have a process and we don't waver from it.
Yeah, and that's what I did. I had to surrender too. I had to get off of my own opinions, and I had to surrender. And quite frankly too, that one of the reasons why Brandon has a place in my heart for his dedication is because I was broke too. When I first started, I was broke beyond broke. I grew up in a family that my parents got divorced, and my mother, I used to listen to her cry at night because we didn't have money for food. So I came from incredible poverty. So to be it was, I had to get over a poverty mentality, which was very hard to even accept. Even when I started doing well, I had to pinch myself and go, wow, is this really happening here? But yeah, so there's, look, I know everybody wants tools and they want to know what moving average you use. But really read my mindset book, because that book is life changing. I read my own book. It may sound nuts, but I read my own mindset book over and over just to keep that stuff in my head. And I wrote the damn book, but it's just a great book, and it's really the most important element. It's the most important part of the whole equation of becoming a great trader or becoming a great anything.
And I'll just add one more thing. When Mark and I first started, we were trading so small. A few $100s was a big deal to us. Now, we have $1 million months, and it doesn't matter. Like, it's not about the money, it's about the process.
Yep.
And that's real. Like, when you get to that point, that's when like, okay, you have something. Your work has paid off. And I think Mark Minervini helped us realize that.
I started off when I first started in the 80s. I made my first trade in 1983. And my goal as a trader, my long term, the big goal, like if I would say this would be successful, was to make $500 a week. That was my original goal. Yep. I went from $500 a week to tens of millions, and that takes a mindset shift. Because and you guys are perfect to speak to this, because I know some people, you should have this problem. You should have the problem where you start off with $10,000, it becomes 100, and then it becomes 1 million, and then it becomes 10 million. You should have the problem of saying, oh, it's a lot harder now to mentally deal with taking a $50,000 loss as opposed to a $500 loss. And if you get to that point, believe me, you're going to hit a serious wall. And this is why a lot of people don't become really rich from trading. They can't elevate to that level. It's the same thing as if you're playing Little League baseball and then you play high school and now you go to the major league. It's a whole different story. It's a whole different game, right? So once you start moving up, so that mindset's got to grow, and that belief in yourself, it's really key. It's more important than the strategy. Strategy is the least important, because there's lots of strategies that you're going to have to commit to something.
Yeah, I think I saw a few people ask that question, where what's different between trading $1,000 account, $10,000 account, $100,000 account, $1 million account, and what kind of adjustments you have to make, along the way. But I think you answered that. But was there anything else you wanted to add on that front, or?
Technically, nothing's different. Mentally, everything's different. Right. You guys need to speak to that in particular, because you're closer to that than me. That was like 3 decades ago for me to jump that hurdle. So you're, I think, closer to that. You've jumped that hurdle more recently.
Sure. And listen, yeah, there's definitely a mentality shift, but this is where I think, what Brandon talked about, where, the process is the same. And I don't know if everybody's seen that, where, yes, there are some, mentality and a few shifts, but it's still the same process. Liquidity obviously changes, how aggressive you can be in certain situations, may change. But this is why I still like the idea, and I always encourage people, well, don't keep track of your losses in dollars, do it in percentage.
Mm-hmm.
So if you lost 3% on, $1,000 position, or $1 million position, it's still 3%. And it removes some of that emotional impact from things. But this is also where I think growing into these things is a much better way of doing it. Rather than just starting too large, if you will. And it's so ironic, when you read a lot of these success stories, most people started off with humble beginnings, at least in terms of, you read the Market Wizards and those types of things. I think there's a reason for that. You usually don't hear this. Oh, I came into the market with 100 million and ran into $1 billion. It's usually, no, I came into the market with very little, figured some things out, and then, was able to really continue to grow. So, I don't know, Brandon, you can add anything to that.
I mean, there's not much to add there. I can, this is where, for obviously for Marky and I, we had each other to talk to. So, when we did whatever, feel like as we grew in our drawdowns, you look at the dollars, even though the percentages were fine, it was like, okay, why does this feel worse than it is, right? And actually, a lot of the time it was just because the trading period, it's not the loss of money, it's more or less the duration of being in a drawdown sometimes that is harder than the actual drawdown, the percentage decline itself, because you want to get out of it, you want to claw your way out of it. So again, this is where just putting things in perspective helps a lot.
And he just inadvertently uttered a Livermore observation or Livermore technique, and that is time is as important as price. Time wears people out in the market, and that's why consolidations and basis and shakeouts and all that stuff is really important to understand, because those are people that are sitting with the stock. And as time goes by and the stock drifts down, just think about it. You have a stock and you've owned it for a couple days, couple weeks, and it has a down day, and it's a big down day. You go, you check the news, you see what's going on. You don't usually panic right out of it, But if that stock just drifted off little by little, every day after day after day after day, for a month straight, it went down every day, you'd be worn out to death, as opposed to a real quick drop. And so that's where, and now it comes back up and it gives you some hope, but then it comes back down and it crushes your hope again. And all these emotions get tied up in it. And that's what you're seeing in a chart. You're seeing the emotions on display, and you're seeing the supply and demand intersecting, and all that. When you learn how to read that properly, then you really know how to make heads or tails of it and find out where the line of least resistance is. And that goes again back to Livermore, line of least resistance. One of the best books to read that crystallized everything for me was Livermore's little book, How to Trade in Stocks. That's one of my favorite books of all time, because that was a pivotal moment. When I read that, I said, okay, these are timeless principles. This worked back then. It worked for Love. It worked for O'Neill. And this is amazing stuff here that I can count on, that I can build a career on. So I was willing to put the time in because I felt like it would pay me for a lifetime. And that's precisely what happened. Real quick too, if you want to get into specifics, I know we're going to end up running out of time here, but I do have a couple charts. You asked for a couple trade examples. We can show how this looks. And then talking about risk too. I think we talk about risk as far as stops are concerned, but risk is more than just your stop. And the way we look at risk is it's like there's 5 levels, and we're assessing a stock on, of course, the stop. The stop is where you're going to get out, and that's whether it's technical or you just decide I'm going to get out at $500 down or 5%. That depends, but there's liquidity. All right. As you get bigger, you have to get out when you can get out. Again, you should have that problem. But in the beginning, when you're buying 500 shares, you don't have that problem. But you do have the problem that if it's unliquid, it could fluctuate quite a bit. And then that gives you overnight risk, where now the stock may gap down against you and it rips through your stop. So that's your next risk. Your next risk is position sizing, right? If you have your whole entire account into one stock, well, then if the next day it gaps down 50%, you're down 50%. So that's another level of risk. And then we've got spread risk. We got spread, and that's for more shorter term. I'm taking a big position. I'm buying 50,000 shares, and the spread is a $2 spread. I'm not buying that. I'm not starting at $100,000 loss. I can tell you right now. So I take spread risk into consideration. So if it's General Motors, it's it's a Goodyear tire. It's got a penny spread. I'll go buy, and it's completely liquid. It trades 8 million shares a day. I'll buy 100,000 shares, no problem. But now it's got a 2-point spread and it trades 150,000 shares a day. I'm going to put very little money into that. So that I'm going to have to be a lot more careful. So there's risk on a bunch of different levels, and it's assessment of all that that gives you your risk profile.
Yeah,
That's
excellent.
a real nutshell version, but just giving you sort of the basics.
Yeah, that's perfect. Let's actually jump to those examples now, Mark, if you want to bring that up.
Sure.
And I know a lot of people's questions had to do with position management, selling to strength, and there's some really good examples that we're going to walk through here. And kind of everybody will chime in and provide their perspective on things, I think.
So this is I tweeted this pretty much along the way as we did this trade. This is the Micron trade, and a couple things that are interesting about this. And on this chart, we've got some proprietary gauges that we use. This is what I call the Fab 4 panel, and we don't have the time to get into it right now, but these are the charts that we use on our platform. You'll see this is a little uncharacteristic for me. This is sort of a bottom fishing pivot where you come back near the 50-day and you just form that very short-term little pivot. I very seldom do this. This is one Micron. I like what AI is doing for this industry group. I think they're elongating their cycle, their earning cycle. This is a growth cyclical group that is turning more to the growth side now because of AI. AI is obviously moving and pushing all types of it's like a big river pushing out all these little streams all over the place. So AI is very, very influential in a lot of areas. So we got aggressive on it right off the lows, but it didn't go right away, and it started turning down, and so we immediately started reducing it, and we reduced it on the second day it turned down. And then after I got that little bounce back, I actually thought we were going to get a little bounce, and that was sort of like the bounce before the dead cat bounce before it was going to collapse, and I had it wrong. So I reduced again, but kept a little position. But then it held up and it moved right up, and then it formed what I call a cheat area. This is the cheat, which is just basically a handle or a pivot within the middle portion of the base. If you're in the lower third, I call it a low cheat. If in the middle, I call it a cheat, and the top would be a typical O'Neill handle, which O'Neill got the handle from Giller, who had the saucer and platform, and O'Neill changed it to the cup and handle. I took the cup and handle, started realizing, you know what? There's lower points in the base that you can buy this. So I had a friend of mine, we used to trade, and we used to call each other throughout the day and talk about our trades. And he'd say, hey, did you buy, did you see XYZ? And I said, hey, I already bought it. I cheated. And he said, what do you mean? I bought it, a week ago. It was a lower pivot. And that's how the cheat started. And we realized that when the cup completed, before the handle, you would get what we call the cup completion cheat. So then I realized, and that was we would have to have the stock run up the right side a bit, and it would form in the middle portion. But then years later, it was like maybe 10 years later, 15 years later, I started recognizing and going, you know what? There's a low cheat. There's even there's more, like on TV, there's even another spot. But the thing is that you're going into the lower you buy, the more you're going into overhead supply on the left side. So as I developed as a trader, I started getting better at recognizing overhead and being able to read it and be able to effectively buy off the lows a little bit better. And that just takes, I call it an expert buy. As you go down in the base, you need to be better. Your skill needs to be better because you have to be able to assess overhead supply to the left. When you're on the right side and you're up by the old highs and you're breaking to new high, there is no overhead supply, or there's very little. So you don't have to be as skilled. So with this one, this is what we would call an expert buy coming off the lows. And then we quickly lightened up. But as it set up, now it improved. And very often, whether we're putting progressive exposure and building into a position or just buying it, for the first time, the best buy is at a higher price than the previous buy. And you can see here, we're buying higher here, but I get even more aggressive. So here I go full 100%, not 100% invested the whole account, but a full position. We went to the full 100% position, went back. Then it was able to mark itself up and tighten up even more and really form a nice large base. And at that point, that's when we went overweight. Now we took a really big position. Now with that overweight, a lot of times what I'll do, and I'm just walking you through this so you can see sort of how, we trade, I trade, they trade. A lot of times what we do is if we're overweight and we're fortunate to get a quick move, we'll take the overweight off because now we still got a full position. And now maybe, we're up, let's just call it 10%, and our stop is 8 or 10%. Well, now we have a full position and we fully financed all the risk. Holy cow, what a position to be in. I have my whole position and I have zero risk. That's what we call asymmetric leverage. So we're always trying to get to a point, angle ourselves to have asymmetric leverage where the upside far outweighs the downside to a point where we've improved our worst case scenario where we don't have any risk anymore. And that's really the key. That's the key to making big returns, having low drawdowns, is to always move towards asymmetric leverage. This is a term that I learned from my very good friend and one of my mentors, Larry Height, who those of you who know me and have came last year to our gala, met Larry Height. Well, you know what I know. He's one of the most beautiful people you'll ever meet in your life. He's awesome. And he's in his 80s, and he calls me up and he goes, I just love to learn. I just love to talk to you and learn. And he's still learning, and we learn from each other. But we always talk about asymmetric leverage, creating this asymmetric leverage. So then as you rally here, and the stock gets extended from a swing trading standpoint, I very often will just sell the stock, take a quick profit, whether it's 15, 20, 25, sometimes, 40, 50% or more, and sell right into strength and get out when the getting's good. This particular time happened to be the day before 17% drawdown, so it was a perfect sale, but it could have very easily been a horrible sale. I mean, if you look at NVIDIA, I don't have the chart. Well, actually, I could pull up a chart. Hold on, let me see. Let's pull up. So two things about NVIDIA. Let me say one thing. First of all, we heard some people say that breakouts don't work anymore, and we hear this from time to time. David Ryan and I commented about this many times, where you get periods of times where breakouts don't work, just like anything. Nothing. If this system, and what I do worked every single day perpetually, I'd be a trillionaire. So yes, it takes work, it takes faith to go through the tough times, and you got to give everybody gets their chance. Like your breakouts will work for some cycles, and then the value guys get their chance, but you got to stick with it because you're not going to be good at switching from one to the next, to the next, to the next. So, but to say breakouts don't work is to ignore, okay, let's say we look at a 10-year period, even if they didn't work for 10 years, they worked for 120. So it's to ignore history. And if you look at that 120 years, you'll see that there's stretches where, yes, it's very challenging to play breakouts. But here's the great news. When they don't work for a while, I love it. Mark's smiling because he feels the same way. He knows, he learned what I know, is that when they don't work, it's perfect because you weed out everyone and then they work like a charm. The longer they don't work, the more I am adding money to my account and getting ready for the chance of a lifetime where I'm going to make a fortune in a very short. And Mark and Brandon have years where they're up 350%. I had a year where I was up 412%. In the U.S. Investing Championship in 2021, I was up almost 350%. So you have those years every now and then. You only need a few of those, and as long as you keep the downside in check, you make a lot of money. So, but looking at NVIDIA, we bought NVIDIA right here. Right on this day right here, just as it started to come out. But you couldn't buy it any better. It was textbook. I'm sure lots of people bought it there. But I also just sold it right into the first rally. But I also bought it back here. I'll show you another time. And this just speaks to 2 points. One, breakouts. This is one of the biggest companies in the world, and it should be. These are the companies that the breakout shouldn't work because they're so efficiently priced. But look at this breakout here. I bought it right here too, right on this day. Bought it, and I also sold it into strength very quickly, and it turned out to be, obviously way too early. But that's just been my MO since day one. So, and a lot of times what I'll do is I'll sell into strength, and it'll rebase. I'll buy it again. I'll sell into strength, and when it's all said and done, I traded Yahoo in 1997 off the IPO like 7 times. I ended up making, I don't even remember what it was, 400 or 500% on it. And I traded the first time for a double, the next time 60%, the next time 30, the next time 20, the next time 25. When it was all said and done, I made hundreds and hundreds of percent on a stock that went up 8,000%. And over the years, I bought Amazon right off the IPO base. I bought Yahoo off the IPO base. I bought Cisco off the IPO base. People go, well, if you held that, you would have made 100,000%. I've made over 600,000% in my career. If you compound everything, I'm up about over 600,000% over it's actually over about 30 years or so. I think it comes out to 35 or 40% a year compound. Funny thing is, Mark, when we were just preparing for this, I looked at your return, the 5,000 plus. You guys are up, I think, about the same that I am up career. I think your return comes out to about 35% a year, something like that. So I've had those triple digit runs where, in the 90s, I had a run where I was up 220% average for 5 years. But over the long term, I'm up in the neighborhood of just under 40%. But anyway, I want to show you that. Let's go on the other
Just to
one.
add a quick comment to the NVIDIA though, Mark, where Mark's talking about, selling too early. And to my comment before, listen, if I make multiple of my risk and the stock goes higher, that's fine. I'm in the business to make money. And if you look at the way Mark is handling these, the way we're handling, and even this most recent example with NVIDIA, it's all alpha. He's grabbing that quick alpha. And a lot of people don't understand this concept. They want to just be in NVIDIA forever because it's the stock that's always moving. But we're looking.
And that's another way to skin the cat.
That is another way to skin the cat, but it's a much more volatile way to skin the cat. You're skinning a live cat, if you will, or something, where we're sitting here trying to grab that quick alpha move before letting, being very precise on our timing. And that's what we're trying to continue to turn over and not allowing that stock then, to take you for a while to ride as it gets extended. The other point I would make from the Micron is that every one of those buys, if you just look at them in a vacuum, stands on their own. And that's one thing we're always talking about, is each one of these buys. So even if you didn't own the name, and that first buy was the most professional buy for sure, but the second and third buy, if you didn't own the name, that's where I'd be wanting to buy it. It's just sort of
it's a great point. What Mark is saying is that we're not adding to it just simply because we'd be buying it at that spot anyway. So that's a really important point, that every buy stands on its own, and you're not just haphazardly. People think that when they listen to comments like O'Neill makes, where you say, you pyramid into the stock, that you just buy it just for the heck of it because it's up 5%. No, it still has to meet the same criteria, meet the same hurdle. Now, these techniques will work. And this is something that Mark pointed out a long time. He said, why aren't we trading, crypto, and all these cryptos? They're like responding perfectly to your tactics. And then, of course, recently we were trading IBIT, which is Bitcoin, of course. But there's lots of cryptos. But this chart shows a couple things on how we trade and also how we handle the risk side and getting stopped out. But one point to make is opportunity cost. So yes, you could own a Amazon and hold it I have a friend that's held Amazon for like 15 years. He's made a fortune in it from a very small investment. But how many people are fortunate enough to do that? And how many people would hold through a 50% drawdown or 90% pullback to get to that, right? So I always say somebody wins lotto every week, but every week the name's different, right? So I started trading because I wanted to get rich, and I wanted to have the freedom of having a job, that I had the freedom and I didn't go work for somebody. And I needed consistency. I needed to make money consistently for 2 reasons. One, because I needed to make money, and 2, to grow your wealth, you need to compound. So I realized that, stocks go up 10, 15, 20%. Every stock goes up 10, 15, 20%, but only a handful go up 80,000%. And it takes a long time. So I did the math. I realized, and we have something, the Master Trader Program, it's relatively new. I've been only talking about it in the last few years. It's called mind-blowing math. And once you see that, it changes everything. Your entire, I've had hundreds and hundreds and hundreds of people send me emails and just go, my God, that is just blew my mind. You said it was mind-blowing. It was mind-blowing, and it changed my whole perspective. And so Here's a perfect example, and this is off of the what we would call the cheat, the low cheat right here. It's a perfect example, and this was already an existing um, security, obviously, but this is where they put the ETF and it formed what looks like an IPO. But you've got this little low cheat. We bought it right here, right? Took a full size, big position, right into strength, reduced it. Bitcoin could be volatile, so I said, you know what? Let's take some off the table here. Now we're free rolling, right? But then it's set up, and like I said, you could sometimes get very often your best buy is at a higher price. So it sets up, it tightens up real nice here and holds its gains, sets up a perfect, if you look at it, it's a perfect cup with handle, right? VCP, what I call it. Boom, comes out here, we're back in. We move right back up and we ratchet up again. And I do the process all over again. I reduce it into the strength and I cover my risk once again. And now I've already backlogged a profit, and now I backlogged 2 profits. So now I'm really free rolling. Moves up a little more, I reduce, and then it had this break. And I felt like, oh shit, I should have sold it into the strength and just closed it. But I got what I call the gift. When you get a big break and you get that dead cat bounce, especially if it comes back 2/3 or so, I usually just get out right then and there. So I punted it on that next day. And then it went up a couple more days, rolled over. Now we tried to get back in it over here as it came off the lows here on a little pullback buy, and we were thinking this will probably not take off right from here. It'll probably come up and tighten up, and then we'll add to it. And it did. And it was looking perfect, but then it turned tail, and we put a break-even stop. We got out. Then we kept watching it. It went through this. It undercut these lows. Perfect. Tightened up. Now I was like, okay, this is it. This is where it's really going to take off. We got a nice big base now and really getting aggressive on it, and started buying it right here again. And then we just put a super tight stop, got out on it right away, got stopped out of it. And I thought I might have blown it because right after that, it took off, went up a few days. And Mark, we had a conversation. He's like, uh-oh, I think we might have got out too quick here. But since then, it's rolled over, and now, we're out of it. But that's the way, we're trading around positions. We're adding back, we're reducing, we're using strength to sell into, getting out when the getting's good, and not walking away from a stock. Even there's sometimes where I'm buying the stock on the 5th base. I was buying it on the 1st base. I sold it. But second base, I bought it 5, 6 times, buying it as it comes out of base after base after base. And then when you string it all together, you got this really nice big return on that stock, but it's from a number of trades.
And jumping with the question, because you mentioned free rolling a trade, and just to clarify for people who may not be familiar with that, when you say reduce, if you could go back to that chart just quick, sorry.
All right,
no worries. I'll ask the question as
which chart do you want? The Bitcoin?
Yeah, this one, IBIT. Yeah. When you say reduce and that label, when you're selling for that first push up, you're also moving your stop up to break even, and that's what's free rolling the trade. Is that correct? And is there anything you want to add there?
All right, so it's a great question. Mark, if you guys have anything to add, I know usually we're talking the same language, but look, there's a few ways that you can free roll. One is you buy the stock, it moves up, and now you move your stop to break even. Obviously, if it goes down, you break even, right? But the problem with that is that now you choke the trade. You cinch up on the trade. You do have a full position. You have your whole position still, right? But now you're not giving it any room. So a compromise is to, if that stock goes up X percentage, and the more it goes up, the less you have to sell to do this. If it goes up an equal amount to your stop, let's say your stop's 8%. If it goes up an equal amount, it goes up 8%. If you sell half, you now can let it go down at 8%, and you're still break even. Now, you only have half the trade, but you have 2 things to your advantage. One, you have unlimited upside on that half position, and you have 0 downside. All right. So, and you've been able to give it more room now. You give it the room. So you've got those 2 things going for you. Now, you could do the same thing mathematically and say, well, I have 100% upside and no downside, and I have double the position. Right. But now you might be knocked out of it and you have no position. So me, I'd rather have half position and give it more room most of the time, especially if it's the beginning of a bull market, because now if I'm on a monster, even a half position could be huge. Later stage, I'm not even playing that game. I'm just selling right into strength and just getting out when the getting's good. And I'm not thinking hold for a big move when I'm fifth stage base and I've been in a bull market for 3 years. Now I switch over to more to a trader. So again, there's nuances there, and there is some art to it, but a lot of it's science too.
And one more question I had about this trade is, before your June or late May trade there where you were stopped out, there was kind of a potential low cheat area there in early May, where it pushes off the lows. Was that not quite tight enough for you? There was also a gap out of that area. How would you kind of analyze that part of the chart?
So we were looking at it there, and that's exactly right. And I know you have a good eye for this. But you see it gapped, it didn't really tighten up, and then it came out on the gap. And we're not going to chase the gap. So you have the overhead too. You've got
Right.
more overhead. When you're going low cheap, you've got a lot of overhead. So if you're really close to the overhead, now you've got to measure how much overhead to the left and how deep you are. So let's just say this was a 50% decline. Okay, this overhead is major. I'm not touching that. Let's say this is a 15% decline. Now this is very viable because there's very little overhead. Still, even with that scenario, probably, unless things are going great and everything's just ripping, we probably still would take a partial position and then sort of build into it, because most likely it's going to run up, it's going to go into this overhead, and it's going to pause just like it did. And this is where you can see how it's developing. Is it doing what it should do? This is absolutely perfect. Up to this point, it's perfect. And even this pullback, nothing wrong. Then here, that's abnormal. That's not acting right. And as it comes below here, now it's really not acting right. So now it's got to go through a whole reset. It's just not. And when I say not acting right, meaning that the supply is coming to market. We have not gone through this supply. The supply, and this is a concept that I originally heard O'Neill say. He said, you have to find out when supply stops coming to market. And then I termed it, I want to be the last weak holder. We talked about weak holders. I want to be the last weak holder. You heard Mark talk about that earlier. That means that the supply, you're in an uptrend. There's big institutions that are buying this stock. There's a lot of small guys, right, that are trading this, that they're weak holders. They're gonna get knocked out on a little pullback. They got their stop real tight. They're doing all these techniques that we're talking about. Those are weak holders. But the big guys, the guys that are really moving the stock, that could sustainably move the stock, they're forming the cup. They're buying down here. They're supporting the stock. So when finally you weed out all these little guys, well, there's nothing left. There's no supply. And now you have big demand. So if you have big demand and low supply, what happens? Boom, explosion. That's why it's not a coincidence that when you see these charts and you see these tight areas on the right side, that the stock catapults out of there. People think, well, that's because of the chart. Everybody sees it. No, absolutely not. It's just the opposite. It's not the cause, it's the effect. If everybody saw it, it wouldn't work. That's precisely would be the opposite. So you have to think, how is the supply coming to market? This took me a good decade to even understand, let alone to apply. And even to this day, Bob Weissman, who's worked for me for 21 years, it took him a decade. 10 years later, he goes, all right, I think I got it. It's like 10 years later, he goes, I think I got what you're talking about. He's asked me every day, what does it really mean? Then he thought he would get the point. And then he'd tell me, and I said, no, that's not right. That's not what it means. And we had to go over it and go over it and go over it and go over charts. So once you understand that, then you really understand what's going on here, and it can make sense to you.
I love
I'll
that.
just
Yeah,
add
go
too,
ahead.
and you look at those first two little pivots.
tight.
They're
Perfect.
tight in price, yeah, and the volume is contracting, and that especially that second one, well, that volume comes in. Price only has one place to go. That demand that Mark is talking about, you're seeing it right there. It's just a textbook example.
Yeah, and again, they say, well, why aren't you the richest man in the world? You just do that. Well, because there's discipline involved. It doesn't work all the time. Matter of fact, it only works about half the time in a good market. In a bad market, this will only work about 20-30% of the time. All right. But that's part of the strategy. Part of the strategy is managing the times where things don't work well. It's like, do you go up to bat and get a base hit every time? No. Do you hit a home run every time? No. Good baseball players bat 300. That's good, right? They strike out 7 out of 10 times. So then how do you ever win a game? It's the same thing. You've got to manage it. You've got to manage it and take advantage of when it does work. With with trading, you have the position sizing. You know, you can step on the gas when it's working. You could ride the brake. And that's the art part. That's part science, but also takes a lot of experience to get it to where you really understand when you should be really gassing it and making those returns and then laying off and letting all the noise go by.
And that ties in really nicely to the concept that we know everybody wants to hear about, progressive exposure. Mark, if you wouldn't mind going back to the MU trade, because this, I believe, would have been one of your first trades, that first buy coming out of the correction that we were in. Could you kind of talk about your mindset when you're coming back into the market from 100% cash? We've been through a correction. What are you trying to do with your first few positions? How are you judging the traction of those positions to determine if you're going to increase size, try more trades? You know, all of that I think would be really excellent.
Okay, so I'll start off with, I'm going to give you some guidelines on progressive exposure. And then also I'll let Mark and Brandon also come in on that because they're really great at explaining that and deploying it. So you have to think of progressive exposure on a couple different levels. It's not just position sizing. It's exposure, it's total exposure. So for instance, 25%. You come into the market with 20, whether it's, let's say it's 5 stocks at 5% each, or 1 stock at 25%. Both times you're 25% invested, right? One time, theoretically, you have more risk because you have 1 stock. So you have a single stock risk. Okay, so now there's position sizing. There's that individual risk. So to where you progressively expose, maybe I start off with 5% positions, but now as things get better, I move to 10, 15, and I move the position sizing up. And then there's your number of stocks, which by default is going to happen. But actually, you would think as you're getting more exposed, you have more stocks. No, actually, a lot of times it's just the opposite. Where for me, I start off with some lighter positions, some smaller positions, and then I start concentrating. As things get going well, now I'm taking bigger positions, so I actually have less actual positions. So those are like your, and I don't know, Mark, Brandon, did I leave anything out with progressive exposure?
A question, I'll jump in with a question, sorry, and Brandon, feel free to elaborate on this. I think a common question people have is, are you selling those first smaller positions and then going back in with a bigger position on a new stock, or are you just adding to those first initial positions? I think that's a good clarification question there.
Mark, you want to take that as far as adding to a position and talking
Yeah,
about
and I think the
trade
Micron
standing on its own 2 feet?
Yeah, the Micron example is a perfect one. In the same way that you want to add to a position as it's working is the same way you want to step up exposure in your overall portfolio. And to the specific question, Richard, though, do you have to take profits in order to buy another name? You can, but you don't have to. And we often don't. We'll lean on those gains in the form of cushion to say, okay, we buy a name, it starts to move. We're going to lean on that a bit to take some more exposure. And that's the whole concept of feedback that we were talking about before. When I was saying, if you think of your own trading as the most important of echo chambers, if you will, that's what you want to stay in sync with. One of the biggest mistakes people make is they go, well, and a question I get, well, what do you own and how invested are you? Why is that as important as what do you own and how's your trading going? Because what's going to drive my trading and my exposure is how the positions I'm in are doing. It's not, and as Mark has often said, if you're 50% invested and it's going horrible, it doesn't make any sense to double up. That's how you get yourself into a disaster. And the whole, start with the end in mind. The whole goal of progressive exposure is to be trading your largest when things are really humming, when they're really working. Well, the only way you can do that is to stay in sync with how things are going. So
the goal to do really well in the market is to get to whatever strategy you're using, is to develop a method or a mechanism that you are trading your largest when you're trading your best and your smallest when you're trading your worst. That is a huge, enormous statement that everybody should listen to over and over and over, write it on the wall and live it every day as a goal, because that's how you make the big money in the good markets and you keep it. All right. So now there's a couple things to talk about here. One is, and these are the questions. Mark said we're going to lean on those profits. Well, now there's open profits, right? And there's closed profits. Those are 2 completely different things. If you close a trade, well, that risk is out of the portfolio. Now you add a new trade, right? So let's equate it to the crap table, right? You've got a bet out there and you have a bet on the 6 and you hit a 6, you make some money, it's still out there. So you say, you know what, I'm doing pretty good. I'll take the 8 now, and I'm going to buy the 4 and the 10. Now you've got more exposure, right? So now if they roll a 7, you lose on all those bets, right? So you have a much bigger drawdown. So now you didn't close those out yet. If you close them all out and then you put one bet, well, now you're financing that new risk. So you got to think closed versus open. If they're open, well, you got to watch those carefully because those open trades can move at the same time as those new trades. But if it's closed, you've got a little more leverage, a little more, you have profit in the tank. It's going to be a combination of that. It's never going to be one or the other for very long. And at some point, you've got to make a decision whether I've got the traction that I feel comfortable to push harder. And that's where we got to look at your worst case scenario. We're always talking about our worst case scenario. What is the worst case scenario? If I get knocked out of everything here, what am I down? And that has to be managed. All this has to be managed. So one thing is what I call the 2-for-1 rule. So you're in a stock, whether it's doing good or bad. Let's just say it's doing bad. It's not doing very good, but it hasn't hit your stop yet. And you got another stock that's setting up, or you have even a couple stocks that are not performing too well. So you want to participate, but you don't want to lever up, because why would you add money? As Mark said, you're going to add money when things aren't working. So you sell a half of the 2 positions and you buy a full position in the new stock. So now the stock that's looking the best at the time is getting the most money. The stocks that aren't doing too well are getting reduced, and you haven't raised your exposure at all. So that's one technique. There's lots of different techniques that we use. They're just permutations. They're permutations of that concept.
Well, and I'll just add, progressive exposure is, one of these topics, like, we're going to talk about this forever, right? And Mark and myself are continuing to try to get better at this. And I think a lot of people get hung up on, well, I got more exposure on, I thought I was being progressive, and, I did it wrong. I got stopped out. It's like, well, that happens. That's what's going to happen, right? And I think what Mark is saying too, as far as what is the risk factor that you are willing to take? And as for Mark and myself, as we're getting the feedback, and this has taken a long time to get good at this, as we get the feedback, we are willing to take that risk number up. So if we're getting the feedback we want to see, we will increase the amount of risk we were willing to take. And I think a lot of people get hung up on that. And we have to be okay with that if we do up the risk and we get our hand slapped that when we were wrong, that we're going to take that loss. And so, I think a lot of people think like, oh, progressive exposure, I should just do it when it's only working. It's like, well, it doesn't work every time.
Yeah, and in perfect what you said was, people get hung up on a specific answer. They want to know if it goes to, I take 25% and this stock goes up 10%, I add X percentage. It doesn't really work that way, because it's just like poker. It's a texture of the game. You got to feel the texture of the game. You're playing poker and there's a guy on there that's a really good player. There's a couple fish on the table and you see how things are going, how aggressive the betting is, and you feel that, and there's an art to it. And there's the science of the pot odds and the actual percentage of the hand. You have to know that. That's the basics. But then there's that feel, there's the bluffing factor, there's the factor of your stack size versus, there's all these things. It's the same thing with trading. That's why it's beautiful. This is why it's a beautiful business. And the reason why, I want to point this out, the reason why there's this awesome opportunity is because it can't all be figured out into a spreadsheet. People want to put this into a spreadsheet, want to put it into a program. They think AI is going to put everybody out of business. It's nonsense, absolutely ridiculous. Okay. This is an art. This is no different than you learning how to be a great baseball player. You can learn all about the physics and be in the right angle and in the box and have the bat in the right spot. But the bottom line is you got to have experience. You have to have experience. There's an art to it as well. If it could all be put into a spreadsheet and everything could be figured out and some algorithm could just run it, guess what? No return. The market will be 100% efficient and random. And the random walk hypothesis would be right. But it's wrong. It's wrong because guys like myself, Brandon, Mark, David Ryan, Jesse Livermore, Nicholas Darvis, you name it. David Ryan, they couldn't exist. William O'Neill, we couldn't exist. And it goes on every generation all the way back to the 1800s that there's people that outperform the market. And the real thing is it's not like Lotto. The names don't change. Stanley Druckenmiller's been doing it for 10 decades and decades and decades. I used to advise the Soros Group. You know, these guys, I had a young guy that was that I advised back in the 1990s. He went on to become a multi-billionaire. Okay. So you know, the names don't change. Matter of fact, they seem to get where the guys that are good at this, they have long careers.
Excellent. Yeah, I think that provides a lot of clarity in terms of progressive exposure. Hopefully that answered a lot of your guys' questions. One last question on
It's going to raise questions too, Rich.
Yeah, it's true. It's true.
We're definitely we have a lot of thought-provoking things here that are going to raise a lot of questions.
Yeah, but there's resources for that, which is fantastic.
That's right.
One last chart question.
That's why our Master Trader program is 5 days now. It started off one day. It just keeps getting longer and longer and longer. But go ahead. I'm sorry.
Yeah, no worries. Could you go back to the IBIT chart? Because I want to ask about, because I know people are wondering this, for the reduced labels, how much are you typically reducing into strength? Is it always 50%? I know you talk about that in your books, or does it depend on the situation?
So I can speak from me, generally speaking, and generally what we put on the platform, and Mark and Brandon, you guys could speak from your own personal trading, but I tend to operate in like quarter positions and half positions. It's just the way I've done it. I tried it different ways, and it doesn't seem to make a whole lot of difference if I do thirds, halves, and quarters. But certainly I'm not taking off like 5%, 10%. That's more of a mutual fund type strategy. Usually what happens is the stock moves up. I'm taking off enough to either cushion all my risk or cushion half my risk.
Mhm.
So, and again, if the stock goes up 20% and you got an 8% stop, you could sell a lot less than half to cushion the entire position, right? So depending on how much it goes up, depends how much I'm going to sell versus where my stop is. So if I want to finance risk. So I'm generally in quarter position, half positions, and full positions, and overweights are usually, you know, 1 1/4, 1 1/2, 2 times. But when I go overweight, I usually go heavy. I usually go pretty heavy on an overweight. Like I'll double my position. If I've got, let's just say it's a 20% and I go to a 40% position, I'm probably not going to hold overnight, or at least I'm going to take some off. If I'm just looking for that thing to get some gas and give me a little return, take a little off, finance a little, that'll finance me overnight. And if I get a little more, take a little more off, and that'll finance my risk for the whole full position. So always looking to finance my risk. I'm trying to get into, and this is, again, this is really, this has been my whole life's work. And Paul Tudor Jones is really one of the main people responsible for me being so stickler on my risk. But Larry Hite really took it like to another level, not with giving me any techniques, but just with his absolute discipline and passion for improving that worst case scenario and creating asymmetric leverage. We had so many discussions. I'm so fortunate to be friends with these market wizards who I idolized when I was your age. And now Stan Weinstein's a good friend of mine. Larry Hite's a great friend of mine. I talk to him all the time. We talk regularly, and it's just wonderful because I learn, I learn and I get these great insights from guys that have been doing it even, 20, 30 years longer than me. And I've been doing it for 40.
Yeah, excellent. Mark, Ritchie, or Brandon, did you have anything to add with regards to selling into strength, how much you guys typically do it, or also the concept of going a little bit overweight in a position as well?
Not much differently, honestly, we sort of cut from the same cloth, but yeah, as a general rule, sort of thirds or halves. If it's a position we want to play for a bigger move, we generally don't sell more than half. And then, as Mark was saying, the most important thing, in terms of even going overweight or getting more aggressively long, like he said, the more concentrated you are, the more overnight risk you're carrying. So you have to be thinking in terms of like, how do you, manage that worst case scenario? What are you comfortable with holding overnight? So if we're going to get really aggressive in one name, we're going to be really cognizant of that, and then be more likely to reduce a little bit faster, because we're not going to carry, for us, anything over a 20-25% position would be considered overweight, and we're not usually carrying more than, say, 30% overnight in any one name.
Mm-hmm.
Yeah. Did you notice the entire time that we've all been talking that we almost exclusively have been talking about risk? And no matter what question you ask, it all roads lead back to risk management. And that's the bottom line. And that's what we just work at becoming better and better and better and better at.
And if you read the Market Wizards books, everything comes back to risk. They all mention risk management as one of the
Yeah.
keys. Yeah.
I said it in my book. I don't know. I don't remember what book or where I said it, but I remember I said it. But Jack Schwager, when he had interviewed me for Market Wizards, he came in and he threw his tape recorder on and we talked for hours and hours and hours. And he sighed and he took his recorder, he turned it off, and he said, Mark, this is all great, but this is what they all say. He's like, this is what he's like, this is what everybody says. All I've already written several Market Wizards book, and they all say the same thing. I said, Jack, I hate to tell you, but there's a reason why this is what they say. And I'm sorry, but this is how I do it too. You know, that's right. There's a reason why, and while it may be boring, I remember Jack telling me that day, he said, my Market Wizards books have been really successful, but I'd like to write one that people would like to sit on the beach and read it like almost like a novel. I said, Jack, that's not going to happen. I said, people are reading these books to read about the masters and how they did it, and they want tools, and yeah, they want stories too. But it was a fun conversation that we had. But I went right back to talking about risk and cutting losses.
Only the most committed traders are reading that at the beach. And I think there's definitely a lot in the audience who do that. Brandon, did you have anything to add as well, or cut from the same cloth? Yeah.
Yeah, no, definitely. But I was always taught early on in life that risk is bad. And I think when you really calculate risk is an opportunity. And I think when like what Mark just said, my job, what I'm trying to do is understand all the risks and get better at it. And I think, if you do that, there's a lot of opportunity out in the world.
Perfect. You said you had nothing to add, and then there's that gem that you just provided. So thank you so much for that. Mark, Ritchie, did you have something to add on that, or you just agreeing? Cool. Mark, did you have any other charts to share, or should we start with the wrap-up questions?
I didn't even know I was sharing charts until the last minute, so sorry about that. But
well, I think everybody really valued you walking through that. I know I got something out of it. So
they're all going to look very similar. That's the thing. We rinse and repeat. Certainly people will show the losses. The losses are really the absolute most boring, because basically we just buy the stock, and if it goes down, we sell it real quick. It's real. There's not a whole lot to show. Sometimes we sell them before they hit the stop. If there's a lot of what I call violations, that's what you have up here. Actually, this what's called Monitor. We have a module in our platform that monitors the stock and looks at confirmations versus violations, which are basically programmed by me, what I would look at and with my own eyes, and then tells you, where you're getting. This one's set on what we call no-nos after you buy. So once you buy, we don't want to see many of these red lines, and you'll see there's very little here after the buy, and then there starts to be a bunch of them, and that's where we want to lay off. So then after the buy, like even right here, you can see there's very few. It's acting right. But then as it starts to not act right, you start to see the no-nos coming in here. It's just, these are just basically a sort of like, a gauge of that would be looking at it like I look with my own eyes, a sort of a shortcut function. And then you could hover over them. It'll tell you which ones are triggering. So, again, this is what we call the Fab 4 panel here that has the indicators that will tell you sort of what I'm looking at, just to get you in the right direction. You can't get too far off track if this panel is in line. It's hard to get too far off track unless you're arguing with the market.
Excellent. And I'll ask you guys kind of key resources and tools like that in just a second that people can take advantage of. But first, I wanted to ask this question. I thought it was a pretty good one. Hopefully you guys agree as well. But for everybody watching, if you had to give them one exercise to help them improve their trading, one assignment exercise, what would it be? And we talked very early on about post-analysis, how important that is to go through all their trades. So maybe it's something in that vein. But maybe starting with Brandon, if you had to give them one exercise that you think would help them, improve their trading, improve their chart eye, risk management, whatever it is, what would it kind of be, do you think?
Oh boy, that's a good question. Wish I was more prepared to answer it. Obviously tracking your trades. If you're not doing that, I just don't know how you're going to get better. Knowing what you've done is the best teacher, like we've, talked about prior. So without that, I just don't, if you're doing that, great. Then develop a process where that's repeatable, where you continue to do it, and then, judge the results. Are you getting better?
Perfect. Mark Ritchie, do you have anything to add? Oh, you're on mute, I believe.
We covered, a few of those things, but the other thing I would add maybe that at least seems to be popular is just shut off the noise. Take the indexes off your screen, take Twitter off your screen, take all that other crap off your screen, follow your rules, stay in your lane and don't pay attention to anything else, and do it for a year, not a day or a week. And then come back to me or you and tell us how it's gone. And I think most people would be shocked how much better they do if they did that versus, listening to all the noise and nonsense out there.
Excellent. And Mark, I know you've got some good tasks for everybody, I'm sure.
Yeah, I mean, look, when I first start working with somebody, if I was to work one-on-one with you and coach you as a trader, particularly back when I was running hedge funds and I had guys come work for me, I would narrow them down to just a very small number of parameters. Like I would only allow them to trade a certain area of relative strength, a certain price pattern, and say, look, you're going to trade this one price pattern in this RS with these characteristics, and you can't go outside that. Until you can trade that, you're not going outside those parameters to really get someone focused, because there's so much noise. There's so many things. Again, indicators, all these indicators. Now, I'm showing you some gauges that we have here, and I was very reluctant to even produce these because I don't use any indicators. I use no indicators whatsoever. But we did indicators in a very different way. If you even want to call them indicators, I call them gauges. We did them where they're really looking at the stocks. They're not like this. They're kind of biased indicators. They're built around me and how I look at the stock. And it's amazing that we could even program this. I didn't think we were going to be able to, but we were able to do it in a very effectively. So this focuses you. Like these gauges do that. If you're sticking with when they have certain readings, and I have those recommendations for our members that you have these certain readings, you are automatically focused in a specific area and you can't trade outside it. So that's sort of what I'm gearing our whole platform around. Now, they're not going to, if for a value buyer, these are not going to work. See, like a stochastics or some of these other indicators are sort of agnostic. You can use them oversold, overbought. Not my gauges. My gauges are built around me and what Mark Minervini sees through his eyes. These things are like looking like me, and we're actually using AI now to enhance that and to look at the charts like Mark Minervini looks at them. Now, you could use them in all different ways. It's just the way we decided to do it for those who want to trade like I trade and learn my strategy. So I would narrow down to a very specific, say whatever the parameters are, and really just filter it down so you're only looking at a very small number of names. Or screens, or people screen, they run all these screens, they got 500 names, and there's, you wonder why you're confused and you can't do well. You can't buy everything. How many stocks can you even buy? You can only buy a couple. So, and you got to get used to letting a lot of pitches go by. And that's the way you do it. That's the way you do it. You narrow your universe down, and you say, hey, and there's a good book. I forget what it's called. It's by Ted Williams, but it shows a box. I'm going to put this in my next book. I'm going to talk about it, but it shows his box and sort of his sweet spot of where he will like the pitches. And Mark says this all the time. If I'm seeing the ball, that ball's coming into my strike zone. We've got a very narrow strike zone. And we're only swinging at those pitches that come in at that zone. You've got to condition yourself to do that, or you're never going to have a strategy. You're going to be all over the place, buying everything, listen to every tip that comes on TV, and trying all these different things. You got to narrow down. You've got to get focused, and that's the real key. And then, as they said, Mark said one of the best things you could say, advice you can give, is to get the indexes, everything off your screen, trade the stocks. And as Brandon said, do the post analysis, go in there, look at the trades, see what you're doing. That's your best teacher, but do it on a very narrow a very narrow set of parameters to start off with, and do that for a while. Do that for at least a year or two. You should be able to double your account first. I mean, you tell me I could only you say, Mark Minervini, you could only trade 98 and 99 relative strength stocks that are 5% from their highs. I will make money. You give me those, give me any parameters. I don't care what they are. You give me any parameters, I'll make money. I'll figure out how to make money in that narrow window. And there'll be long stretches of time where I won't participate because nothing sets up for me. But that's what you have to get used to, because that's precisely what it means to have a strategy. There's going to be periods of time where you got to sit back and you got to let others take their turn, and then you get your turn, and you make as much as you can when it's your turn, and when it's not your turn, that's where you got to learn to sit on your hands, what I call sit out power, and not lose your money, not lose what you made.
Excellent. A lot of golden nuggets there, and that focus. Yeah, I'll mention this.
So, well, I wanted to also
yeah,
talk about one other. Yeah, sorry,
Sure.
Rich. I'm sorry. I wanted to not only talk about the Master Trader Program, but I want to talk about my birthday bash
Yes,
before I
course.
forget. Yeah, I wanted to give that invite to everybody. But go ahead. I'm sorry.
No, I was just gonna say, one of the key changes I made in my trading, was I limited my daily buy list to 3 stocks. You know, 3 years ago, I would have 15 names in there, which I'm trying to watch and manage alerts and all that. And limiting to 3 really helped me. That focus really helped me execute better, manage risk better, get tighter entries, all of that. So I would double down on that focus. I think that's a golden nugget. So thank you very much for that. And I was going to ask you, which leads into this, what resources, given what people learned today, if they want to learn more, where can they go to learn more and learn more about from you guys?
Well, let me say a couple things. First is that there's more resources than ever, and it's an amazing time to be a stock trader. It's an amazing time to be a human being. There's lots of crazy things happening in the world due to technology, but there's a lot of wonderful things. So we didn't have, when I first started, there wasn't a master trader program, although eventually I went to the O'Neill seminar, which was pivotal for me. But we were going to the library. I was going to the library reading crappy books about strategies that never worked in the first place. So it took me a lot of time. That's why it took me 6 years. I had to figure this shit out by myself. I was graphing the stocks on graph paper by hand in the beginning, which some people can't believe. But and standing outside a brokerage account to go in and check the quotes because I didn't have quotes. So crazy things that I went through, the commitments. And then, of course, Brandon selling his car. We've all made these sacrifices to get to where we need to get here. So the resources are fantastic. The problem is that there's information overload now. There's a lot of self-proclaimed experts that are turkeys in a strong wind, maybe have a good year, and they think they're ready to teach the world. So you have to be very careful of who you're listening to, because there's so much information and so many people to listen to. Obviously, I'm biased to my strategy. I think we've proven ourselves over 40 years of my own results, 15 years, these guys, U.S. investing championships, thousands of people around the world. I've got a very solid platform based on fundamentals. O'Neill, is his books are homogenous with mine. The Market Wizards books are always great to read for inspiration and to learn about how some of the greatest traders, particularly the first Market Wizard book is wonderful. You got Paul Tudor Jones in there. These are going back to my lineage. So there's tons of information, but you gotta guard from information overload. I think that if you read my books and O'Neill's books, you don't really have to go anywhere else. You might add a couple other books on psychology. You don't really need any more than that. Everything's right there. You're probably going to dilute and start to go outside, the strategy. And then there's other strategies that I can't recommend on, like if you wanted to have value and you're doing a strategy that was more of maybe a Warren Buffett strategy, a Benjamin Graham strategy. I know nothing about that, so I couldn't give any advice on that, but that's another way to do it, But my advice is to commit to one of the ways that makes sense to you and matches your goals and your risk tolerance. That's the main thing, is your risk tolerance. You could have one strategy that says you got to, you got to hold through a 50% decline. Well, you may not be okay with that. That was never okay with me. I tried it, and I felt like my stomach was bleeding. I was going to get an ulcer. I said, well, I'm not doing this to get sick. I'm on this to make money and to have success. I just couldn't go through the drawdown. So I came to this strategy because of the risk aversion. And I think Mark and Brandon are similar in that way, where the risk aversion was the attraction to this strategy. But there's lots of strategies. There's lots of resources out there. Of course, now let me just say two things real quick. Master Trader Program, of course, this is our 14th or 15th year, right? 2010, yeah, 15th year. Going to be online in November. It's 5 days of curriculum, well, actually 4 days of curriculum, 1 day of live trading, and then we do Q&A days during the week. I think 2 this year, so it's actually 7 days. But the thing I wanted to point out to everybody is we for our members, if you come to the Master Trader Program or you're an MPA member, we have a gala now. Once a year, you come and we all get together, all the clients from around the world, and we exchange ideas and we have special guests. It's just a wonderful, awesome day that we all get together and have fun together and learn. Well, this year coming up, my birthday, my 60th birthday, is in January. So we moved the gala to January 18th because on the 19th, I took the House of Blues, the entire House of Blues in Myrtle Beach. I've got a national band coming, which I'm going to be playing drums with the band. We're going to have, I don't know, 500-600 people, maybe even more. Clients are coming, friends, family. So if you're a client of mine, you're welcome to come to the bash. I want everybody at the birthday bash. I wanted to do this when I was 50 and I didn't. I regretted it. So now I'm going to do it when I'm 60 because God knows if I'm going to be here when I'm 70. So just wanted to give that invite also.
Yeah, fantastic. No, excellent. The last question I want to kind of close things out today, and first of all, I want to thank all of you, all three of you guys for being here. I think you guys have all shared a lot of golden nuggets, so thank you very much. My last question is this: what kind of final piece of advice would you give everybody watching this? What final piece of wisdom? And this could be trading or also life related, however you'd like to take the question. And Mark, Ritchie, I'll start with you, not to put you on the spot or anything. Oh, he may be frozen actually.
Is he?
Oh,
Yeah.
oh no.
Brandon, we'll go to you. Hopefully Mark's able to come back.
Yeah, sure. So for me, obviously, this Master Trader Program changed my life. Yeah, it seemed like a lot of money at the time, but man, has it paid many, 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 many multiples of that. So I can't, obviously, I get to work with Mark every day, so that, I might be a little biased, but if I wasn't working with Mark, I'd still be a client at MTP because Mark is such a great coach and I believe in that. But this idea of everybody overestimates what they can do in 2 years and underestimates what they can do in 10. Like that, to me, that's my life. And it takes a while for you to understand that and get that, but that's what I would say. Invest for a decade into learning this approach for us. Like Mark said, there's a bunch of different things out there, but you got to invest the time. You get in what you put out. And yes, I sacrificed by selling my car, but I also sacrificed many other things to get to where I am today. So there is a cost, and sometimes it's friends and leisure time, which I sacrificed. But it's been worth it. So.
Perfect.
I was engaged several times and once I was had a girlfriend for 14 years and was engaged for 5 years, and every one of them said you love your work more than me, which to a certain extent at the time was true. And so I sacrificed a lot too. I delayed having children. I delayed a lot of things to put my full time into trading, and really my whole life went into this. And even to this day, writing books, it's a lot. It's a lot to write a book. And my advice would be the mindset side is really important. I wrote the mindset book because that's really the most important part for a lot of people, because I mean, if you grow up wealthy, and you grow up in a family, you're privileged, you know what? You've got a big handicap. You feel entitled, and that's a handicap. And if you grow up poor, you grow up with a handicap. You feel unentitled, and you have a poverty mentality. Both sides create challenges, and mentally, that's what it comes down to. Because this is a very, very difficult profession. It's even difficult as a hobby, and so I think the mindset is the most important. And if definitely read my mindset book, because that book was written as much from the heart and as much research and as much personal experience that I could ever give. And I think that's the most important element that will get you to where you need to get.
Excellent. Thank you very much, Mark. And Mark Ritchie, I don't know if you heard the question. You tried to duck out
No,
the
I
last
got
minute.
booted.
Yeah.
I'm not sure what happened there, but yeah, I did hear the question. I'll just add, look, look, I think the market still provides a great opportunity, an opportunity for people to have, life-changing results. But yeah, you've got to find, for lack of a better word, a process, a strategy, and possibly even a coach to get you there. But yeah, I think, look, we're living proof of that. Mark's living proof of that, and the success stories will continue to be there. And it's a really rewarding business at the end of the day. And so, but you have to treat it like that. So that would be my piece of advice.
Perfect. Well, I just want to thank you guys one more time for being here. I really enjoyed this. Thank you guys all for the golden nuggets, and hopefully everybody watching this thoroughly enjoyed as well. Check out the resources, the Master Trader program I attended in 2021. Really enjoyed it. The workbook, which you guys didn't mention, is just by itself a fantastic resource. So many model book charts. If you want to improve your chart eye, that's the place to be. And I'm considering joining again this year, and the gala tidbit, Mark, may have just tipped the scales. So
you have to be.
That'd be very cool.
You have to be at the gala. So the whole
That'd be great to see you there. Yeah.
Everybody at Deep View needs to be there. You guys are invited, of course.
Awesome.
Absolutely.
Well,
you guys are on the close friend list. So
awesome.
Yeah. Oh, I appreciate it. I hope this has been helpful. That's, we want everybody to benefit and to have a great life. And so, we really hope this has been helpful.
Yeah, for sure. Well, thank you guys again to everybody watching. Thank everybody in the chat. Please check out the resources, and we'll be right back with the next presenter. Cheers.
Take care.
Thank you.
All right, welcome back, everybody. It's my honor to introduce our next speaker for the TraderLion conference. We have Lance Breitstein. Many of you guys are already familiar with him. He was able to present last year, which was fantastic. Highly recommend checking that video out as well. But Lance, for those of you who aren't familiar with him, is an ex-Trillium top trader. He has made over $10 million trading multiple years. He is also the founder of the Impact Competition Foundation, whose aim is to solve social issues while providing real-life experience to students in problem solving and entrepreneurship. And today, as you can see right here, Lance will be presenting today on the limits of backtesting. And Lance, it's great to have you back. Really looking forward to your perspective, which is a little bit different than some of our kind of swing traders as well. But of course, with all successful traders, there's key principles and takeaways that you can take from every style and time frame. So thank you so much for your time. And yeah, looking forward to this.
Thanks, Richard. It's great to be back. And last year's presentation was a huge success. And even to this day, the amount of times where I'm still getting positive feedback from that presentation, or where I'm citing that, where people are asking me about some of those trend following questions and how to define trends, so often I'm still referencing that. So hopefully this will be another banger. And for those that are curious, on Twitter, all of my achievements in P&L is either verified by Trillium or Kinfo. So I am 100% the real deal, because those questions always come up, and I think it's good for people to ask that. And today I will be presenting on the limitations of backtesting, one of my favorite subjects, because I think it kind of adds a lot of controversy, especially for a lot of people that rely on backtesting to find their edge and test their edge. And let's dive into it then. So
Let's do it.
first, for the audience that may or may not be aware, what is backtesting? Good old trusty Investopedia says, backtesting is the general method for seeing how well a strategy or model would have done after the fact. It tests essentially the viability of a trading strategy by discovering how it would play out using historical data. If backtesting works, traders and analysts may have the confidence to employ it going forward. So what does this really mean in just explain like I'm 5 years old terms? It says we're going to look backwards in our stock data and just test our basic assumptions. So you might wonder, do stocks go up on the first day of the month? Right? For a long time, there was the theory that, pension funds, 401ks, all that stuff, all those inflows tend to occur on the first day of the month. And that as a result, there is a little gap. Or I think a lot of traders might have heard the very famous Santa Claus rally, which is that in December, around Christmas time, going into the new year, everyone's feeling good, everyone's jolly, there's a lot of money flows going around. And as a result, the stock market tends to go up with it. And so backtesting is a means of testing a lot of these simple seasonal or cyclical or whatever things. A lot of just any pattern can be backtested. And as a fun fact that I think really surprises a lot of people is, for the most part, I barely backtest anything. If I were to look at my trading that I've done this year, and really here in 2024, the first half is over, and my God, has it been an active year between the moves in Bitcoin, between the moves driven by AI and the semiconductors, between the moves in GameStop and AMC with Roaring Kitty that we're definitely going to dive into. Not a single trade that I've done this year have I had any form of hard data on. Not a single trade that I've done has been backtested. So for a lot of traders out there, that is kind of a mind-blowing fact. Like, wait, how do you know it's going to have edge? How do you know it's going to work? And so first, I want to preface this whole presentation by saying backtesting is absolutely a useful tool. There is nothing wrong with backtesting. For many traders, especially on the higher timeframes, especially the more quantitative ones or the more programmatic ones, or even for beginner traders that are asking the questions, do I actually have edge? Which is a very important question to ask. Backtesting can really help you decide that. But the point I want to make with this presentation is that it is just one tool, and it favors more quantitative styles of trading and more simplistic scenarios that are testable versus other things. And my whole issue, though, is from my experience online and interacting with a lot of traders, backtesting is widely used, which again, great, but many don't recognize its limitations. And that's really what I want to, I guess, educate people on and make people think a little bit and kind of question some of their own actions and beliefs. So we're going to start off on a very morbid note using a little thought experiment. And that is, what would happen if Russia launches a nuclear weapon? Something nobody ever wants to think about or imagine. And thank God, this scenario has not yet occurred. But if you were to ask a traditional backtester, like what's the play here? What's the game plan? How are things going to respond? A backtester would immediately run into problems. First of all, it takes time to do a backtest. It requires some thinking. It requires some assumptions. It requires you to potentially find examples that, right? Thank God, very, very limited nuclear weapon use. It's not as if we're coming up with 30 data points, thank God. And so as a result, you would need to go to some lower tier comparables. How does the world act during wars and finding those comparables, those dates, yada, yada, yada. There's definitely some complications. And while that happens, I would argue that the discretionary trader is already making all the money or all the easiest money. Because while you try and do that analysis, markets are moving, and I can guarantee you VIX is exploding. Certain equity risk markets are going down. Safe havens are potentially going up. And my point being roughly made is that these are some of the things we need to think about when we do these back tests. So this probably doesn't cover all the limitations, but I really try to think about like what are the main ones that people should be aware of, but I see often aren't. And so the first one is the situation has no direct analogy. What do you do for something that has never happened before? Or number two, the market has changed and previous data is misleading and dangerous, or even just totally obsolete, which does happen. The third is the back test is making faulty assumptions, things that are just dead wrong and can get you in a lot of trouble. And four is the back test is overly simplistic and missing key nuances. And I think really number four is probably the issue I see most often being made. Like, I think people recognize that, okay, if there's no good analogies, you can't really use backtesting. If this hasn't happened historically, that's fine. But I think where people run into the most trouble is they do these backtests and they're just too simplistic and not touching on a lot of nuances that would otherwise help really determine the outcome of that backtest. And then what this really ends up as is, when do you even know that a backtest is missing something? Like, when do we ask these questions in our process? And that's something that's so important for people to think and have a real step or a process carved out for knowing, hey, I need to really do some deep reflection on this. So let's dive in. Number one, times when the situation has no direct analogy. So by definition, we can't backtest any opportunity that doesn't have relevant prior data points. And I would argue this very strongly, and I think is probably one of my strongest points on this, is the most opportunistic trading environments are when things are the most uncertain and backtests are the most useless, right? If we were to take COVID-19, I mean, what did we really have to go off of where the whole world is locked down? I think people made the analogy to the Spanish flu in I think like 1913, but like, I don't know, was there really that much great market data then? Were the same products really around back then? So even COVID immediately started to pose a problem. How long do lockdowns exist? What will the effect be on long-term travel? Will people stay working from home? Will people use Zoom forever? What are the implications going to be? Really, really hard to know. But at the same time, there was so much uncertainty and the price moves were so enormous and there was so much strain on the system that there were incredible, incredible opportunities. And that was when I think most traders made some of the best money in 2020 and 2021. And that was when there were also some of the least comparables. Another one being modern monetary theory. Interest rate policy by central banks actually isn't really that old. And up until 2008, we had pretty normal interest rates, and we ended up having very low interest rates for a very long time. And a lot of people said interest rates can never go negative, this or that. Sure enough, we end up with negative interest rates. We end up with near zero interest rates for over a decade. How do you really know what the implications are? For a long time, people said there would be inflation, but there wasn't. And sure enough, eventually it caught up with us where we currently got inflation, call it in 2022. But people didn't know, and there wasn't a comparison. And even with something like Bitcoin, can you necessarily say that there's been any comparable to a cryptocurrency? So when crypto has offered some of the greatest compounding opportunities and trading opportunities ever, how do you really know what to base some of these backtests are off of, depending on your time frame, on something that hasn't? I mean, how many products have we seen that start off at, I don't know, tens of hundredths of a penny, then become 60,000 plus in value? We've not seen something like that. At least I can't think of too many off the top of my head. So often traders that need these comparables are going to have some of their weakest tools kind of when the opportunities are biggest. And I think that's a big problem. If you don't have any other tools in your toolkit, that's going to be a problem for you. So let's dive into some of these. I would argue that in 2022, some of the biggest trends were kind of created from CPI, and it was the best theme for swing trading, for day trading. And what happened is, for the kind of 15 years prior, CPI was pretty much nearly a useless data point. There was not a single day trader in 2018 or 2017 or 15 running into the office for the 8:30 a.m. CPI number and saying, "Oh my God, like what's my game plan? What's going to move?" For the most part, it was just a non-event. There wasn't inflation. There wasn't any inflation in sight. And so all of a sudden in 2022, the narrative changed. All the stimulus started to change the market environment. And so I work with a very talented seven-figure trader. And at the end of the year, we were reviewing his year, which was not as good as he wanted. He had underperformed in 2022. And I said, "Hey man, like the big difference between you having an okay year and you having an awesome year is you missed one of the best themes. You didn't trade these CPI themes." And he said, "Well, yeah, Lance, like the problem is I didn't have any data points before. Like I didn't have a game plan. There was no way for me to do that analysis." And I said, "Well, yeah, that's what made it so good." The regime was changing, and a lot of people that are looking for data or looking for this, by the time you get that data, if you wait a year, CPI and inflation is now already kind of price adjusted. Market participants have changed. So instead of using alternate methods and is noggin a little bit to get involved and say, "Oh, wait, oh my God," like after the first data point where things come in hot and you see a big market move, that's when you start wanting to pay attention to the second or third and game plan it. And you can use different methods, which I'll get into at the end, but you can say, wait, if all of a sudden high inflation is bad for risk assets, because that means the Fed is going to hike rates, you can still develop a strategy. And so his reliance on data there, but not having relevant previous data, actually really hurt him and affected his year. There's also the example this year when Roaring Kitty is back. We all know the story here. I don't think I need to belabor that too much. But what do you do when you see a tweet like this, right? People wonder, like, why do day traders and traders still have jobs? Why has it not all been programmed out? Well, I think when you feed an AI program this tweet, AI says, "What? I do not understand, cannot compute. What is the relevance of a meme? And what is the relevance of, this Roaring Kitty tweeting," right? How many people had AI programs scraping this? Pretty much nothing, right? And I would argue there's no AI on earth that is going to be able to deduce, "Oh my God, Roaring Kitty is back, therefore must buy GameStop." And the only way it would have been able to do that if it was instructed to do so with explicit logic from a human. And I would argue, recognizing that meme mania might be back because of this, and oh my God, I might need to buy GameStop. This happened on a Sunday evening, but what happens if that happens midday? Do you have a back test you need to run? And even if you did, you can't figure out what the action is. When kind of day trader discretionary Lance is like, "Oh my God, if this happened during market hours, I'm just buying max buying power, GME and AMC and anything remotely memey, YOLOing in some calls," because it's asymmetric to do so even without the data. So there's also times when the market has changed and the data that does exist is obsolete. Essentially, backtesting limitations arise because markets evolve. Trading patterns and behavior can change due to factors like macro environment, market regulation, and investor sentiment. And often the biggest opportunities are caused by these past comparisons breaking and disconnects that are created in the market. So long-term capital management is kind of a more famous story from the late 90s. And it involved some of the smartest people in the world, Nobel Prize winners, economists, all sorts of mathematical geniuses that are far smarter than me and probably far smarter than all of us. And they had been outperforming the market using a lot of back tests and quantitative methods for pretty much a good couple years. They were just walloping the market. They looked invincible, and it was very lucrative. And $4 billion in AUM back then is pretty enormous. And so then what happens is there was a financial crisis, and in 1998, some of the correlations around the world started to go to one. And I think it's become more popular and more acknowledged over time, even in 2008, that when you get really, really bad economic events, like take COVID, right? COVID was a global event. so many correlations of the world. All of a sudden, the whole world economy was linked by this one virus. And when the whole world shut down, everything was hurt together. And so what happened to long-term capital management is they ended up blowing up. They essentially lost 100% of their assets because they were overly reliant on some of their backtesting data and not recognizing that, oh man, the patterns that we're making money in, sometimes these patterns break down. And when that does happen, oh my God, we are going to be absolutely screwed. And again, going back to my original point, when things break and companies with huge AUMs end up screwed, this is when you get some of the most lucrative dislocations. So if you're properly positioned and you have liquidity during times like this, whether it's 1998 or 2008 or during COVID in 2020, you can make magnitudes more than you ever imagined if you're properly positioned and not caught up overly relying on the data. Again, another morbid example. I don't know. Guess I was in a morbid mood making this, but the Trump assassination attempt we saw a couple weeks ago. So what backtest will tell you, what assets to buy and how they'll necessarily perform. So if you were to generally just think some of this out or rely on past data, an assassination attempt, of course, is generally not good for risk assets. Bitcoin is generally one of the kind of biggest risk assets these days. It's highly correlated with risk. And what ended up happening is, despite a very, very small initial dip, Bitcoin ended up exploding over the weekend and into Monday. So what happened? Essentially, despite this being an assassination, the more causative factor was that Trump has come off as very pro-crypto. People view that a win for Trump is going to be good for crypto prices. And so when he came away unscathed, that was actually extremely, extremely good for Bitcoin. It's not as if the NASDAQ did that much. The S&P, like the NASDAQ, IWM markets overall, like the broad indices, didn't do anything that meaningful. Bitcoin absolutely exploded. That's not going to be in a backtest. There's no way to figure that out really without prior data, which just doesn't exist so well. You can get a lot of conflicting signals. And so now probably one of my favorites, because I almost got absolutely tore up in this, which is pretty damn funny. Well, I guess not at the time, but very funny. Even at the time, it was funny, to be honest. And so this was during COVID. This is in, I believe, March of 2020. So gold and gold miners are generally a safe haven asset, right? In times of panic, people will push money into gold as a store of value. And so generally, gold does well. Gold miners are linked to gold. So COVID comes, GDXJ, which is small cap, not small cap, but the junior gold miners, they get absolutely walloped. These junior gold miners fall over 50%. And not just that, but GDXJ is an ETF. As we know, ETFs generally trade at their net asset value. This ETF, because there was such a massive liquidation and funds were blowing up, this got absolutely smoked. And this started to diverge, especially on those bottom days there. This hugely diverged from their net asset value by, I think it diverged by close to 10%. So imagine being some quantitative fund and you get a divergence from NAV when always this is pretty much perfectly linked. Why is it perfectly linked? Because you can just totally arbitrage it. Generally, you can short all the underlyings of the ETF and buy the ETF when in discrepancy occurs. Instead, this just absolutely blows out. Not only did it fall greater than 50%, but it was like 10% from its net asset value. And if you're overly reliant on the data, like, what's the play here? How do you handle risk and how do you handle these situations? It's very, very, very difficult and it's very, very dangerous. And so that brings up the point of faulty assumptions. Backtests are only as good as our inputs, and sometimes though we don't realize where our blind spots are, especially if we have a system where we're getting more aggressive as erroneous or faulty inputs tell us a stronger and stronger message. It gets more and more dangerous. So taking that GDXJ example, if you're like, oh my God, a discrepancy or a divergence from net asset value in an ETF especially one as liquid and global as GDX and GDXJ, if you think that's free money, well, guess what? It was free money at 3%, it was free money at 5%, and it was free money at 10%. And you need to be able to hold through all sorts of that stuff. So it can get really, really messy. Spreads often can blow up, and things that a backtest might say, like, for example, sometimes with mean reversion, hey, this bounces 80% of the time, and this is the expected value. But if that just keeps going and going and going, when do we need to wonder whether we're actually missing something and our backtest is not valid? So this is another example that came up with one of the traders I work with. What we see here is a recent chart of Apple back in June. And I believe it was on June 10th towards the close, it came out that Apple was going to collaborate with OpenAI for ChatGPT and some of their AI. And so essentially Apple went down on that headline because people were thinking, oh, Apple's kind of folding the AI race. They're not going to be a player. Like, this shows how no longer they're innovative or whatever else. And so meanwhile, Apple the next day absolutely explodes and makes a multi-standard deviation move higher. And so one of the traders I work with does a lot of good backtesting, and he's very, very smart, sharp guy, 7-figure trader. And Apple starts to explode higher. And not only that, but Apple had a huge level on the daily at $200. And so it breaks $200. And now we're really talking. I mean, I can't tell you the exact prices just off of this, but Apple went from what, roughly 192 to about 210. And then the next day we touched 220. So, that's over that's almost a 15% move in Apple in 2 days. That's almost unfathomable. And guess what? Depending on how you code that backtest and how you view markets, that isn't even on news. The news happened the 2 prior days. So you can get really, really, really twisted doing that analysis. Now, though, if you use other methods, it's very easy to say, oh, wait a second, like, that assumption's wrong. What happened was the market realized that this collaboration is going to actually be very, very good for Apple. And what we perceived initially as being bad for the company, now not only is it good, and you got to retrace all that and then some, but then when you break out, that's a huge tech breakout in a momentum market. And so all these factors are coming into play and leading Apple to make a really, really, really big move. And if you're on the wrong side of that, you are not going to have fun. And not only that, but you're missing one of the best breakouts of the year. How often, in most years, Apple, I would argue, probably shouldn't even be moving 10%. And so then to capture like a 10, 15% move in 2 days is pretty damn incredible. Then if you start throwing options into the mix, you can do amazing, amazing plays, which might otherwise be the total opposite of what your backtest tells you as far as standard deviations. And so then, even if we look at an intraday perspective, I would argue these nuances matter. This intraday, nowhere were we that extended. It was very, very steady. It was very, very strong. And when we're not analyzing that stuff and we're taking too simplistic of an approach, that's where you get in trouble. And the play gets better and better. If you liked Apple at a 7% move or an 8% move, what are you going to do when it moves 10, 12, 15% in 2 days? You get twisted and you put yourself in some real bad positions. The other thing, and many a trader blew up on this, was back in February of 2018. And this, I think, was one of the most important points of sometimes we just don't know what we don't know. And the volpocalypse occurred where volatility, the VIX, was just really chronically low. The market was very, very boring for a long, long time. Trading was pretty boring for the most part. And then all of a sudden there started to be real risks, and all the hedge funds and all the firms that had been just rolling over short vol, all of a sudden it was everybody going for the exit. What happened was VIX started to explode. UVIXY and SVIXY are inverse vol ETFs, and those started to explode. And what then happened, though, after hours, was during the day, they were totally linked, doing their appropriate, I think these were like 2x inverse vol. But then after hours, these just started to absolutely implode. And if you go off any of the data or any of the correlations or any of the rules, like, this shouldn't be diverging from the VIX. what was happening was that somewhere in this 250-page prospectus is a liquidation clause. And, you know, we're now talking 6 years ago. I can't remember the exact terms, but it was something to the effect of if the VIX rises X% and if net asset value falls below a certain amount, these ETFs are essentially just donezo. They're wrecked. And people knew about that clause. I think probably virtually every retail trader and every day trader probably was not, at least 99% was not well versed. And so if you're thinking this volatility, vol is going to mean revert, vol always tends to mean revert, right? If you were playing it and playing that divergence, you don't know what you don't know, which is, oh my God, there is a clause in this prospectus that will just absolutely blow me up and I can lose 90% of 95% or something of the holding of the net asset value. So that's why some of this is important for the blind spots, but then some are just overly simplistic. And again, this was from the beginning, what I said is some of the most troublesome part. And I think where people get, in practical terms, the most trouble. And so discretionary traders are able to subjectively assess dozens of variables with lightning speed. The daily chart, the intraday, what comparable stocks we're doing, the context of the market, what the level 2 box looks like. So many retail traders, though, I've come to learn, overlook the variable of breaking news. I've learned that most retail traders don't even have real-time news sources to know whether news was ever out or not, which is mind-blowing to me. Because to me and my trading, one of the most important variables is a binary one. Was there fresh material news? If we look at some of the best momentum swing traders, people like Kwalamagi and some of those episodic pivots and everything, the number one criteria for that is a news catalyst. If we don't know whether something has a breaking news catalyst, like that Apple move, right? Say we're blind to the fact that on that prior day, there was news on Apple. You can't really readily explain why is Apple going up 15% in 2 days. And if we're not super honed into this variable, like all of your back tests to some degree are going to be nearly garbage. Because in general, with news tends to lead to trends. News tends to lead to a fundamental repricing of different assets. And news tends to invalidate a lot of mean reversion, or at least make mean reversion very, very hard. So if you have a test, if you have a strategy you're testing and you're not aware of that variable, or if you're not properly tagging some of this data and you're trying to mean revert stocks that are including news, your data is going to be, you might have an amazing strategy, but because you're missing that one nuance and you're blind to it, you might say, oh my God, this strategy is no edge, when that one tweak might be the difference between you passing on an amazing strategy and you making tons of money. And I think even for a lot of traders out there, if you catch these variables, it can have huge, huge effects on your trading. And even knowing stuff like market context, are low floats running, are short squeezes occurring, are breakouts working? Take semiconductors this year. This has been the market for semiconductor breakouts. This doesn't last forever, though. The more breakouts that work, people start to adapt and the markets change and everything else. But if we were to look at semiconductor breakouts in 2015, 16, 17, some of the moves that we've seen in SMCI, Avago, well, Broadcom now, I still mess that up, NVIDIA, ARM Holdings, unfathomable, right? When have we ever seen multi-billion or 100 billion or even trillion-dollar companies make 30, 40% moves in beautiful trends in a couple of days and everything? There's never been a market where that has happened. And these have been some of the best trends out there. So it's so important to judge these variables. And one story that I love to tell is that of IPOs and the classic trainee mistake that I saw. And you know, I've trained a lot of people at this point. And when I was running an office in Chicago, I was probably training, I don't know, five new guys a year. And one of them would trade every single IPO there was. And I would say, hey, man, what are you doing? Why are you trading all these IPOs? Like nobody else is trading these shitty ones. And his response was, oh, I make money in IPOs. I've crunched the data. And I'm like, what? Like, dude, there's no way you make money in these things. And I'm like, dude, send me the data. Let's go over this. And he sends me the data. And let's say he traded 20 IPOs. He was 100% right. He did make money in IPOs. Let's say, again, I don't remember these numbers at this point, but let's say he made 20 grand across, 20 IPOs. So in his head, every IPO he traded, he makes roughly $1,000 on average. And that for him was his justification. And I think we all make these mistakes, right? We have ego, we have cognitive dissonance. So that's what made him realize, like, I'm good at IPOs. This is one of my best plays and best playbooks. That's why I trade these IPOs. But there was one little thread that he wasn't pulling on. He wasn't looking at the data close enough. If you looked at the data, you would find out that in 4 IPOs, he actually made 60 grand. In the other 16 IPOs, he lost 40 grand. And so the question is, what makes those 4 IPOs that he did so well in so good versus the other ones? Is there a variable? If there's not, maybe there isn't, and no big deal. You do need to trade every single one. But when we looked and did that dive deeper, what we found out is he was making essentially 300% of his P&L in the hot IPOs, like an ARM Holdings or Reddit or any of those. Then he was proceeding to give back 200% of that P&L in the shitty IPOs that nobody else was trading, thinking, oh my God, I have edge in IPOs. And so a lot of times with our back tests, when we don't have the right nuances, we miss stuff like that. So it's so important for us to figure out what are the threads that identify our best trades. What are the threads that identify our worst trades? And you're not going to get that just from backtests or crunching the data. At some point, you need to really use your head and do a lot of the analysis yourself. And like the example I give is kind of the silly one. Let's say my electricity bill is the same amount in summer and in winter. If you just look at the dollar value of my bills, you can't really predict anything about my electricity usage. But anybody with common sense can take that bill and you can say a couple things with very high confidence. You can bet that in summer, that electricity bill is going towards AC. I'm not going to be using the heat probably at all in the summer. But then in winter, I'm going to be using probably all of that bill towards the heat and none towards air conditioning. And by pulling on that thread, you're able to get so much more using logic, common sense, causal mechanisms to figure out like what's behind this bill, what's behind this data. And then even as like another thing where we can go a step further, if we use our head even more, it's near certain summer is AC, winter is heat. So something that's likely but not as certain, and it would surprise people if you don't like think about these things because it's not intuitive, but during both the summer and the winter months, I use less electricity at night than during the day. Why is that? During the summer, when I'm using air conditioning, at night, the sun is set. I don't need as much air conditioning. That being said, in the winter, the sun doesn't matter as much, but in the winter, most people want to sleep at a cool temperature, so I need less heat. So you can pull on these different threads and come to conclusions in different ways that you're otherwise just not getting from the data. And these, like I said, with the IPO example, have very, very real implications for you. And probably the example that most inspired me to rant on this topic and piss off a lot of people was this happened November 29th of 2023, last year. And this is VVOS. This is a small cap biotech. And what happened was intraday, the stock made a little move towards $20, not even a little move. It went from 10 to 20 and we consolidate all day. The stock then absolutely explodes when we break above 20 and people blew up. People lost their shirts. A lot of people got absolutely wrecked. And I felt that this was a pretty kind of textbook long setup. And that infuriated people because so many people had got run over. And I would argue like, look, should you be mad at me for pointing that out? Or should we be learning and be mad at our system and just adapt and get better? And a lot of people get lulled into this false sense of security because in general, guess what? Microcap stocks and a lot of these low floats do tend to retrace. it's without a doubt, right? Most of retail Twitter, I think, does a lot of the small cap mean reversion because it does tend to work. But then you get some outliers. So how can you kind of prevent some of this stuff, or how can you be more aware? And so a lot of people were like, dude, no way that's a good long. I've run the data. These tend to go down. These tend to not hold, yada, yada, yada. And what it really came down to was that in all these back tests and all these traders that were short this and all these traders that were just like not even just short, but averaging short and having no stop, they were trusting their system. These tend to retrace. This is really good because it's up over 100%. We're doing a lot of volume and turnover. But they were overlooking some variables. For starters, it was day one breaking news. The same way that I discussed before that breaking news is one of the most important variables in trading, and most people tend to overlook it. A lot of those traders did. This ticker also had a history of squeezing. This ticker was also doing, I don't know if it was all-time high or not off my head, but it was pretty damn incredible, insane volume. This also had an amazing intraday consolidation. For hours, we were consolidating flat despite being up over 100%. The other big thing that's particularly hard to code and adapt to is there were so many biotechs that had microcap biotechs that had been mega squeezing. And I had this tweet around that time. It was VTGN, SLNO, RNAZ, TPST in just the last couple months. That tells you that the market environment has changed. The context is different. So when so many traders out there do their historical analysis and their system says, hey, most of these do retrace, this is not the same back test saying, oh my God, microcap up X%. Sure, it's eventually going to retrace. But that's like, it's too simplistic and you're getting the wrong conclusion. So then I had some of the quantitative traders that I work with run the back test with the variables, the appropriate ones, the more nuanced variables. What did they find? They found that this setup actually had massive edge long, and it was a setup that they ended up taking and developed into their playbook as a result. And any time that you're on the wrong side of that, you need to adapt and listen to the market, because generally, right, whether you think so or not, if you're blowing up or if you're taking some losses, there's generally almost always signal to those big losses. Not always, but nearly always there's something to learn from them. And so what now? What does it really mean for the people listening to this? What I want to emphasize is this doesn't mean don't use backtests. Generally, appropriate data and being aware of the limitations, is better. And like, it just helps you identify the environments when trusting a back test is most dangerous and what things you might be overlooking. So you want to set rules on just when to adapt or when to override. And you want to make sure, like, does your system have safeguards for shutting down or adapting strategies for when prior data might no longer be pertinent? Or do you have alternative methods to also help make better trading decisions? What are some of these alternatives? Like, okay, Lance, like you're saying backtesting isn't always so good. What can I do instead? For starters, forward testing. Forward testing is, rather than working backwards with data, you work forwards. So, for example, with the CPI in 2022, nobody had good data. And even though I'm trading on some of these other methods that I'm going to discuss, you easily could have started to collect data points. Okay, we've seen 1 or 2 or 3 hot CPIs now. How did the market react? What instruments are going where? What instruments have the most lag? What instruments offer the most liquidity? What is my game plan based on the couple examples I'm going to see going forward? Another way is understanding, having a framework for understanding price action. I have, and this is pretty much what I rely on most for the record, is having a framework for price action and having a framework of technical analysis. I hugely rely on what the chart is telling me. I have a system for understanding what charts tend to make moves and everything else. And so when I look at that BVOS, I view that as a beautiful intraday setup. It's got a resistance level. We've got hours of consolidation. We're doing huge volume. We've got a breakout on massive volume. I've got a framework for viewing all those different variables as bullish and all of them aligning. And a lot of variables are coming together to make that specific long setup very appealing to me. Another alternative is you might have an understanding of the causative mechanism. Why is something happening? So going back to CPI, for example, even if you've not seen a single data point, there's a lot of people that understand if we get high inflation is going to be, of course, a worry for the Fed. The Fed needs to counteract that by raising rates. Generally, raising rates is going to be bad for stuff like tech, stuff that doesn't have much cash flow and it's dependent on future cash flows. There's a lot of stuff that's very rate sensitive. And so you can understand the mechanism of what might happen. And so there were a lot of people that were game planning for what happens if we get inflation. And then you can run that playbook without collecting the data. That doesn't mean you'll always be right, but it's just another alternative. And you really often want to use a mix of methods, and especially the right method for you. So backtesting, for example, it tends to favor those that are strong with statistics and programming, those who are more methodical, slower, deeper thinkers, those who might wish to pursue more programmatic strategies. As we know, if you're a discretionary trader, that's the opposite of being programmed, and a lot of programs kind of rely on backtesting. There's stuff like Jane Street Capital and Jump Trading. All of those type firms, they do a lot of the backtesting. Forward testing, jokingly, is for those with less patience, but it's more so for the tinkerers and the people who tend to be the hands-on experimenters and are willing to have less certainty, but be able to act faster, and with less, in more situations where you might not have data. Then for the framework for understanding price action, these are for more of like the systems thinkers, the people that want to make the quick decisions, act first and test assumptions later, and the more discretionary traders, the Druckenmillers of the world. So I would say, again, I'm mostly under this category, and I recognize that that allows me to act in a lot of situations where other people might not be able to act as quick, right? If you were to take earlier this year, this ticker Golf Lima, which had this fraud report, I had some data, like I had some back tests that I had done for fraud reports that are down, stocks that are down a ton on fraud reports. But I then also understood the price action. I understood the volume capitulation we were getting. I understood the price capitulation we were getting. I understood that this was making multiple legs. So in that specific trade, I had a mix of data backed up behind me. And then I had the chart patterns and I was able to combine the two, which ended up being very, very powerful. Then finally, the causative mechanism, why is something happening? These are kind of the analyzers, the portfolio managers type personalities, the Ray Dalios of the world. And so all these methods on their own can be incredibly effective or incredibly ineffective. But when you start to combine these two or 3 or 4 methods, whatever you're most strong at, that's when you can be really, really powerful. You can have some of the things where you can be as adaptive as a day trader, but then you can be as data informed as a programmatic trader. You can know that, like, okay, recently we saw IWM spike the last couple of weeks. There was a mechanism there where all of a sudden, CPI is starting to change. There's a big sector rotation, but you can also figure out, like, what does the data say? What happens generally when IWM is up this amount in a matter of days? Then you can also just trade the price action. Are we capitulatory? Is this a pattern? Is this something you want to be long? Maybe it's a momentum pattern where, look, CPI was a news catalyst. IWM made a multi-standard deviation move higher, while the stuff like the Qs and the NASDAQ were lower. That signals rotation. We've got a news catalyst. We've got huge volume. We're closing strong. Do you take that as a momentum trade? A lot of these methods can help inform that decision and make it way more effective. So my question for you is, what best fits your trading? Are you taking advantage of your unique strengths and skill sets? Have you thought about the limitations of your strategies and in what environments you might want to push risk versus pull risk back? And what blind spots might you have in your trading? And so that is my presentation with the usual disclaimers. So yeah, Richard, let's talk about it. What'd you think, and what can I answer questions on?
Well, first of all, Lance, I think that was great. And when you're going through kind of the key things that you think about when you think about the limits of backtesting, one more that I was actually kind of thinking about, and I've kind of run into my own, I've done some kind of basic Python backtests of different strategies and indicators and that type of thing, is survivorship bias and hindsight bias. So I just want to hear kind of your thoughts on that. But first, kind of my experience and kind of explaining how that impacts things is, I'm more of a longer term trader, especially compared to you, more of a swing to position trader, holding a few weeks to capture kind of those momentum moves from breakouts typically. And if you go back and test that basic strategy, say it's a break above the 21 period moving average on the daily, a very simple sell signal, two closes below that same moving average later on. But if you test it on NVIDIA, it's going to work and have amazing results because NVIDIA has done amazingly over the past few years. So something to kind of combat this that I've done is you test over a wide variety of stocks, just trying to see, overall, is there an edge there? Overall, do the metrics make sense in terms of win rate, average gain, average loss? But you also have to be careful there because if you test on the NASDAQ 100 now, it wasn't the same, 3 years
Yep.
ago that it is now. So there's still some survivorship bias. So that's one more thing that, I kind of think of when I'm taking into account the limits of backtesting. I don't know if you had any kind of additional thoughts to add, or that's
Yeah, I
something
mean,
you think as
those
well.
are just both great examples, and I think all that falls under some of like the faulty assumptions we might make. And so often, as I think it was Richard Feynman says, like we're the greatest fool ourselves. We're the easiest person. The easiest person to fool is ourselves. And especially in trading world, there's a lot of just like cognitive dissonance that goes on, and especially like selective memory. Because here's the thing. How often do you just remember all your winners? And like the amount of times where I've seen traders think that they're profitable in some strategy, but what happens is they have a couple big winners that stick in their memory, and then they forget about all the small scrapes. And that's not being like malicious, or that's not being ignorant. It's
Right.
just a total, like, we are susceptible to human biases. We are susceptible to cherry picking our data, not just us as traders, but even like scientists. There's so much scientific research where it's like, oh shit, like we actually didn't properly control for some of these biases, and now everything that we thought was true is wrong. And so it's definitely something you need to be extremely cognitive of, and especially the survivorship bias, right? It's like when you look at some of the performance of some of the best stocks in the S&P 500, it can be really stunning if you look at an Apple or an Nvidia. But then guess what? How many stocks were then removed from the S&P as they started to suck, then eventually went to zero? And if you think about it, like, what percentage of the S&P 500 from 30 years ago are probably now totally bankrupt? It's probably some crazy percentage. And so all these things are really, really important. And I think that's where it's like, you need to be so intellectually honest with your data to make sure you're not just using hindsight or everything else. Because think about even with some of those examples with say like the VVOS breakout, you need to make sure where it's like, hey, I can think of 5 really big winners, but you need to also wonder, like, man, how many of those might be losers, but I just never took note of them because of the fact that they weren't standout? Will that mess up my data? So it's a huge consideration without a doubt about it, and it makes some of that backtesting very tricky. And not even just backtesting, it makes all of our analysis tricky because we are susceptible to just having false data sets and false biases in our head.
Yeah, kind of along those lines, one of my kind of least favorite tweets to see on Twitter is if you invested $10,000 in Tesla 5 years ago, here's what you would have now. Because it forgets everything that happened along the way. It forgets all the other stocks that looked amazing, like Tesla.
What could have, all that could have been Teslas. You want to know a
Right.
funny one too, that just speaks, like, I think also as just humans, it's very, very hard for us to keep track of a lot of data. And there's just so many times where it's like, if you ask the average trader, hey, how much are you up in X strategy this year? Once you're talking like 70, 80, 100 plus data points, I don't know how close you can even remotely be. And so one thing that we always giggle over is, and this is kind of pre-COVID and everything else when the market changed, but it was maybe back in like 2016 or 17. The one of like the head trader of Trillium, like essentially like the risk manager or whatever, he sent out some email that was like, public service announcement, dear everyone, despite what you think, like, you all do not make money trading SPY. And like, people would trade SPY all the time, whether it's like Fed stuff or this or that. And like, not to say that there wouldn't ever be winners, of course there'd be winners, but most people's like the proportion of how often people would trade SPY versus the P&L was like laughable. And he's like, dear everyone, like the firm is like net negative in SPY over a very long time frame. Like if you keep on trading this, like I don't think you guys are actually making money. And so I remember one of the guys in the office was like, what? Dude, there's no way that's true. I'm great at trading the SPY. And then so we have the tools to crunch that data, you know, pretty quick. And he looks it up, and then all of a sudden he's just real quiet, and we're like, hey man, like what does the data say? Why are you so quiet? And he's like, yeah, not as good as I thought. And I think like there's no malintention there, right? It's just that it's very hard to grasp some of this stuff and keep these mental tallies and everything else.
We're human. Yeah.
Yeah, we're
tough.
very human and very fallible, which is amazing that like we can have as much edge as sometimes we do.
Yeah. And you know, a lot of people when they think about backtesting, you know, they first learn about trading, they learn about backtesting, and they're like, all right, this is how I'm going to find my edge. I'm going to find the perfect moving average to use, the perfect whatever. But again, because there's no perfection and there's so many nuances, as you mentioned, what can people do instead of going down that road? Where can they learn to develop edges? And what process should they take to kind of improve those if backtesting isn't the only answer, it's not the only way?
Yeah.
What's a better system, I guess?
Yeah, and so first to even run with your point, like, because I think there's some other cool examples regarding this, which is most academics that have studied technical analysis, I don't know, pretty much every study they do ends up being, hey, technical analysis has no edge. Well, guess what? There's got to be some edge because, right, I've done billions and billions of shares. You can't ascribe that to luck. Like it's, you know, as an active day trader, I've done on the average year thousands and thousands and thousands of trades over almost 15 years now. And when you get that level of skew in the data and it's replicable, like the same Buffett arguments, right? I've been able to teach people to do the same things. I've run an office where everyone else was doing the same things, yada, yada, yada. And when you look at some of the analyses that they're doing in academia, you're like, oh my God, of course there's no edge. Like if it was that easy, like again, to my point about backtesting, they're trying to find edge in something that's just way too simplistic. Oh, wait, if the average stock crosses above a moving average, dude, if it was that easy, like again, that would already be arbed out, and it is. That's why there's no edge. It's the same as saying like, oh, Warren Buffett, fundamental analysis, you just buy cheap PE companies. It's like, no, that's not really how it works. What makes Warren Buffett so good is a million nuances of analysis that you're not doing in a just low PE screener, right? And so the very important question is, so then, okay, if you're a newbie and this backtesting isn't going to, you know, be nuanced enough, like where do you start?
Right.
And my answer is going to pretty much always be reverse engineering. What does that really mean? It means take the really crazy moves and just start to document and write them up. Okay, what were the big moves this year? Off my head, there's stuff like GameStop, there's stuff like ARM, there's stuff like NVIDIA, Avago, the semis. We've seen some decent crypto moves. Like whatever you think were the really good things, and just upload or just run a screener. What's doing the most volume? What's up the most percent? What's up the most on the month? And start to check that out. And even look at IWM, right? What made IWM move like that? Why is an index up 4%? Why on some of these days is an index of a bunch of stocks moving 2% in 30 minutes? And reverse engineering, once you start to get enough data points and you build up these databases, you can come to a couple conclusions. Okay, like IWM, that move looks like it kicked off on a news catalyst, CPI. Huh, is that coincidental? Maybe, maybe not. I need more data. Okay, VVOS, the day it went from, I mean, the prior day was at 5, we opened 10, then we go to 45. Let's look at that. Okay, that had news that day. Okay, maybe it's coincidental, maybe it's not. And I think if you look at some of these big movers, and if you're a swing trader, if you're a trend follower, if you're looking for some of these bigger picture moves, I think you will find that a lot of them do come from news catalysts. So then that's one factor that you can start to think is important. I think another factor is very, very high volume, signifying, hey, something's changed, right? IWM, or an Apple breakout or any of these tech breakouts. And I think if you start to work on some of these criteria independently, you get a lot of stuff that can kind of look like some of those episodic pivots, like the Qualmagi stuff, or it can look like something just new and special to you too. You can study different nuances, like what is potentially sentiment? Can we find data points where it's like, oh my God, sentiment was, really, really shitty. Now something happened where all of a sudden there's a big change. What happens to stocks that are breaking all-time highs? What happens to stocks that are breaking all-time highs on really high volume?
Right.
What happens to stocks breaking all-time highs on high volume with the news catalyst? And you can start to build these databases, and you can start to pull those threads and figure out, like, wait a second, hey, that electricity bill is exactly the same, but I'm able to reverse engineer that in the summer, it's being used for AC, and in the winter, it's being used on heat. And if there's a way for me to make that bet, there's probably an edge there. And so it's
Right.
figuring out like stuff like that. What happens to stuff with high short interest? And so really going through and building those data points and thinking critically, and then pulling those threads, then back testing. That's a way that can also help.
Yeah, I love that. And one thing you said along those lines earlier on, like looking into what creates trends, you said news leads to trends, and I think that's a great golden nugget there that I took away. And you I think a couple weeks ago shared kind of a template that you use kind of when you're looking back on these opportunities for July or whatever. We'll try to put it up there if we can, but just kind of talking through it. You talk about keeping the date, the ticker, the P&L if you traded it, the category of the trade, the context, was there news, no news, add in a daily chart, an intraday chart, level 2 box, how I traded it, how others trade it, how should I have traded it. All these are kind of questions that you can use to pull those threads and identify, what was special about it, what were the characteristics that led to this move that I can then apply that template later
Yep.
on. How can I find, yeah, go ahead, please.
Most traders, I would say, and I think this is like a good analogy. So if you read the Tiger Woods book by his swing coach, one thing that stands out about Tiger is never ever would he hit a golf ball without being very deliberate. What am I trying to work on? Where am I trying to place this ball? If that happened, why or why not? What could I have done better? Extremely deliberate. And I think we can agree, like, are you better off hitting 100 golf balls and doing nearly no analysis, or are you better off hitting 50 of them and being very deliberate about it? And I think the analogy here is, as a trader and as a new developing trader, there's probably a lot of traders that are probably trading too much and doing too little analysis and too light on the nuances of the analysis. And so I think if you're going to do a trade, especially as a developing trader, it's so important that you're very intentional and you learn and you try to pull on those threads and suss out those details. And if you're doing a trade, you really want to go back and figure out, like, okay, why did I trade this? What was the setup? What were the variables that made this good? How should I have traded it? Like, what should my executions have been? And like, what should the edge and everything else have been? And then collecting some of that data kind of going forward and everything else, or backwards. And I think that deliberateness, that's where the real growth happens. It's not comfortable though, right? Like it's so much more fun to trade and like get the dopamine hit and everything, and win, lose, and you feel like a trader. It's the way harder work once the markets close, where you need to then sit there and review and figure out, did this make sense? Is this something that I was supposed to be trading? Why do I think this ticker has opportunity at all? And even so many people, because you brought up the level 2, which I have in my analysis, there's so many people out there that say the level 2 has no edge. It's all algorithms. It's all useless. And I would argue, like, again, it's almost like the same argument with technical analysis. Like, sure, I mean, yeah, look, the level 2 in SPY, I would agree, is probably nearly useless for the most part. But that doesn't mean all level 2 is always useless. And can you find those opportunities where something's really, really different? If you're a mean reversion swing trader, can you find on this most recent GameStop pop, can you, when Roaring Kitty was doing the live stream, can you identify that after hours into 8 p.m., it was just one ARCA buyer driving that stock up? Then the next morning, that ARCA buyer was just totally cannon fodder. And once the ARCA buyer was done, it was game over for that stock. then there was the offering and everything. But can you identify turns like that? Or on a breakout, if you're going with the trend, can you identify like just how big the buyers are? How aggressive is the paying? Is anybody hitting the bid? Is anybody selling? How like just those things can really matter in a breakout. Like if you were to watch the breakouts of SMCI, Apple, Nvidia this year, a lot of these, when it breaks that level, it's just absolutely gone. Like if you're trying to get hit on the bid, or you're trying to fight over pennies, those breakouts are gone. Do you not think that matters? Do you not think that the best breakouts this year have not looked back? Then we talk about selection bias, right? Because it's almost by definition, some of the best moves don't look back. So if you're the trader that is trying to always get in on the pullback, are you perhaps leaving yourself more susceptible to the ones that are about to fail?
Right.
And then lopping off your asymmetry on the ones that are going to work the best. And so I see a lot of traders that won't buy that initial break. They want confirmation. They want it to go, then pull back. But then I think if they were to look at their data and pay attention to that nuance, they would realize, oh my God, the best setups, the Apples, the Avigos, the SMCIs, the Nvidias, those break that level and they're gone. Why are they gone? Again, what's the causative mechanism? It's because everybody recognizes, holy shit, this is an amazing setup and I need as much stock as I can get. And they don't pull back because no one wants to sell at $200.50 an Apple. Nobody wants to sell 201 in Apple or wherever. And so you're not getting the pullback because everyone says, wow, that setup there, that was a spot. And so those nuances in these write-ups, it really, really matters. It really matters in your analysis. It really, like that price action is a tell. And if you're never taking the pause to analyze and observe that, whether you're a swing trader, day trader, whether you're a trend follower, mean reversion, that stuff matters. What happens when you get a capitulation and boom, it's just done? Like that thing is just dead as a doorknob. It can't bounce. That is a way different thing than, hey, we capitulated and now we're curling back up and we're consolidating up there. That's way different. That stuff matters.
And when you're doing these write-ups and looking back on either stocks you traded or stocks you didn't trade, how can you kind of try to be as intellectually honest as possible? Because again, we've talked about how we can fool ourselves. This is the obvious buy point, but in the moment it might not be obvious because things are different in real time. So are there any kind of tactics you use or procedures that you use to try to get the most out of each write-up and try to be as objective and honest as possible with yourself and your own abilities, your own way of trading?
It's going to sound really corny, but the more you tie your identity to performance, the more you're going to struggle. Like if you're afraid of making mistakes, then you're not going to have a fun time and you're going to do yourself a dishonest disservice. Mm-hmm. And the more you view that you're like every day, my goal was to get 1% better. My goal was not to make money, right? Obviously, that's the end goal, but that I knew that's not the process of how I was going to get there. And so if my goal is just simply to get better, and if my mindset is how can I get better today, I'm mentally open to those mistakes and I'm actively trying to find those mistakes. What am I overlooking? What could I have done better? If you're just not focusing on that and you're not emotionally open to that discomfort and you don't view that as how you grow, like that's a huge difference in mindset. And the person that has more of that mentality, that's when you start to justify things and say, oh, this didn't work out so poorly because I'm unlucky, or the market's just been choppy lately, or this or that. You're less likely to take accountability versus saying like, look, every day I'm just trying to find what I can do better. I'm accountable every day. And growth is just improving. And I think that mindset of saying like, I want to find these mistakes. Every time I took a big loss, like I retrained myself to think good. This was a big loss, but I found that vulnerability. And I fixed it. And I would just think like, oh, that's a patch for my armor. There is a hole right here. And, right. A hole here almost got me in the heart. It was almost fatal. It was here. Now I know I need to reinforce this. And when XYZ happens, I need to be way more like, so you're better. You're actually a more resilient, robust trader because of that. And like I trained it's uncomfortable, right? Like you just took a huge loss. But having that mindset makes you just way more, I guess, open and adaptive to these things over time.
I like that analogy of patching your suits of armor. That's a good one. That's a
Yeah.
great way to put it. And this next question, it's more about going to a trading question versus kind of a little bit what we've talked about with backtesting. But you mentioned, the key themes this year and how important it is to key in on them. Whether that's AI, semis, small caps recently, the social media stocks. What are you kind of doing in the moment to identify those as they're very quickly developing and just becoming an important theme because they go from CPI, as you mentioned, went from a nothing burger where it didn't really matter to now, all right, the whole market's moving up or down, whatever, on this event. How do you start to notice what news catalysts matter, what themes are developing in the market? I assume, we can make a whole presentation on this topic because it's so important, but what
Yeah.
are kind of your high level thoughts there?
Yep, and I think that's where your process matters. And again, I think anytime I start talking about less explicit, tangible things, like people start to think like, oh, like, Lance is BSing or Lance is hiding stuff, rather than thinking like, oh my God, like process and how you think actually does matter. And so from a process perspective, I was doing a daily report card. So every single day, without fail, I kept this up for years without fail. I mean, unless like, look, sickness, sometimes you're on vacation, whatever. But if I traded that day, I was writing this thing up. And during that daily report card, you can reflect. Like one of my lines is, what was the best opportunity? Or what did I observe? I also generally would do a weekly review. Each Sunday I'd go in and just study the opportunities from the week, and then I do a monthly review. So I created these layers in my process to help spot these things as proactively as possible. So I think on that CPI day, when you take a step back at the end of the day, you say, what the hell? Like IWM is up 4%. The NASDAQ is down. I don't remember. I'm kind of making this stuff up. NASDAQ is down 1 or 2. Like if you catch that in your daily review, that's like, you're like, wow, that's something to pay attention to. In your daily review, when those microcap biotechs started to go crazy, like even after one data point that does something exceptional, you need to say like, whoa, what happened here? And like something might be different. Once you get 2 of them, that's now 2 data points. And you really want to start connecting threads. And like, as long as you're really being receptive to whatever's like, and it's like the Gretzky line, like you need to skate to where the puck is going. And it's like, you don't necessarily need to be there for like that NVIDIA earnings call. I think it was I don't know, was it late 22, I think maybe, where essentially it was like the earnings where they guided up and everyone was like, holy shit, AI is real. And then it was the Qs, to the moon. Like, I'm not saying you need to catch that first one, and often you won't, but you need to say like, whoa, like this AI is kind of the theme driving the market. And maybe you missed the second semiconductor. Like I think it was Avago, Broadcom or whatever that then made the next move. Yep. And that's when you need to start to say like, wow, like on the third one, I need to really pay attention. So like as a general rule, I excuse myself of not having, you can't be everywhere. You can't catch everything. So you don't need to catch the first one. After the second one, you want to really be on top and say, hey, this might be a pattern. Ideally by the third one, I want to be trading it. That doesn't mean huge size. That means like even in the forward testing bucket, I might want 100 shares, 1,000 shares, 1 share. I at least want to be involved and see like, am I developing a replicable system to capture this? And then I would say like, usually the sweet spot is like, and ideally I'm even doing that on the first and second. So I have my system in place for the third, because like the sweet spot really is like probably the second to the fifth. And once we're talking about the 6th, 7th biotech that does this, or the 6th, 7th semiconductor, that's when everybody's kind of on top of the trend, and it's almost like too late now. And if you're waiting for 10 data points, like I would argue, and I'll go out on a little bit of a limb. I would argue we've seen the top in the semis, and I've been pretty public on that view. And if not the top, at least probably peak euphoria with some of the gaps. And look, maybe I'll eat my shirt on this one, but like what happened is once it's now been a year of some of these real blowouts. And I'd say like that arm that arm move was pretty damn crazy, where literally every semi that broke out, it was just boom, 20% or something. Like that's a level of euphoria where then expectations adjust so much higher and everyone's so on top of that. And then you start to get like earnings reports where it's like when expectations are up here, like for you to get a 20% gap or something, it needs to be like stratospheric. So I do think we probably reached peak sentiment. And like if now you're hopping on that trend and you're running these back tests and you think, oh my God, the average breakout's going to return 20%, I would argue just from experience in the context, those are going to compress and maybe even go negative. And so it's just being very, very adaptive through your process to recognize these and say like, okay, like, one is just one data point. Two starts to be, I can make some
Trend, yeah.
yeah. And then three, it's like, I want to be acting on that.
Yeah, so there you go, folks. Routines matter, daily routines, weekly routines, do them. And you kind of answered my next question, but maybe you've got a little bit more color here. Once like you said, once the semis, started popping up, whatever, they've been trending for a long time, started in 2023 through 2024 now. What are some signs, and you mentioned a few, that the trend is kind of losing steam, losing momentum, and is a little bit long in the tooth?
Yeah. And that's such an important question. When do things start to falter?
Right.
And so I would argue anytime you get some really, really, really big blowout, after that, most volatility spikes tend to be dampened versus that. So take GME AMC the first time, like, okay, mega blowout. My general theory is anything will be dampened against that one. So then Roaring Kitty came back. We blew out to like 80-ish pre-market. My general theory is ones after that will be even dampened versus that one. And so like, again, not always, like it's just a heuristic. And so like, again, when we look at that ARM one and the hysteria, and you can even tell just from like reading some of the headlines, listening to CNBC, like it's kind of funny too. I don't know where SMCI is right now, just having no charts up. It's probably like 800, 700, whatever. And on its way up, when SMCI was going up to like 1200, as we were approaching 1,000 plus, like 900, everybody's target and where people were scared this could go, oh my God, is this going to 1,500? Is this going to 2,000? And it's like, what? Like, where were all you people back when this had earnings at $450? Like, I want to hear those views then, not the reflective view where, oh my God, because this is doing that, it just is this feedback loop. And eventually that feedback loop reaches a mania where it just can't build on itself anymore. And so it's like when you start to see the euphoria of every single thing, when every single setup works and every single setup is just exploding, that does not last long. It does not last long. And that's when you like, again, I think that sweet spot is probably, in times 3 through 5, roughly. And when things start to really work and you're like, oh my God, this is awesome. And now everyone's hopping on the trend. That's when I start to pull back. You always want to be one step ahead of the market and not waiting for confirmation, right? And so it's like, if I see one CPI, then a second, I don't need to wait for the third. I'm trading that, right? And then once everyone is psyched for CPI, every single person is like, oh my God, I should be game planning these. Oh my God, I now have all the data I need. That's when I'm like, okay, like I'm going to start to pull back. Not necessarily stop, but just start to be more defensive. And the other thing too is initially what you'll see is not that everything stops working, but you'll start to see a couple cracks. And all of a sudden, the setup that used to go 5% goes 2 or 3. Or all of a sudden, the setup that was working 80% of the time starts to work 50% of the time. So it's like almost like the slope of how well things work, where you're like, oh my God, like this semiconductor worked. Now all of them are working. Then you start to see, okay, both the reward and the percentage are starting to falter. And that's when you start to really, really go back. And then most people, a lot of people though, don't stop until after they take losses. And it's like,
Right.
dude, you didn't need to wait for the loss. Like you can see things working less and less. You don't need to stick around to like, take the flesh wound. Like it's okay, man. I think like even P&L at a certain point, like that becomes an indicator in itself. hey man, when things are really easy, it's rare
Last too long.
that stays going. Yeah.
Yeah, I know, like, early on in a trend on a daily chart where we're coming from a correction, whatever, you have a really big day. It's like, okay, cool, that's the start of a trend. But then when we've been trending weeks and weeks and you have your best day in a while, that's kind of almost a warning sign that I've kind of noticed where, all right, got to be on guard a little bit now.
Yeah,
That's just
the
something that I've noticed.
sentiment's so huge. Like, you're so spot on with that. And like, it was even funny when Bitcoin was at, I don't know, it was like what, 67,000 or something. Like, every single trader on Twitter and every single trader I know is like, hey man, what's your game plan for the Bitcoin breakout? And like every single trader was like, dude, like, oh my, like, you just saw it. Like, I would check out random Twitter posts and like about homes or something, and people would be like, dude, why would you buy a home when you can just invest in Bitcoin? It's inevitably going to be up. It's like, what? Like, what are we talking about here, guys? Where like sentiment does reach that fever pitch, then you end up with like, wait, everybody's already positioned for the breakout. Everybody's long when it hasn't broken out yet. And if everybody's already positioning, like, then it's like, wait, there's nobody left to bring it to the breakout. And that's kind of the chumps that make that lower high. And then it cracked, right? Then it cracks, it breaks 60,000, it flushes out to 55, and everyone's like, oh my God, like it's over. That was the lower high. This is the end of the world. Like, it's just that pendulum that shifts and shifts. And you just want to be so cognizant of like, is every, it's like, like even GME a couple of weeks ago, it started to perk up towards 30. And I
Yeah.
saw some post where it's like, oh my God, every time GME has broken 30, it's exploded 20 more points. It's like, one, that's like a super stupid analysis because you're only like, first of all, and I mean, this is a great example because when GME had recently broken 30, every time it had done so was on like this fresh roaring kitty news catalyst. So the person wasn't factoring in the news catalyst. The person also wasn't factoring that this has already now just had like a couple big spikes with no news catalyst. And sure enough, like, I think it like doinked 30 and now it's just melted. And it's
Right.
like, well, everybody was getting super perked up. Like, everyone's like, oh my God, here we go again. If everyone's saying here we go again, we're probably not going again. It's those qualitative things really matter.
And meanwhile, small caps and IWM are gapping up and they're starting their move, and that's fresh, and that rotation just happens. It's how the market works. So,
Yep.
yep.
And,
Lance,
and
this,
even
yep.
with, sorry, but even
Go
with
ahead.
IWM, where were people the most underpositioned?
Right.
It was probably IWM. People were saying IWM is going to be dead forever because, unlike most indices, their best performers, get into the S&P and they move on and everything, yada yada yada. Small caps suck. It's the mega cap growth, and it's like, well, when everyone agrees on that, it's probably about to end.
Yep, perfect. Lance, this has been fantastic. I just have a few kind of wrap-up questions for you. I've really enjoyed this. First, this is kind of a complete pivot a little bit, but I want to hear your take on this because it's kind of one of my new favorite questions to ask. How do you define and also manage risk when you are trading?
Yep. I mean, okay, I'm ready for my 2-hour TED talk. How do you
Next
define
time.
and manage risk? Yeah. I mean, I think at the end of the day, a lot of stuff just needs to come from experience and starting safe. And most people are never as conservative as they think. And ultimately, the best way is through experience and iterating. And no system you come up with is going to be perfect. No strategy you come up with is going to be perfect. And by definition, if we've learned anything from this talk, a lot of times we just don't know what we don't know. And you can be blindsided by so many things. And so the most important thing is to like size way more conservatively, always leave ammo in the tank, and just give yourself the most important thing, which is the runway to always be in the game to learn and add new patches on your armor. And so the biggest risk is just being out of the game. And so maybe that might be having in prop trading world, we had daily loss limits. You were never ever going past your daily loss limit. That
Right.
should be just such a common practice. It's different if you're a swing trader and you're potentially up on the trade, right? You sometimes you need to give back some gains depending on your system. But as far as like percent of account in a single day, you always want hard-coded risk limits. And you always want to even live by this heuristic, which I recently started using and thought up, which is only allow yourself a loss that will not impact your psychology. Because for a developing trader, having a positive feedback loop is so important. And when I train and mentor all these guys, the most damaging thing these young guys can do to their career is you end up in this hole or this drawdown, or you take some loss where it really kills your motivation. Because the most important thing is just making forward progress each day, just getting that 1% better. And so what I realize when traders are like, oh, how much should I size up on my A+ setups? How much should I size up if I want to grow? My answer started to become like, if something is truly A+ for you and you want to be very aggressive, definitely push it, but never go so big that taking a couple losses will then affect your psychology. And I think that's just such a good little rule of thumb, because it just allows you to always compound and grow. And so as long as you have rules to protect you and keep you out of the game, or sorry, keep you in the game, and as long as you have rules, ideally even stricter than that, which affect and prevent your negative psychology, that's kind of how I think about it these days. And for anything more specific than that, it's like, well, that's kind of the fun. That's on you and what you learn along the ways by taking all those, little flesh wounds. And there's no way to avoid that. Nobody can ever do that work except you. And that's what makes you unique and robust as a trader, is that you've taken those flesh wounds. And it's part of just paying the dues. There's no way around it.
That's a great answer. And Dr. Steenbarger actually last weekend was talking about positive trading psychology, that positive feedback loop where you got to keep that confidence up, and that's going to allow you to trade better and better. So I love that. Lance, if you had one homework assignment for everybody watching right now that they could do to improve their trading, maybe it's along the lines of filling out a few of your templates and analyzing some of the best opportunities. What would that kind of homework assignment be? What homework would we give everybody watching right now?
Yeah, one homework assignment, probably the most important one, if I had to do one, is take what you think are the 5 examples of your most quintessential setup. Like if I were to say, okay, what is your setup? What's your edge? Take the 5 absolute best ones in that trade and dissect them in extremely high detail. Every single nuance, every single variable involved, exactly how you should have traded it. What's the entry? What's the trailing stop? What's the stop loss? What size you should get? What % of risk? And do that for 5 examples, and then make a master document. This is the play. These are the variables. This is what makes it better. This is what makes it worse. And if you just have imprinted in your mind, like, the analogy I would give is there's such a huge universe out there of stocks. There's so many setups, everything's moving. To know what not to trade, there's actually an infinity combination of what not to trade. It's
Right.
overwhelming to study what not to trade. What's way easier to study and to learn is to say, I'm going to imprint this one super specific pattern. It might not occur all the time, but I'm going to master this super specific pattern. I'm going to scan for this super specific pattern. I'm going to know every variable. I'm going to know every aspect of this, and I'm going to have all the data that's exactly on this, and I'm going to master that. And that's the way better path than trying to fight a universe of just 1,000 different things. Like if you told me, like if I had to teach you poker in one day and you needed to know the odds of every single hand, or same for blackjack, how do you act in all these different hands? The way easier thing is that if I have like 1 hour to teach you poker, is okay, here's one rule. On aces, you bet, everything else you fold. Like you can come up with like, all you need to learn is how to play aces. I'm going to teach you how to play aces and nothing else. And that's going to get you a lot further than like, okay, here's all the nuances of what to do if you're stuck with 2-7. It's just not going to be as effective for people. So yeah, really honing down in the highest detail imaginable. Like if you don't have some multi-page write-up, at least for like 5 charts where it's like, boom, this is a quintessential imprinted in your head, it's going to be a high return.
Wonderful. I think that's great advice and assignment for everybody. So I expect to see some people sharing their examples on Twitter, tagging us.
Cheating's
We'll
allowed.
retweet
You
them.
can share, you can post, you can collaborate, you can even use AI.
There you go. There you go. Lance, this has been fantastic. I know you've been working on a resource that you'll be releasing later this year. I'd love to hear more about that, as well as your foundation as well, if you'd like to share a few words on those.
Yep. So the big thing going on in trader world for me is after many years of kind of just sharing my knowledge and after a lot of requests, I am finally working on creating the greatest trading course of all time. And I mean that quite literally because I'm pretty certain nobody has ever invested this amount of time or money doing this. I recently posted a trailer on my Twitter, which shows just the quality of production going on. And the beauty of it is the majority of this course, which I've called Magnum Opus, is going to be totally free. I plan on this being the legacy of all my trading knowledge, especially as I want to one day kind of move on from the trading world and pursue other hobbies. And my other big interest, of course, is giving back. Since 2018, I started my own nonprofit, and that definitely takes a lot of my time these days. And what we do is it's called the Impact Competition, and we host competitions at universities that challenge students to solve different social issues in their local communities. We give them a cash prize. We give them funding to implement their winning idea at the local nonprofit. And we have some really cool success stories on everything from gun violence in Chicago to housing insecurity in rural Indiana. And it's really amazing working with these students. And I think what's so important for traders to recognize when so often P&L and money is our scorecard is you can get trapped in this cycle of enough never being enough. And I really enjoy giving back because it's a reminder of just how grateful we should be, and why I love this conference itself is because it's ultimately sharing free knowledge and trying to raise money and everything. And so the other beauty of what this trading course is going to be is it's going to intersect the two worlds. Because I saw this opportunity where there's just so many furus out there, so many snake oil salesmen. And in my view, they're essentially just defrauding people of their money. There's no real edge being taught. It's all bullshit. And it's sad because I've met these traders in real life. I do a lot of meetups and I hear their stories and that was really my motivation where it's like, okay, enough of the bullshit. We're creating the end all be all. And then what I plan to do for part, which will be just a premium version, is then take some of that money, cover my production costs, and then just donate it to good causes. So it's ideally, look, share my knowledge with the world, help people hopefully fare better at this craft and make the world a better place rather than throw the money into the pockets of, just frauds and furus.
There you go. And people can learn more on your Twitter, I believe. Is there a website
Yep.
as well
Yeah,
related to
so
it?
for the course, it's going to be the1lanceb.com, all spelled out. It's all linked on my Twitter and everything else. And there's a sign up page. And look, I try to avoid a lot of the heavy marketing and everything else just because I just want to do this for my own reasons. But nevertheless, like the free version, I think is going to be a super kick-ass resource for thousands of people. So stay tuned. Come year end, I'm hoping to just break the internet with this one.
Perfect. Well, Lance, you've definitely given back today here to everybody watching. Please, everybody, thank him in the chat. Let us know your favorite Lance quote or key takeaway from today. Lance, thanks again for your time. I really enjoyed that. I think this is a great compliment to last year's as well. And yeah, thanks again for being a part of this. I always enjoy talking with you. I always learn something, and I'm really looking forward to rewatching this back, taking some more in-depth notes. So thank you again, and we'll be right back with our next presenter. Stay tuned.
My pleasure. Thanks, Richard.
Thanks. Okay, welcome back, everybody. It's my honor to introduce our next presenter at the TraderLion conference, Leif Soreide. Really looking forward to this. As you guys know, he's the U.S. investing champion of 2019, a difficult year for growth stock trading, and he's done many podcasts with us previously. An amazing educator, trader as well. A lot of the kind of price and volume nuances that I look for in charts, I learned in those initial interviews. So, Leif, thank you so much for being a part of this, and really looking forward to diving into this topic. Basically how to fish in the right spot. I think is kind of what you're conveying today. So welcome and thanks for being here.
Thanks for having me. It's an honor as always. I'm trying to bring something new to the table this year. We're trying to focus on, creating your universe and kind of, I wouldn't say put the math to it, but sort of put the amount of stocks that are in your universe into a histogram. I've seen, people start to use this and not even doing it exactly the way I do it, but, making it a similar histogram, saying, okay, this is setting up for me, and I'll show you how I trade it, what kind of clues it gives me. It helps me kind of press it when the swing trading is hot and turn it off when it's cool. So it's a great indicator to use.
Perfect. Well, let's dive in. Or did you want to start with this quote here from Stephen Hawking?
I don't know. It's okay. We'll skip it. Let's go into, I guess I have a slide just introducing sort of the background for me. Obviously, this is my family. Father of four, and obviously I always tell everybody max out on the kids, whatever number that is for you. For us, it happens to be 4, and we're very busy. Time is precious, and Richard's got 100 jobs and no kids, so now's the time to sort of get yourself to get there before you have all these. And that was been my path, and I settled down and do trading like exclusively for the most part now. Won the U.S. Investing Championship, and it's helped me kind of reach out to other traders and even talk to some of these influences I have personally. Obviously, William O'Neill's it's all sort of based around that. So he's like the main guy. He passed away recently, and then we still have Mike Webster and David Ryan. They're on IBD Live quite a bit, and I've had the honor of kind of talking to them a little bit there. Stan Weinstein for stage analysis, and Minervini for early entries, and like his trend template idea is an influence for what I'm about to talk about too, and Zanger for volume and chart patterns. So just a little bit of fun before everybody falls asleep. I know everybody's looking at a lot of these videos here, but we have this thing called the significant other indicator, and sometimes you got to fade yourself, right? So if you start running around telling everybody, you tell your spouse, say, oh, I did it, honey. It's going to be a great year. Like that's the time to sort of mind your risk, work on your signal, and at least, maybe sell a little bit or adjust your stops, something like that. So
is there a
this
reverse
is a
significant other indicators, like when we've been basing for a long time, correcting? Is there
well, there's the reverse one, right, too. So you tell your wife, like, oh, I don't know, it's I'm never going to make it, and you want to quit, which is everybody gets there at some point, but you got to have that no quit attitude too. We're going to talk about that because we have we'll talk about Leo, who he did a talk with you, and one of the last things he said is never quit, and he had a tough journey. I'm going to get there. I'm getting ahead of myself, but you got to know when to sell, and you do have to sell at some point, or at least take partials. And you're your own indicator. Are you giddy? Are you too excited? And in the other way, if you think you're never going to do it, that's the time to start looking at what's setting up, maybe, right? And maybe you're missing something. So anyway, just a little fun little slide there. But the first things first, I mean, I always say trading is sort of a lonely venture for a lot of people, and that's why a lot of people quit and all that. So I'm all about the educational platforms. I've subscribed to several. Now I work on my own, obviously, exclusively, but it's great for idea generation, and really everyone learns somewhere. And even the people that knock the services, they'll let it slip where they learn and what service they learn from. So you got to take that, consider that. At Champion Team Trading, we really do word of mouth. I don't advertise anywhere. So we just kind of want a great trading environment with like-minded traders. So you kind of get what I'm doing already, and you show up, and then you're going to be in good shape. And we're not listening to crazy stuff. We're very focused, and you want to be around a focused group, even if it's not with us. You want to trade your style, and don't have 100 different styles going at once, because you'll kind of get random results with, random, methods and stuff. So, but anyway, part of that is, Leosh, we're honored to have him on the champion team. You did a great talk with him, Richard. And, one of the things he said, like I was saying, is, you never quit. He had a bumpy journey, but, he's up 300% plus, and, leading the contest, or at least close to it. He's top 1 or 2. So, it can be done. He's an example of that. He's done, master trader, and then he trades with me at CTT, like a lot of people. It's key to be around, like-minded traders and have this kind of motivation. Like, you can do it, but it's not a typical result, right? So I don't want to say, I'm not the guy that's kind of promoting, huge returns and you're going to have cars and all of the lifestyle stuff, because I think it is a grind. And if you show up with that attitude, and we're on red signal, it's all about risk management or something, you might not understand it. Like, it takes some time to get there too. So you don't want to be in the market all the time anyway. So you kind of have to dial things back when things aren't working, and press when it is. And you got to be concentrated. Leosh does that at 2 to 8 stocks, 25% positions on margin. You got to do margin if you want to win a contest. And you got to watch your drawdown. So that's him. But anyway, so he trades our universe. So just to tie it together, we're talking about the universe that we trade here. We want stocks in uptrends, the stage 2 criteria. Obviously, that's, Stan Weinstein's idea. And, like the trend templates from Minervini, you want to stick with something like that. But, we add a bunch of qualifiers with, liquidity, average daily range, things like that. Then you get, what's in your system. And sometimes, we do kind of not really break the rules, but we do add IPOs, because they don't have the time, they don't have 200 days of trading, and they can be rewarding. So you want to be flexible to add those to your system, but you want to take a look at what's setting up overall, and that's going to end up in the histogram. And you want to see, are there more stocks or less setting up for your style? And there can be false signals too, or choppy periods, but we're going to go over that. But you got to define your universe and say no to some stocks. Just say no, right? So you don't have to trade everything with a nice chart pattern. And I always say, kind of think beyond the pattern. That's sort of our catchphrase, I guess. And I'm sure someone's used it, but we're gonna borrow it. It's pretty much all this stuff has been done. It's just everyone's way of looking at it is different, and you're going to see everyone has their little things they favor and such. So anyway, so when you're looking at the stocks in your universe, you want to make sure you're selective, right? You don't want to just trade any stock just because it has a pattern. Especially if you don't understand it, like some highly speculative biotech stock with no earnings. That's kind of a random stock, and if you don't get it, you probably want to trade it small, if at all. If it's just no earnings, then it's hard to understand what it is, and you don't get it. Prefer something that you think is a leader. Look for increasing fund ownership and volume, of course. Stick to quality, and like I said, trade random stocks. Expect random results, right? I mean, if it's not a leader, the leader is almost the key, right? You want to trade a leader. What is a leader? That's a whole different presentation, but you have to work on that. So we can be selective about what we buy, and you can't buy everything, and you shouldn't buy everything. You got to be concentrated. So sort of the ideal universe, when you look at all the stocks setting up for your criteria, this is a look back at in June, and things looked pretty good then. Technology was leading, energy was I think the next day barely on here. That's sort of the spread I want to see. I want to see tech growth leading. So it's just a quick breakdown of that, a recent thing. So we want to see energy falling off, and that has to do with inflation and recent trading and such. If the money kind of rotates to energy when it comes out of growth, so you see energy going up and tech going down. That's kind of a problem. And these are all keys to looking into what's setting up for your style. And this is that breakdown here. You see tech, the sectors in the top left is tech is leading, energy is at the bottom. So that's kind of ideal until it's not, right? That could be exactly when it starts to change. And then you can also look at the market cap breakdown. whether you're trading large caps or, small caps weren't really breaking out yet. I mean, small caps recently took off. And, look at the country breakdowns and the industry breakdowns, so biotech, software leading, semis leading. It's kind of a good mix there while things were kind of hot there for a minute. And then fast forward to July 22nd, you have technology sliding, right? So now it's number 3. So that tends to, no matter what the index is doing, your stocks in trend, the growth stocks are kind of falling apart there. And we're sort of adding regional banks. Like regional banks aren't exactly what I swing trade. I really don't want to swing trade them at all, even though they recently had a good move, but they've been asleep for the longest time. And, they made nice bases, some of them. But if you missed it almost day one when they all kind of broke out, then you're buying the laggards and you're getting limited gains, and you're risking 5% to make 5% maybe. So it's just kind of not the groups I want to trade suddenly when the growth stuff falls down, financials pop up. But then you just have to adjust. You can do some trading in those, the ones that are setting up. We're in APO recently and things like that. So, but take a look at the breakdown. This is going back to June. Stocks that are setting up for us that meet our criteria, kind of the performance versus the S&P 500, they really outperform it. So these are the real movers that we look at. So you can see that difference there. And that's what you want to be trading, the ones that are the strongest in the market. And that's where you end up when you have stocks in trend, that are, you got the 50 over the 150 over the 200. You're going to see those right sides of the basis tighten up and not have random choppy charts. And one of the things, I don't have a slide about it, but I've been saying stage 2 transitions are choppier than the textbooks, right? I mean, you don't, if the 200-day is flat, you're always trying to time the turns where it starts to move, but it's got to start moving. We want to see stocks that are typically trending first, so the moving averages are rising. So that's how you get the good right side development. Look for those decent pivots in tight areas, cup and handles and such. So anyway, so when we plot this histogram, we kind of look at it a few ways. The 21 EMA we find captures kind of the move, but you can have a false signal, a false move, or a difficult move. If it's all regional banks, it's a tough thing then. But you want to see, you don't want to see huge liquidations when you see all the stocks in trend really fall out of bed very quickly. Like we had something like that in April. So that was sort of something we had to sidestep very quickly. But then it consolidated and then kind of started pressing out again. So we're able to get involved. So kind of waiting for confirmation, you can be kind of late. You got to look at the stocks also. You can't just look at this and say, I'm just going to go all in. And you kind of have to get in incrementally, obviously, buying the stocks as they're breaking out, looking at the groups that are setting up and such. And the mix that's moving up in the stocks and trend. Like if you're trying to buy tech stocks and they're moving down, you're probably having a hard time, even if the more and more stocks are entering the trend because they're regional banks or whatever. So anyway, so you want to look at some ETFs for verification. So recently we had a very nice looking trend, but it was mostly because regional banks were being added in the small caps. And it wasn't a lot of the small cap growth that was working. So it was one of the more interesting spots in the last few weeks where we see the FFTY sort of making almost the spirit of, I borrowed this from Mike Webster. I told him this last time we talked, sort of a head and shoulders look to it. And then I think it got even worse from here. This is from a week or two ago. So if that's going down, where the trend count is going higher, these are handpicked 50 stocks from IBD. You're going to find the growth leaders in there. And if those are falling apart and your histogram is rising, but you're trading these type of stocks, you kind of have a false signal. So you got to be careful for that. It's kind of an interesting thing that we sort of planned this, and this is actually what happened. So now we have something sort of to show a recent sort of false signal where kind of mega caps are kind of all rolled over, and the regional banks and stuff that we don't really like popped into the trend there. So anyway, so some more false signal talk. This is regional banks popping, and the FFTY, those IBD 50 stocks are not doing anything. So unless you're going to move to the regional banks very quickly, you're not really going to get much out of this this divergence here. This is kind of a false signal for the types of stocks we trade. And you'll see it was even home builders were part of this, running right up the right sides with kind of no valid buy points. So all those, the count for those rose, the count for regional banks rose. And some of those were buyable. I'm just going to say I wasn't really too interested in them, and they just all kind of broke out one day. So missed some of those. And you don't want to be in the market the entire time anyway. You're going to catch those choppy periods. But we do want to let some stuff trend. You want to sell some into strength and let them trend. And if things can hold all the moving averages and such. So, but basically since the, post-pandemic highs, it's been a relatively thin market, but there's been plenty of good opportunities, and that's what we've capitalized on. And you can see Leosh up 300%, just trading all the stuff we look at, everything in the that's on the histogram there. So here's a little math to it. And this is the point of our platform. We have someone that is, I say he's a genius, basically organizes all our stuff, can do all this, all these things. Most of the time you're going to have like 123 stocks. And when you're down to 5, that means you're pretty much out of the market. And if you're on your way to 1,000, like the COVID highs, you want to be involved with that, but, watch the, look for the exit, because you're way overbought. Right now we have over 400 or so. So I think it's like 11% of the time is something like that where we're at now. So it's a little elevated, but that's a lot of regional banks, and they're moving fast too. So that's kind of puts them in the trend there. So, so I mean that this is just kind of the stats behind it. So, and more of the universe kind of looking back, you see it kind of choppy. And when you kind of get to the highs, you can look to sell some into strength, and then you kind of miss these drops too. So it kind of helps that way, and you're following the 21 EMA. So
sorry, just jumping in. Before, you probably will address this, but just in general, here you're kind of looking to get aggressive when it makes that turn above the 21 EMA, and we start to see it trending above it. Yeah.
Usually you're going to need a consolidation first. Mm-hmm. So you can see here in April on the right side, it really fell out of bed there, and then it consolidated a little bit for 7 bars or so, and then stock starts setting up and moving. That's when you're getting aggressive. Going back to last year, things were falling apart all the way until the end of the year, into November. And then stuff started coming up off the lows, but that's not setting up proper right sides of the bases. You need a little bit of time. So even if it just kind of goes straight up, you do need a little consolidation, let things set up. And some of the stocks are going to set up during that pullback. And that's going to be something like NVIDIA. It went on to, as this was declining here, we're going to show that it's sort of like a relative strength indicator versus the market. Right. You see the trend falling apart, stocks, selling off or way down to, I don't know, what are the 20 stocks that are even in the trend there. And then they start pumping up again. And then you have something like NVIDIA here during that period, showed relative strength kind of, while all these are falling apart, like I was saying, and then it kind of resumed its, it started basing. That right side looks really good, and then it took off and went for a double from there. And I think we only caught a little piece of it, but we've been trading, AVGO and similar names. So, growth versus value is kind of an important thing to match against the histogram. If growth is not leading value, like we have a recent sort of sell-off. This is last week or something. Growth kind of broke down versus value with more stocks and trends. So this is sort of a false signal. You got to keep your eye on growth. I mean, that's really the key. As long as the relationship is consolidating or rising, growth winning, right? You want to be probably swing trading harder to the growth side with more size. As things are rolling over, growth is losing to value, you're probably going to have a difficult time, and you got to downgrade your signal. And that's a little bit of thinking beyond the pattern. When you get your patterns, and maybe you see something setting up, but you got to recognize when things are not working and growth is getting bested by value. Beginners kind of focus on chart patterns and think there's that's the key to everything, but we kind of layer our odds onto a chart pattern that sets up based on what is the group doing. are more of these stocks entering the trend and things like that. And you got to learn what a proper base is and the right side of the base development. You know, the tight areas, you know, you always want to kind of cup and handle, trade like a VCP, similar idea, tightening throughout the base. You know, shakeouts are meaningful. There's all the little things you got to learn, and it takes years to do it. You want weak hands out. I mean, this isn't on the slide. I'm just saying a couple things here.
Off the dome.
To go, if you're a new trader, there's so many little nuances that you have to find out, you know, that make you money, right? You get a 50-day test with a shakeout, recapture, all that kind of stuff. You gotta find your setups. You know, and tight areas are really just the key to understanding supply and demand. You know, as you know, that's what a base is. You just want the supply to kind of work its way through the right side. When demand starts to increase and there's no supply left, and you get your breakout. That's what we're looking for. So, you know, you want the good patterns to lead you to the groups that are setting up, and you're going to find the leaders, right? That's you want the leader, the top 1 or 2 stocks in the group, and kind of target those. And you got to be patient. You know, sometimes you're not going to get them. You can play some similar names, but ultimately you want the NVIDIAs and, you know, the AVGOs and stuff like that. So, you want to recognize when breakouts have that lower odds of success. Is it institutional demand, right? Going to your breakout point. We're trading something. I was looking at something today, and we got it out 8%. I was seeing a lot of buying inside before the buy point. So to me, that was you know, real buyers stepping up, not people looking for some kind of a daily time frame trigger, which is what I use. But I was seeing that ahead of it, and that was good for sold some up 8% plus, you know, for a single buy. So, you know, sometimes and then sometimes the earnings pauses create the tight areas. So you look at a tight area and you want to buy it, but just waiting for earnings. You know, there's nothing there. It's not even a supply and demand thing. Just sometimes I think it's just a pause. So you got to consider that too. Yeah, ultimately the stocks are going to guide you. If you're making more money, you got to size up. That's really what it's all about. You're going to catch your runs. You don't want to give it back. That's the main thing. So. And then we try to work on our edges. You know, I'm not a big poker player, but I do a couple charity things once in a while. This is a scene from Rounders with his name. It's John Malkovich's character's name, KGB here. You know, it takes years of screen time, you know, seat time really, to line up all these techniques to kind of improve your odds and know them on the fly, right? You know, real-time trading is way different than the hindsight stuff that everybody, you know, you see on Twitter and all that. So we're working on and making notes about what's setting up before it does, so we know what to do and have at least what we feel are some better odds. They're not all going to work, you know, so you got to be, okay, where are you wrong and all that stuff. But this scene was a little dramatic. You know, they're not all tells aren't this obvious of a guy flipping an Oreo around, right? Giving away that he's, you know, bluffing or whatever he was doing there. You know, the top level of poker players, it's more of like a small shift in the seat or chair or whatever. It's more of a tell, something real subtle. You know, so this is the theatrical version of that. So you see it, but you know, subtle edges in stocks. If you're not thinking about it, you're only going to see it in hindsight. So you kind of have to know what to look for. You know, you got to recognize sort of the liquidation of weak holders as an edge. You get your swing traders out of the way. I'd prefer if no swing trader was involved in any stock I buy. I want to see real buyers because they're not selling up 5-10%, they're holding it. So you want to see real heavy buying. You want to see that inside the bases sometimes. You need to look for clues, look for the big volume bars along the way, see the footprints and such. But you know, if swing traders are less involved or they got shaken out, then I'm more interested, right? So, and there's a trade at the end of this. We're going to show that we capitalized on that for quick double digits and just took the profits. But you know, you got to review your past trades, winners and losers, of course, and it'll help you spot, you know, what you're doing wrong. You know, are you chasing stocks? Are you too aggressive? Are you know, when the market's not working, are you pushing too hard? Yeah, and don't forget to look at similar names. You know, within a stock that you're buying, you got to have some clues and some tells. Are they moving, right? what are the market conditions and all that. So that's the edges are subtle. All right, so we did AVGO as a trade here. So we had some requests on Twitter X. You can find me there. People wanted a couple successful trades, and I think an appropriate one was AVGO to show here. We got this one a little over 600 on a turn with a 2% risk, and went that kind of rise, and then we sold it and traded again. I even tried to short it and scratched it, and I don't have that up here, but we did it. We did this twice. And I'm trying to get back in this one again. So you're kind of thinking about this in terms of all the AI stocks we're setting up, and this was setting up. So, that's really the edge. I mean, there's something going on there in the theme. Is there a theme? The N and Can Slim, what's new there? Like, I'm trying to do the N and Can Slim, what's new about Leif's trading, right? This is sort of the idea of the histogram I want to show. And I've always kind of used that idea of, how many stocks are in a trend count and stuff like that. But putting some math to it makes sense. And, a couple other edges, you're looking for mini shakeouts, like I was saying. Compare 3 stocks. If AVGO is going to work, NVIDIA is probably going to do something, and similar names. You got to fade the group think too. If everyone's saying NVIDIA is overvalued, I don't know. But there was somebody that wanted to do a talk with me was saying NVIDIA is something. NVIDIA is effed constantly. I was like, well, I don't know what that's all about. Not for me. So we passed on that one. But NVIDIA being, everybody thinking it's overvalued is an edge. If it sets up again, you have to fade that group thing basically. So anyway, be quick to target setups that held up well after a sell-off. That's kind of the relative strength idea. You want to sense if it's real buyers or just breakout buyers, and doesn't matter. Sometimes it does. Sometimes the breakout buyers, and there's no more supply left, and the breakout buyers are moving it up, and the institutions come in and chase it. Then you're in luck for that kind of trading. But you do want to see the footprints on the way out. So, and that's all about volume. This is what I'm saying here. So,
on an intraday basis, sorry to jump with the question.
Yeah, go ahead.
What are you looking for? Just big volume bars on an intraday basis to suggest that there's institutional traders involved before it gets to that pivot point? What are you kind of looking for in that chart?
Yeah, I mean, you're following a stock probably for a couple days. There was one that I traded today, and I was starting to see a bunch of excitement buying, and it was just trading inside. So that was a clue, like, who's all of a sudden decided they just have to have this, and they're buying it pretty heavy. And then it broke out on the daily time frame over the prior high, which is what I use. I use the daily time frame, but I'll look intraday. As that broke out, that went 8%. We took a profit scale already because just the signal's a little difficult, but things are setting up. But that led me to buy it. I almost didn't want to buy it, but it just that's the thing. You're sitting there, and everyone's probably thinking what I'm thinking. I don't want to buy this. It's kind of choppy market and all that. And then you see them coming after it. That's sort of what I'm saying. You have to see it though intraday. See the heavy volume start coming in. Just I assume it was an institution or something. So maybe, and I was probably right because it did break out, and you can only guess. Sometimes it could be breakout buyers trying to front run a breakout and doesn't do anything. So there's all kinds of landmines you can step on too, where you're wrong and your judgment is totally wrong. So, but that's what the risk management is for. If you keep running into some kind of false breakout, you're obviously going to have to dial it back, so that's that. But yeah, that's a good question, and that's something that you're going to get to. That's more of an art. There's no formula. It's just, if you're watching something intraday as you traded it, and I'm going to show this one later actually, and it may blow out and have to stop even on it too. I mean, but it did stay out. So that's what we're looking for, and that's more art than science. And you have to kind of listen to the volume in a way. You don't actually need a audio, but you got to feel it. So
yeah,
that's why we have the big speaker here, so you can feel that. But sometimes the opposite sort of is meaningful, and we've talked about the reverse pocket pivot idea, where you have this kind of minuscule volume, and on a horrible sell-off for growth, one of the things you can do is look for the stocks that were trading on the lowest volume in that universe, right? So you're looking at your universe list and say, sort by relative volume. We're not sorting by total volume. You look at that later, but you want to see what was just, tiny trickle of volume, and because the sellers weren't excited to take it down. That's kind of something important to look at. And then when things set up again, that one, you see there was no seller. So say there is another sell-off, they didn't want to sell it off in the first place. They didn't show up to do that. So you have better odds. They already showed their hand that they're not selling it down, if that makes sense. So you want to maybe revisit or at least move that stock up on the, on your watch list or focus list, in your ranking anyway. So, but like I was saying, kind of high volume inside the pivot, when it's moving to a buy point, I'm thinking most of the time, I'm thinking that's institutional volume, like I was saying. And I don't want to repeat myself, but I'm trying to get the nuances here.
Yeah.
Yeah, high volume sell-offs in a stock that closes in the upper part of its candle can mean support, like a shakeout. We're going to look at Sky West. It was a nice shakeout. That's what I keep referring to at the 50, and then recapture and then turned up. Big volume right at the buy point. It could be traders, but institutions, like I'm saying, they ran out of supply. They got to get what they're not done buying, so they're going to go with it. So that's the key. You want to ride that, and they don't all buy in one day. So anyway, so a little bit of a technical stuff here. You see a stock that's in our universe, Sky West, like a smaller airline. And I was saying back here in the first base, like these guys are small enough to get bought, and then they started trading really well. So we bought it ahead of earnings, and I think sold it into March and got back into it on this after this shakeout. So we got a shakeout, and it traded tight on the 50, and then it turned, and that's what I'm using the daily time frame turn over the previous high off the 50, and this sort of William O'Neill's studies, show that the first one or two pullbacks to the 50 simple moving average in a leader are kind of viable. And I talked with Mike Webster on IBD Live recently about this, which is, like I'm saying, how cool is that, right? So that's sort of why I do all this stuff. I get to do stuff like that, because I'm a fan of all these guys too, right? I'm trying to emulate what they do, and put my own little spin on it. I'm not reinventing the wheel here, but we're trying to put it all together in a system that works. And sort of journaling, like the whole platform we use is just a big journal, right? So we're journaling, at least the chart patterns and such. So yeah, he agreed that these first touches. So we're working on that, more of that this year. Pullbacks to the 50 and turns. We're doing a lot of that. In leaders, and this stays in your universe, this stock just on the list constantly. That's a sign that something you want to get involved with when it does pull back to the 50. I missed the one in April for whatever reason, probably because it was going into earnings. I didn't buy it there, but I waited till after. I don't like to go too close to earnings, everybody knows, but so yeah, that's the edge. You get that shakeout and recapture. So everybody that was using the 50-day as a stop probably got out, and then you're quiet and tight, and then you're turning up. And we just sold it into double-digit strength there, and we'll let it work itself out. In fact, the group is kind of telling us it's maybe not the best. The group's kind of declining, even with oil coming down instead of going up. Maybe some recession fears and things like that. So yeah, like I said, if it keeps staying on your universe list, that can be a clue itself, and that's where you want to sort of find your way in. There's a few ways to do it. Obviously, you're not getting a fully developed base, but you're catching part of the trend off these 50 turns. So, all right. So another thing we do is I like this buy we did here, LI. We just kind of sold this up into strength maybe a couple of days later. This is the initial look at it. So we did this slide a while back. It's sort of a nice. So we look at something like, we call it like just a pivot reset. There's sort of a false breakout here at this. I can see my mouse on there. I don't know which one.
Yeah.
So you can see this here, sort of a false breakout. A lot of traders won't get re-involved with that or involved with that again. So we look for that to tighten up, and then we bought that, taking out the prior daily high, and that just went right in the money. So we look at those as sort of shakeouts also, right? It's like a false breakout, but it didn't break down. It didn't break the 21 EMA and trade rather tight. You got the kind of double bottom pattern recognition on there, which we like to see, and then just tight handle flagging out there. So that's the reset. It reset rather nicely, and I think it just comes off everybody's list really, and you got to kind of be sharp with it. And that's the spot I don't think a lot of people would play, but we got that really right. So I think it's worth sort of an example. We get them wrong too, don't get me wrong, but you want to see what you can do. This is what we look for. And this is sort of the second mouse gets the cheese set up. We talk a lot about that. Sometimes we'll let a few go, and it'll just end up like this. And you just revisit it when everybody's already out of it. All the swing traders moved on to other names, and then you're back in the game with something that everybody took their eyes off of, and there's real buying behind it, real support there. So, and the same stock, I just have more notes here. It's all about the right side of the base. I mean, obviously this is rather tight, despite it, sort of a false move. So you have to sort of be willing to do what maybe other traders aren't willing to do. And one of the ways we measure this with math is average true range. You want to see that declining into your buy point, basically. And like any kind of VCP is probably going to show that. So there is math behind it. You can scan for, average true range that's kind of lower now than it was, you could say however many days ago, 14 days or whatever. So yeah, double bottoms are great. We like that shakeout. Shakeouts are good. So I did get a little undercut there and set up after this kind of earnings malfunction bar there, as I call it. So this is sort of what we're looking for, and it's sort of a subtle edge to be able to think like this. And this is just the start of it. There's a lot more to it, even relative strength line, other things. The group, you look at the group, obviously other related names and such were all setting up, so it was kind of a easy buy in a way. And so one of the things I like to do is, I looked at the Bitcoin. So this was my most profitable trade of the year so far, trading it in February. We treat it like an IPO base, and I was using the spot chart. And we're trying it again. I might have to just, size back if it comes back in on me. And we tried it again in May. We sold it into this kind of higher basing area, and it's working on a new base. There's Ethereum ETFs out now, and this, it's a Trump play. I think he's polling high, so he's for crypto. I think there's as many as 100 million people that own crypto, so I think they're going to be pro crypto because they want the votes. Obviously, that'll be a kind of not a great move to be against 100 million people's wallet. I mean, people vote with their wallet, right? So that's something to consider. So we're putting a couple things together there. And we got to revisit the stocks and double down on them. That's the whole point of stocks in your universe, like Sky West. We go back to this one. We got it here. We got it there. You double down. So some of this is not ideal buy points. We're playing momentum on the right side here, trying to catch the move up through the 50. So once I get very profitable in a trade, I'm more comfortable, more aggressive with it. I'll go back and try to find a spot I think will work. So the second try was, lightly profitable, not like the first one. This last try to be continued. We'll see what it does. And IPOs are sort of the only item we'll manually add to the stock universe. And this is, obviously Bitcoin's not an IPO, but we treated it like one. So we went down to the 60-minute chart. And what we do for those is we sort of cut them all in half the time frames, criterias and stuff. So a couple of requests for some of the model trades we're working on this year. Eli Lilly, we did pretty well. We got spot in January, and then you're right at the end of the base there in May, and sold it on that break there, kind of around the 21 EMA, avoided 4% more to the downside, and now we're trying it off the 21 and it turns. It's a little aggressive because the volume down is pretty heavy and hard, but all the megas and sold off together there, and they appear to be bottoming at that point. So we're willing to give it a try to kind of that swing low of that area there. So it's got real earnings. You can be bigger in it. So this is why this was rather profitable for me for the year. You can get a lot of size in a big liquid name. you know, really putting all your money in a speculative biotech, I mean, you could have a big win out of it, but you know, your life savings could be cut in half very quickly if you did something like that. So you got to position size correctly and make sure you're buying stuff that doesn't really have too many trap doors where you could wake up one morning and be down 50%. Or, you know, that's why we don't go with some of the Chinese names, because there was some, you know, Luckin Coffees and things like that. I never got caught in them, but I did trade some of that. And then to see something like that just go to zero is definitely you know, something we want to avoid. So you want to trade the kind of liquid names if you can, and when they set up, get more size and, you know, take your pieces out of it. And we recently did have a rather thin market, so the megas were kind of working until about 2 weeks ago when this kind of or a week ago when it kind of broke down there. So anyway, so more of the model trades, like we went over AVGO. That was this spot here back in May. We even tried a short that I ended up scratching for, you know, hardly any loss there, but revisited this turn here. It's an earnings pivot. This is something that we call an earnings pivot. It was on earnings, taking out the prior high on a pullback, and that really moved really well. The last one we got it well in the money and round tripped us, and then it took off without us, and that happens. You're gonna feel, if you don't feel stupid, you know, once in a while trading, I don't know, you're not trading that. I mean, this is going to happen. You know, everything can set up and they just dump it out. Some random funds change their mind entirely, right? You know, things change over time. You can't predict that. If you could, you'd own everything. You'd have all assets and you'd own everything in the entire world, basically. So you can only take your pieces out of this stuff, and to protect yourself from the downside. Like that could have rolled over there down to the 200, and it just happened to turn up there. But right into earnings, I wasn't willing to buy that turn, because I wasn't expecting, you know, a double-digit move right into earnings. So that was a tricky spot. And then you get more choppy, but I'm trying to get aggressive in a leader when things start firming up. I'm taking a little piece here, see if we can get something to work. And that was this is Tuesday here, buying that spot. So anyway, high tight flags is sort of what I'm known for, I guess. So, you know, we're going to go over a couple of these. And Richard, you want to tease it out, the masterclass?
Yeah, stay tuned as well. You know, Leif does an amazing job trading these, and we're going to be doing kind of a special webinar, you know, covering, you know, exactly what to look for and how he trades them. So we don't have the final details yet, but if you're interested in that, just keep an eye out. We'll be letting you guys know. But yeah, Leif, this is your bread and butter, your specialty. This is what you were known for back in 2019, 2020, and you do a fantastic job picking the right spots, trading them. So yeah, I look forward to it.
That's what we have to figure out, put it all down into a master class and all the little nuances and stuff.
Yeah.
The first things first, I mean, this is like a look at Celsius energy drink, and the N in can slim is a very important thing for high tight flags. What's new about it? It's got to have something going on there if you're going to go up 100% and then go up another 100%. And what was new there is they just had a whole popular, I wouldn't say a new category, but they had the #1 energy drink on Amazon at least. And I thought it was okay. Tried it, and you know, it's set up. You know, you get some volume on the buy spot there, and I'm selling it in the strength there, of course. And this ended up going to 100, so you can also keep it. You know, but if you're a swing trader, you're probably in and out more. There's several spots along the way, and if you don't really find this spot, like I was saying, you get aggressive with something that if you made the most money on this trade for the year, then you should be very aggressive on the next spot, even if it's not exactly textbook perfect. That's what I'm trying to say. So because you can let it fly, and you kind of have the temperature of the stock, and you're kind of in step with it anyway. Most likely, if you made real money on it. So a high tight flag, what it is you typically want to see kind of a dormant state, and then all of a sudden everybody realizes, hey, this drink is hot. It goes up, 90% at least in 8 weeks or less, corrects 25% or less, and that kind of qualifies as a high tight flag. And I talked to Mike Webster a lot about this a little bit, and the spirit of one also kind of matters. You don't want to necessarily, well, that's more for the master class, but you get something that's 27% instead of 25. but you might let it slide if it's kind of to the end of the time frame we like, and it's up way over 100%, probably 200, 300, 400% or more. You're not going to get exact measurements out of something that moved. I've seen them go 800%, and during the COVID, you get some move at 800%, and then you're setting up, and you're worried about 2%. You're with a ruler and all that.
Right.
Sometimes the spirit is the most important thing too. So I want to go through the whole masterclass, but this is just a little preview of that. And there's a couple things I do also. We like the power. If a stock like this is in our universe, to try to tie this presentation together to make sense. These high tight flags are in our universe. Like, it's always going to be like this. You see the right side, you get the trending 200. All the moving averages look great, right? So they're all trending. This is what it's going to look like when you get a high tight flag in a stock in trend. And since then I'm going more $5 plus, but this was a little bit less. But it was kind of a special situation. I tend to go 5 plus.
And with the high tide flags, does it matter so much that the group's developing together, or if it's a lone wolf that's showing that power, that's still okay?
Yeah, the lone wolf is okay. I think this might be a split adjusted too. They did a split. I think I haven't kept up with it too much. I think the thing went to like almost 100 down to like 40 something recently. So
yeah,
it's something I'm not watching anymore. So you can't remember what it was. I feel like this was a little higher price then. So I think they might have done something.
I think a 2 for 1 maybe. I'll take a look.
They did something, because I typically don't go below 5. It must have been a special situation, or something's changed. Anyway, so once this this goes down below 25%, I still want to play it if it's a proper base. So we just call it rocket base. Just put a name on the so we know that the distance from in the flag top to bottom. If it's less than 50%, we just want more time then, right? So we call it rocket base. We do low tight flag. RSI is this gambling stock I just traded as a low tight flag. Just swung it out for 13% and took it off, something like that. You want to look for moves that are powerful, like this, like 60 to 90% move. Doesn't quite make it. So, but if it only corrects less than 15%, then I look for it to be, I'm trying to be aggressive with it, but 6 to 8 week base. I can really buy anything in a 6 to 8 week base. It's just something I prefer, right? So we just call it low tight flag, not trying to steal the whole high tight flag idea. It's really a William O'Neill idea. Just I'll go play around that, and then we have some names for what we're playing around it. Basically, that's kind of the idea there. So, and then we have the deep view, which is awesome. And you guys coming out with like new indicators all the time. And deep view looks like it's got some huge potential, and it's really good. I got a lot of people that saying it's awesome. So this is my first stab at it. We did some high tight flag scanner on it, and we have something called CORZ here, kind of a crypto play. This is something that's set up, and when this turns through here, I'm trying it. As long as crypto holds, I mean, this will probably do okay. So, this is typically what it looks like without the moving averages, but the moving averages are going to look similar to the other one there. So, and then you want to see a little bit of more high tight flag action. This is the one I was playing today. It was selling up 8% or so. But it's not easy all the time. We're in and out. I'm selling some in strength. Getting a really bad bar back towards even, taking it off, letting it flag and re-engaging it. That's part of the process too. I don't want to make it look too easy. We're trying to find our spot where we can get this to go out 15% or more, move the stop to even, see how far it can go. Something like this moving almost 500%. It's got the end in can slim. It's kind of like 5G broadband from space. They made some deals with Verizon, AT&T, I think. So there's something going on there. This correction was about 25%. And then it starts kind of drifting out of there. And we're trying to find these spots. And it can be choppy on the way out. So you kind of have to, be aggressive about getting in and out, making sure you're in on the move, right? I'm just waiting for any kind of a turn. Trying to get back in, and that was today. If it fully reverses, it takes out the daily low there, I'd probably be out. So you want to look for that, this kind of power, and then that flagging action. That's relative strength line is a whole nother thing we get into. As that's going rising there, you're improving your odds. And you want to see the volume bars, you want to see big red ones. So I don't see any of that. So it's got something going on there. That's sort of the high tight flag. And then a little more of that, you want to see sales. You got TMDX transporting organs, so when you need your new liver, Richard, you can get delivered from TMDX.
You know me, I'll really need a new liver.
Well, you did hang out with me in Vegas for the night. You weren't too bad though. But I got about 3 hours of sleep and went on stage. And don't go back and watch that one. I can't believe I was functional. Anyway, but that's because I was unsupervised in Vegas. Only had Richard to watch me there. And you're a good luck charm for I bet all the money I had, everything I had, I bet on that fight, and I won. So that was good. The trip paid for itself.
I didn't get my check yet. I don't know.
Yeah. It's in the mail, man. All right. Anyway, so TMDX flagging out, choppy. You do sort of want to see this kind of down drift to the right at some point. I mean, it's flagged out long enough. Now, right into earnings, I figure they're going to make it difficult, and they're going to run it up. And that's where you sort of have to get as close to earnings as I'll go. I think we've got a couple days. You get a nice little pop today. We're a little bit in the money on this try. And you might have to try it several times. I mean, that's the thing. And the thinner it is, the wider the bid and the ask. If you're going to try to adjust all the time, you're going to be getting a lot of slippage. So it depends on how something trades also, what kind of size you want to put on it. But this opened sort of on the low and pushed out. So today, so that's sort of confirming, and it was sort of new high there. I like it. It's got sales. There's something going on there. Everyone's gonna, get their organs delivered. So we like the N and CAN slim there. Something new. So CVNA, this has been a hot stock. This kind of meets, and I'm not really, we're not trading this on CTT right now, but we could, if this turned up here, I'd be interested. Tight and turn on top of this base. You want to be the pullbacks. You want to see on top of support, which is typically the base high. You had pretty much a cup and handle breakout and a pullback to it. So I could see the case to buy this. It sort of has this spirit of one. It's got the minimum requirements, but you don't want to see too much activity in the pull, and this 90% rise is the pull. You don't want to see a lot of kind of supply in there. You want to see kind of a clean break, ideally something 100% with no supply in the pull going back a year, right? That's the other thing. So we'll get into all that stuff in much more detail, I'm sure. And that's the high tight flag masterclass coming soon to TraderLion. But if you want to trade with me and people like Leosha, we're on Champion Team Trading, and we've had we've had a winner of the $1 million+ contest on there, other contest players, and really focused on the universe that we're talking about and nothing else. We don't do any politics and nonsense. It's set up so it's all, topics for each stock, market signal. Everything's very organized, and we have a staff to do that for us, basically. So anyway, that's what I've been doing the last couple of years, and it's a lot of fun. So
perfect. Well, thanks for putting this together. I got a few questions. Could you jump back, I think 3 slides here? Not quite sure. Maybe one more. Yeah, around here. So some of these can set up kind of multiple flags as they go up.
Sure.
How do you kind of decide which one to play, or it's already had a big move, it's still playable if it sets up and tightens up again? Is it kind of like a late stage base? Do you kind of think of it that way, or if it's still showing that power, you'll kind of give it a shot?
Sure. I mean, eventually it'll probably crash and go to a new base or something, even if it's going to get on its way. Like Celsius had a lot of that, a lot of pausing for maybe months and years, or a year or two almost. But we're looking at it. I wish I could dial this back, like we could use deep view or something. But this day, I think it's like July 15th or 14th, something close to that. You had the down drift to the right and the turn on the daily time frame there over the previous high. Mm-hmm. And usually I'm trying to get in lower than the high, because at the high you get choppy. Like you can go back a few bars from the initial buy there, and you can see traders probably try to run that up there. It's a little early in my view. It wasn't super tight or anything, just kind of drifting. and you get that down drift to the right, and that's something David Ryan says a lot. It kind of lets all the little bit of sellers out in a turn. And then you're going to get sort of like a high handle on top of that, sort of almost like mini base on base here, but now you have this area on top of the previous kind of, this is the high tight flag where I bought it initially. Now you're kind of building on top of it. So that's sort of like a high handle idea. Looking for some kind of daily turn. When it nosedived like that, you know, opened on the high and then closed on the low, that's, I'm just closing it and you're gonna get another look at it. Given how how growth was selling off at the time, like I was showing the signal, even though the histogram was improving. For the most part, if the histogram's improving with tech in the lead, then I'm, you know, pedal to the metal gas. I'm gassing it, you know, because you don't get all year to make money. You get 2 to 3 times a year to make any real gains, you know, unless you just catch NVIDIA and sat in it, the whole thing. Something going 100% over a full year, basically, or more. But yeah, hopefully that answers some of that.
Yeah, it's good. And you showed a diagram where you kind of had 300 something as a level to the top and around 70 to the low. What are you kind of doing during a correction when we do get to that low end? Does that tell you to be more aggressive with your homework, start looking for, you know, leaders kind of moving ahead of the market before the breath?
Yeah, it's kind of an extreme. If you go down to, I remember like 5 stocks in trend. I mean, that's like, you know, crickets, you're on the dance floor by yourself, you know, eventually they're going to show up. So you got to start to see them coming in the door. You got to start flowing in. And you know, you got to get ready. But really during that time frame, I'm shorting, you know, it's like, it escapes me what year he won, but our contest player that won the $1 million+ was mostly doing shorting. And that's what we were doing that year. You know, there's more limited gains to be had that way. Typically, I mean, you'll see a lot of people say you don't have to short and all that. I mean, I like shorting when things are broken. That's, you know, they're offering up breakdowns. It's the same as breakouts, right? So you're gonna play some of those. Like we looked at Disney recently. It was kind of an obvious ledge break. You know, even in this market, you know, that's just kind of off by itself, falling apart. You can trade it. So what am I doing? I'm probably shorting. Actually, I'm doing a lot of shorts. So the platform we have is, you know, probably active all the time, right? Because even when you're on kind of the choppy signal, there's stuff to play. Like we're playing a bunch of high tight flags even in this environment. So they all have a shot at, you know, big gains. You know, this could go to 20 or something. I don't know, but it could also stop me out tomorrow, you know, from this day. Right. I just don't know, and we're just going to risk manage and see what we can do. But when it looks like this, it's got the look. You know, it's like, you know, you swipe right on your app that you young guys have, right? I never had one of those. You can't swipe. I'm swiping right on this chart. It's got the look, you know. So I think that's what you do, right? You swipe right. So that's it. I mean, it looks good. It's got the look. Something's going on here. It's got the high rise and all the tightness and all that stuff. So
that's actually a feature we're adding to Deep View Mobile very soon. Swipe right on the charts. So it's funny you mentioned that. Yeah,
I love that. Swipe right. Let's go. Swipe right on this. I swipe right on this chart on Tuesday, and we'll see what happens to it. So,
yeah, perfect. Well, this has been great. Just a few wrap-up questions. I know people, I'd encourage them to kind of watch our previous interviews and podcasts because you definitely touch on this. But just very briefly, you've kind of talked about the setup of the high tide flag. Where are you looking to sell into strength as it kind of works for you, and how are you managing your risk as it, you know, works in your favor as well to keep that stop tight and make sure, you know, you're in the money quickly?
Well, it depends on the level of difficulty I'm experiencing. As things are bouncing all over the place, the money's moving to regional banks. I'm in a trickier spot, so I'm faster to sell. I usually want to see 15% or more before I take any scales on these. So that's the main target. Is you got to have several risk multiples, because, you know, if you're going to try, you might have to try something like this several times. 5% risk is typically what I want to do within that range. And sometimes you have to go more because, you know, the daily time frames is too wide, because these things are really ripping. But, you know, that's why you look for a 25% flag or less, right? Then you got rather tight area. Right. You know, even at 15%, or so flag, you can just kind of buy the high then, right? That's I'm more likely to buy the high. Depends on kind of the dimensions of how much support the thing has. If it's very tight, like a 10% flag, then you're buying the high probably, because you're probably going to get a good stop somewhere as it tightens up around highs and busts out. So there's a few things to consider, but always trying to get more than one risk multiple. But the signal right here, it got difficult as we're in megas recently. Amazon was up 200 to 10% or something like that. Just everything's round tripping on those, even though we took some profit scales. A lot of the growth, even large cap growth, which has been leading all year, sort of was losing the values you can see on that slide, comparing the two. So it means you have to adjust your signal. If whatever you're trying to buy stops trending, it's a signal adjustment.
And for this chart in particular, ASTS, how you drew kind of the flag part, you're including the low of kind of that shakeout bar at the bottom. Is that kind of what you usually do when you're looking at that? Obviously, again, the spirit of the high tide flag, but
yeah.
that's a demand bar. So some people might look to kind of use the two lows prior to that as kind of the bottom of that base. Yeah.
Yeah, you could. I mean, it's just showing the power, right? I mean, I'm not too picky with where it starts unless it's below the level, below 90%.
Right.
If I start cheating one down, it's the wrong bar. It's it's got to be in the last 2 months, and it's got to kind of be start from where it was kind of basing. And I think really anywhere in that zone. I mean, you could kind of the May 13th low. I think that's fine. I think I just threw this on there very quickly because it gets the point across.
Yeah.
For the masterclass, we're going to get it perfect. We're going to make sure we say exactly which bar I would use. But this is sort of either or. I think that this one's fine. Once the volume starts, I mean, that's kind of where it all kicked off. From that move. If you're clear from there over 100%, you're good to go. Then you have your high tight flag in my view.
Yeah, perfect. And, coming back to the theme of your presentation, if people are kind of wanting to design their own universe for themselves, what would be kind of some recommendations for you? You mentioned, obviously, the influences of Minervini's template, Stan Weinstein's methodology. Right. Where can they kind of start as their building blocks?
Well, as they say all the time, nothing good happens below the 200-day moving average, right? So you want to be in uptrends, most likely. You want to be in the liquid names. Maybe you trade all different types of chart patterns, but you want to be in the liquid ones, or maybe you don't. Maybe you want the smaller ones and you want a gambling account. It depends on what your style is. So maybe your style is completely on the gambling end, and you're doing the small account challenge, which I don't recommend. I'm not telling people to do that, but think about how you actually trade and make that your real universe. Maybe you're not honest with yourself and that's all you do trade. You trade spec bios. Okay, fine. Make it all biotech. If that's all you trade, then that's your histogram, and make it. Your dollar value requirements, is it below $5, $10, $15? Some people want to go over $100. So these are very easy adjustments, and then you have your own histogram. So that's the point of this. I encourage everyone to do that. Get your own histogram set up and trade your universe and get good at it, be focused and specialized. And you probably will make some adjustments to your universe over time. As sort of for Champion Team, we've had a lot of members over the years. You'll see I kind of done away with spec bios altogether. Sort of like we'll look at them, but I won't even really trade them anymore. It's just over time you evolve. You don't want to put a lot of money in it. Something can blow up. There's more relative safety. Of course, that can happen with anything, but there's more relative safety in the bigger liquid leaders, in my view, and that's more my universe, as that's part of my evolution in trading. Is everyone's going to sort of adjust more and start to get into their preferences, and that should show in your histogram.
Yeah, excellent. And if you had one homework assignment for everybody who's watched this to go out and do, what homework would you give them?
All right. Well, it's nothing I prepared, but what I would do is define your universe.
There you go.
That's the whole point of the slide deck. We go back to the front. Define your universe, right? So you can get good at it. Maybe it's only high tight flags or whatever. So this is a high tight flag on an NFT, on a moon. It's just kind of a joke. Then you're going to have your breakdown, okay, of what high tight flags are setting up. Maybe that's all you want to trade.
Right.
Okay, so then you can see which high tight flags are working, what market cap. At least you have some stats behind it. And now you're journaling a little better, and you're getting a little more of a clue. You say, oh well, this one's setting up, and all the micros I'm looking at are working in the high tight flags, and or whatever. So, or whatever sector is working. It's all healthcare high tight flags. So much innovation there all of a sudden, which is not really the case right now, except for TMDX. But you get the idea. You see what's working, and
Right.
where you want to move your chips, basically, and place your bets.
There you go. That's your homework, everybody. So go ahead and do that. We want to see tweets on Twitter sharing that. Leif, this has been great. Any last words of wisdom for everybody watching? Could be trading related, could be life related. What would you kind of leave everybody with today?
I don't know. Just know that the journey, you can get there. I mean, you saw the slide with Leosh, and it's a bumpy ride, but after several years, you're going to find your spot. Don't let yourself draw down too much. Don't fight the market. Give yourself some time, and you're going to get there. But you got to have that no quit attitude, just like you said at the end of your interview. Just watch his interview too. That's more homework. Watch Leosh's interview with Richard.
Yeah, that's good.
Good interview. Good realistic interview. I've been trading since 1996. I blew up in 96. So I was like 16 years old or whatever, but haven't done it since. So just trying not to have any drawdowns now, and trying to incrementally increase the net worth. It's all you're going to do. And it's, you have to like this stuff and get involved and be useful. You don't have to win the US Investment Championship to be useful. Go on X, post good ideas. Some unknown people are some of the people that I find the most helpful, including the people that are known, of course, but be a part of the community, and trade with like-minded traders, like I was saying, and improve that's the only way to improve, really. I mean, it's like having a training partner or something like that. So,
and define your stock trading universe. There you go.
Yeah, define your universe. Like that's what you got to do. Start writing down your ideas right now. But what is it that you're going to realize what you actually are good at trading, what you want to trade. It'll risk manage you better, right? You'll have better risk management if you're trading more liquids, if forcing yourself into more quality. That could be one thing you realize. Maybe you want to do that for yourself. You don't want to trade only high tight flags or something, in spec bios or something like that. So make sure something has, I don't know if you can put sales on that, but that can be part of the universe. Someone's got to have sales. Most of the stuff we trade does. That's not a factor on the histogram, but another idea if you want to take this farther. So all the stuff you require, make sure that you're focused on that.
Yeah, perfect. And sorry, I got one last question for you. Regarding market cap specifically, is there a breakdown between mid, large, small that you prefer, or which sectors and industries are working? That's a little bit more important.
Yeah, I mean, I prefer small caps ripping. Go back to COVID, take me back. I couldn't taste the wine in February for an hour or two. So, but I didn't like shutting down the country, but give me that stock move after that. Yeah. There were a lot of smalls breaking out, going crazy. That's where you can compound your money. Okay. You can put big bets once you start getting going, and smalls that go, 20%. We were even trading some Chinese stocks. As soon as I buy it, it's 20% up. I mean, that was ridiculous. So, small names moving fast. That's the time to compound your account the best, in my view. And you got to do it incrementally and carefully with gains. I mean, you don't just go all in on small caps, but and they happen to be working now. They're just the wrong small caps, like all regional banks and stuff. So that flips around. I'm excited, and we're going to go for it. So we'll see.
Perfect. Well, Leif, thanks again for your time. Always fun talking with you. And I think
thanks for having me.
Golden nuggets here. Yeah, of course. To everybody watching, please go ahead and leave a like down below. Thank Leif in the chat right now, and we'll be right back with the next presenter. Stay tuned. All right, welcome back everybody to the next presentation of the 2024 TraderLion Conference. We have our next speaker, our very own Ross Haber, co-founder of TraderLion. Previously, as many of you know, back in the 90s, he first worked at William O'Neill & Company in institutional sales. Then he was handpicked by Bill to become a portfolio manager. And while there, worked on many special projects, including the 1998 to 2000 model book, along with Mike Webster and Charles Harris, where they studied the greatest winners right there and then, and developed a lot of tweaks to their system, early entries, key price and volume characteristics that they would then incorporate into their own processes and kind of adapt CanSlim to then. So today Ross and I will be discussing the importance of model book studies. Many of the previous speakers over the past weekend have discussed, how important it is to go back, study a setup, do a deep dive, go back and study the greatest winners and look for the characteristics that they shared. And this is basically a step-by-step walkthrough of how Ross does just that every single year, looking at the greatest performing stocks. So Ross, thank you so much for being here. Please welcome him in the chat, and we'll go ahead and dive right in. Ross, great to have you here.
Thank you so much, Richard, and thanks everyone so much for being here. So we're going to go ahead and dive right into what is a model book, right? So we're going to be talking about model books with regard to how I've made mine, my methodology, like Richard said, finding the greatest stocks over a specific period in the stock market, and then trying to see what's going on during this period relative to others, tweaking some rules, largely entry and exit, right? It's always about refining and having that optimal spot to buy a stock and set your sell stop with as little thinking as possible, right? That's the idea behind it. It really helps you hone your rules. It helps you get a feel for the art of the market, right? The more you do this, the more you realize what stocks are doing during what periods, okay? So for those reasons, it is winds up being an incredible reference tool, not to mention the process itself. The more you do it, the better you're gonna get. It winds up being a very personal thing. So you'll see as you define your study and you do your first one, you'll have some aha moments, you do it again. And that in addition to having just a phenomenal reference that builds up over time historically that you can go back and compare to, it's a must do if you're a trader. I don't care if you're day swing or position trader. I would say that. And as you can see, so for my process, like Richard said, I'm looking for the best stocks and the best groups with the best fundamentals that went up the most for the year. I want to see how these stocks are acting, how many bases did they build, all of these things that are important to me with my entry and exit process. And it may be you can notice breadth over that period, confirmation, one group to the next. It's all of these things, all the way down to the nitty-gritty of entry and exit. So how do you do it? That's what we're going to get into, from starting with our large lists to our first blank chart. How do we draw the lines, why we draw them, and give you an idea of how and why at least a model book from my perspective, for my methodology, works. And then hopefully you would be able to then draw from that and apply it to whichever way you do yours. So that's the idea.
And jumping in just a second, just because I think this is especially useful if you feel like you're kind of stuck, and you can go to the next slide. But if you feel like you're stuck or you're missing a lot of the best opportunities at the moment, maybe you didn't catch NVIDIA this year, or SMCI, you saw other traders on Twitter, catch those really easily. I think it's especially useful in those circumstances where you feel a little bit lost, or you're just kind of very early on in your process and still kind of learning, because it allows you to build your own chart eye. And, there's no replacement for actually trading and learning, live, making mistakes that way. But this is kind of the second best thing, where you can study, learn the characteristics that then you can recognize in real time when the market's developing, to look for and find those big winners just as they're getting started on their moves. So that's why to me model books are so important. It's the best way to practice. And Ross, I know you want to talk a little bit more about how helpful and impactful the 1998-2000 model book was for you, because you were kind of early on in your process at that point too. You were just a few years into working at William O'Neill and Company.
Absolutely, absolutely. And so, yeah, and I mean, you'll see here if you've read through. So a lot of, I would say this, you know, so sitting in my office with Mike and Charles, I will say a lot of us, like, we had the same questions at the same time. Why aren't we buying here instead of here? And just stuff that you know, was going to enter your head, and you make note of this along the way, and you go, well, here's, you start asking those questions because it's different than the rules, let's say, that you learned from the book, right? And this is how you start thinking and tweaking and look, right, comparing. So that was actually kind of the beginning of, you know, my whole thought process to early entry, right? Was working on this model book, followed up by incorporating Stan Weinstein into my process, which gave me, and we'll get into this further. And then I basically, you know, when I was running the hedge fund in New York, I'm a big believer of putting what observations to work to see if they work. I don't care what kind of genius you have run a back test for you. There's nothing like buying 100 or 200 shares and testing an observation. And does it work? Yep, it worked that time. And you'll know if it works or if it doesn't work. Your P&L will tell you in a hurry. That I promise you. And to be quite honest, I have found that to be an extremely effective method for me when I notice make an observation that seems to be very strong. I will just go test it. And that is how I slowly, and the reason I had to do that was moving into hedge fund land. I was, you know, we started off with 120 million on day one. We grew it pretty quickly. And so, you know, as you get up to over $500 million assets under management, and you're running that on margin, you're buying on
just buy the pivot
like we did in this market, and paying up for extended names in the wrong environment will destroy you. I mean, you can't. So what works in one environment doesn't work well in the next, and that's hard to get used to, especially when you've gotten. I can't to this day, almost 30 years later, I still have that. I still have to like tell myself it's extended, don't chase it. It became it's ingrained in me to, you know, to still want to buy a stock that's up $6 above its 10-day moving average, and it's, you know, less than $100 stock, because it came to a point, you know, when I was learning that if you didn't do that, you missed. And that's certainly not the case now. Now it's a game of patience, right? It's a much choppier, less smooth environment. And if you try, I can almost guarantee you the optimal buy point here, if you were to go back and look at where I paid for stocks, if you were to apply it exactly to the market today, I'd be willing to bet that those would be some of your best short entries on the planet in the market environment currently. And I'll just go on to one more thing besides, you know, entry and exit. It's, you know, it's these environmental things like I'm talking about. You will also learn that even if it's a smooth uptrend that you're back in, depending on the time, and I'll give you a perfect example, 2009, after that 2008 crash, all the garbage, all the stuff that got beaten down 70-80% rebounded. Nothing recovered, but it rebounded sharply. So if you were into buying the garbage off the bottom, that is what performed best in 2009. It was not a year for William O'Neill canned slim trading. It was very difficult if that was your style, and yet very frustrating because the market went ripping straight up in 2009. And if you were trying to trade canned slim, you did not have an easy time. In fact, I did better in 2008 than I did in 2009, which you won't hear many people say. So, and all of that, I will tell you, came from being, and I will say forced in a way to, you know, do research projects like working on model books and, you know, teaching the workshops with Bill, which, you know, thank goodness and thank you, Bill, were some of the most valuable things to my entire process and learning. So we'll start here. What did I learn from Bill during this period? What I did learn from Bill is, so if you focus strictly on the best of the best, right? You want, when I say story, you know, what company is changing the way we work, live, communicate, what's making the most money, of the big funds who are buying these companies, are they continuing to accumulate shares, and what kind of long-term track records do they have, right? I mean, we're essentially riding their coattails. and top relative strength, right? We're looking for the strongest names. So that is, what I'm typically that's the key focus of any model book I'm working on. And then, once I'm sure that I'm looking at the best of the best, the soundest companies that, the best mutual funds and hedge funds on earth would put their money into, that's where you're breaking down and developing your list to study. And you'll see as we move up, Bill tends to, and there's nothing wrong with it, he's going to go for the best of the best. You will have fewer choices, right? Because you are going to eliminate anything that has a flaw technically. You're going to eliminate, even things that have flaws fundamentally, where you might have like the triple digits and then an off quarter, right? You're going to get in the least trouble that way, right? You'll hear many people stay away from the biotechs. And this always made the most sense to me. When the biotechs are, when the group is really working, there's always going to be, now in that group, the reason I refer to it, and we'll get to that further, is just because in general, many of those stocks don't make money. However, they can be extremely powerful. And so that was just, anyway, we'll get to that. That was one of my key takeaways, that I pulled out, here's what Bill does. Bill, so let me get back to, and I'm all over the place, why I got there. There's, I think, close to 800 names in the biotech group. However, let's say a very small percentage make earnings. Bill will be the first one to tell you, stick with the 2 that make money, that have increasing sponsorship, that have, growing earnings, that have all of those things. And the other 7, let's say there's 760, I'm making it up, and there's 3 that meet that actually have a drug that they're selling that meet. All the rest is garbage. You don't need it, and is right. However, if your style is to, take on a little bit more risk and, figure out a way around it, develop rules around, and so that is, I guess, why, what I learned from Bill versus what we'll get into, what I've taken away from model book building. So
yeah, just adding that to that, Ross, he would be extremely heavy on just 1 or 2 names. So like his requirements were just the strictest quality, and he had to know the intimate details of everything, versus
Correct.
your style, you're still very concentrated, but you might go into a handful of names, a little lesser size than he would go all of his account into 1 or 2 names. So
that is the very important point you make, Richard, right? And he operated mostly on weekly charts, and he put all of his money in 1 or 2 names. There was no
cowboy
performance boosters. There was no, okay, I'll buy a few smaller, less liquid names. That was for the rest of us to do for him. He put all of his money in usually 1, maybe 2 highly liquid names, and we'll get into what those look like, in terms of personality, which was, another one of those things that I learned over time. But here, let's back up to the actual process, right? So first, you want to define what is the objective of your model book. What are you trying to do, right? I'm looking for the best stocks in the best group with the best earnings, with the best performance. You might be looking for exactly the opposite. You may have made an observation that when I buy, an entry exit observation based on, I'm going to make up a simple one, a MACD cross off the bottom over, on daily charts over a particular time frame, or in specifically 2 groups of a sector and a very strong bull, whatever it may be. You want to define that and then understand, what are the best situations for that particular study or whatever, right? So for me, I'm looking for the highest performing stocks, let's say with the fastest growing earnings. You might be looking for the stocks of a particular liquidity in a certain group during a particular period that, at whatever it is. And when the MACD crossed and you look at the ones, let's say the top 20 or 30 that were like, holy cow, these were the models for the year based on everything that I look at, and then study those in the same way. But you want to have a very relevant list of stocks. And again, we'll get into how I pare down my larger universe into a smaller list, right? So time period, that's part of your objectives, right? So you want to be clear on that, whether you're studying weeks, months, or years. Yeah, and I guess that
Cover that, yeah.
basically we've
Yeah.
gone through it here. So
And
anything?
just to give some more examples, you could be studying earnings gaps, you could be studying gap downs, you could be studying when we undercut the SMA or the 50-day moving average and pop back up. You just want to be very specific in that criteria because one, it's going to allow you to be a lot more selective, and the study's not going to blossom into 3,000 stocks that you have to go through, which is very valuable, but you want to do it in bite-sized pieces, especially if it's your first one. So keep that in mind. If it's a 3,000 stock project, it's never going to get finished. Like, you're going to keep on going through, and there's too many to go through. You got to wrap your head around 20 stocks max. Probably your first one could be 5 stocks. Just go really in depth. That should be the way to go. But yeah, whatever special situation you want to study, go for it. You can tailor the process that Ross is going to speak to that. And for him, the criteria he's looking for is top performance of canned slim quality stocks over typically a year or a cycle. So just want to clarify that. And then you can use screeners like Deep View to look for different situations that then you can, build kind of a master list that then will show you how to pare down. So yeah, Ross, I think we can keep going to the next slide.
Gotcha. And I was thinking, so yeah, I think maybe we could have put those in better order. But before we do that, then I
Spoke to
kind
this
of
a little bit. Yeah.
Yeah, I did kind of I jumped ahead. We talked about this in the slide or two before, right? So just Bill's original perspective when I was learning. If it wasn't for him, I would know none of this. I mean, I can't tell you what. I mean, so and let me make it clear. I built it with Mike, Charles, and Bill. So we would work on it, but everything had to be approved by Bill. The final list, the final everything. And so this is, also how I was lucky enough to be able to make these observations, what I was thinking, what they were thinking, what Bill told us to do, and then the actual observations we made along the way and, over the last 20 plus years, right? So, yeah, so that, I started with some very basic canned slim objectives, and the more model books I make, the more I come up with, the more observations I make, the more I refine my rules, right? So, starting from 98 to where I am now, I could probably count if I really tried, but I've built more model books than I could count right now off the top of my head. That's for sure. I can say it's an extremely valuable process. Start with 5 stocks, but figure out something, start with 5. So, it's like getting back to the gym. If you do try and do too much at first, it's never going to happen, right?
Get hurt.
Yeah, take it easy on yourself. Go make it fun. Make it so you want to do it again.
Right.
That's all so again, determining the scope is like we just said, your objectives, your time period, exactly what you're looking for. And we're going to go through now, like what Richard said, and I'll start. You'll see on a following slide. I always start with just the Google search, top performing stocks during XYZ, right? And then I'll take it from there, and then I use Deep View to break down the market. There's tons of software that you can do it, paid, free. But anyway, and then I will hone in on my list from there, right? And the bigger the period, right, from 98 through 2000, I mean, what a bull market. We had a ton of stocks to really narrow it down to. So I learned a lot from that process with Bill, whereas, there are much thinner bull markets than that, where, it's hard to come up with 20 or 30 stocks, whereas, it was hard to minimize it to 20 or 30 in that particular time period. Then, so once you've got your list decided on, then comes the nitty gritty, right? Opening up your charts, and what do you do with them? Where do you draw your lines? How do you start your study, right? And then, that is the process of building the model book. And I don't, and we can discuss some of this studies that can even be performed after that we don't cover. I'll just mention. So again, like we were saying, I should have clicked ahead. Start with your basic Google search. For me, again, my my routine is every day, all day, every day. So I have endless lists. So to be fair, I go, but and I keep it in my deep view. I have lists created. So if I needed to make, if you're Ross, I needed to make a model book for, you know, January 1st to July 23rd of 2024, I could put together a pretty good list before I went to sleep tonight, just because that's all I do all day, every day. But had I been starting from the very beginning and I only look at the market once, you know, every couple of weeks, because, you know, that's what my life has time for, or less in many cases, right? Anyway, you get the idea there.
Yeah, and we also, like, in the chats that we're in, we also kind of contribute tickers too. That's another way that you can kind of source ideas. Just wanted to add that in. You know, Rye, you know, myself, we've all got, you know, stocks we've been focused on, and you know, when you kind of are starting the process, we kind of throw lists at you, and then you kind of, you know, use that and see what you want to include, what you want to throw out. So that's another way that you can kind of get ideas, is just, you know, have a group of friends and do it together. That's another way to make it more fun, right? Is do it as a group.
Yeah, I mean, there's finding the stocks really shouldn't be the problem. I mean, with you know, a simple Google search, even guiding you to the software to help you hone in some more, that shouldn't really be an issue. But it is important to get, you know, the right list of stocks, especially when you're doing, you know, a larger study. When you're going to focus on just 5 stocks to get yourself started, pick the 5, you know, that best match your objectives and go. Don't worry about what you're missing. Get the process underneath you and feel it. That's all I can tell you, is from the larger list all the way down to completing your book and everything that happens in between. That, I think the best 2 words for that is do it. Like, feel it, feel what that does to your brain after you go through it. I think it'll give, it will propel you to want to do another one. So anyway.
And then this is the hard part, you know, getting that final list.
Whoops, and it looks like I left a little mistake on the slide there. Sorry, everyone. But so again, and I kind of covered it before, how big your list is going to depend on your study, how long the period of time is. And it's not always going to be minimized by your period of time. Again, if I'm a day trader, but let's say my time frame or time period, I'm now honing in on 1 month of the stock market, right? Let's say we look at it in months, this month versus this month versus this month, and I want to see how 3 entire sectors or 3 entire groups did that. Now I've got more stocks than I know what to do with. Now I've got to go, okay, which in those lists of you know, those groups are the most important? How would I want to sort that? You know, for me, if that was the case, I would want to sort by what are the, you know, highest relative strength with the best earnings, and liquidity is going to play a strong part, and that basically all ties into the sponsorship, right? Big funds can't buy thin stocks, right? So I'm just, on my mind, that is how I would, you know, if I had, again, if I was a day trader and I was looking at several groups, but it wound up being hundreds of stocks, depending on my, you know, if I was a short guy, I'd be looking for, you know, possibly the low relative strength stocks that have all run up X%, have formed, you know, X, depending on what your strategy is. And, you know, it can't hurt to pick the 5 best ones that match and start there, but start somewhere, keep it small. You will feel the value of it when you're done. Yeah, so for me, you know, very simply, I said it all, but if that didn't bring it down, you know, for me, if it wasn't liquidity, price, relative strength, I have a list of stocks characteristics based on my objectives, based on my study, that will help me pare down a list of hundreds to, you know, 30 or 5, if that, you know, to make it relevant. Once you've got your list, now you open up ABC stock, right? You got a blank chart in front of you. What are you looking for?
And just to jump in, I know we're just kind of showing the theory here. We'll kind of give examples later on. So we're just kind of talking through the process, and then Ross is going to actually walk us through a few examples and point stuff out on charts. So yeah, stay tuned for that.
Yeah, thank you for that, Richard. That definitely clears it up. So yeah, don't get worried. Yeah, that we're not looking at pictures yet. We're just going to discuss quickly and then go through in detail, right? So when I'm looking at a blank chart, what are the things that I'm looking for that are relevant to my study that are going to help me understand where optimal entry is, and where a stock is and its overall cycle, all of these sort of things. So starting with, William O'Neill, Can Slim style trader, base stages are very important, right? So early or late stage, obviously, I know in my book, I'm picking stocks that have gone through an entire cycle from early to late stage. Right. But again, you want to be aware of what this, depending on your objective, what your book is. These are bigger picture things you want to be aware of, right? The larger cycle, bigger picture. And I move down to the smaller, right? So what is a launch pad? I'm looking for. So that is I don't want to call it a setup, but a specific thing that I look for that happens. It's one of my observations. I have it there where all of the moving averages are converging in a tight bunch beneath a stock's price as a potential right side begins. This is something that happens around bottoms. As the indexes do it, stocks typically do it in groups, right? So for me, this is one of the key things that I'm looking for on charts. It's also it happens, it can happen at the bottom of any base, but in general, that is just about how the earliest entry points on any model book stock, since I have developed this way of entering stocks, they always start in this manner. So I now go look for launch pads to form. Okay. And that'll make more sense when we look at some stocks. So relevant trend lines and other logical areas of support. So relevant trend lines, meaning the top channel lines, they can be diagonal channel lines, declining tops lines. It can be channels, up the bottoms of a stock moving up the right side. Yeah, so all tops of bases, bottoms of bases, prior highs, prior lows, but yeah, trend, resistance, support, and most importantly, pivot points. And you're going to see, again, we're going to go through and I'll explain how I go from blank chart to drawing those lines to the the detailed labels. Right. And then once I've got and so what I do is, and to be quite honest with you, I will start by drawing what I see as all of the relevant pivot points, trend lines. And then I said, right, so when I look for confluences, right, meaning those are where, let's say, a moving average, a trend line, the top of a base, and, three averages are all lining up. That is going to be a significantly more level than if it was just, let's say, whole number support, where we've gotten support a couple times and that's really it, right? There's going to be a difference, and it doesn't mean one is absolutely going to work and one isn't, but the more things you have lining up at a particular area, in general, the more, right? And again, that's something that becomes part of the study. This is something that I guess we have learned over time and I continue to watch for, and it's still the case, right? Where I have a big confluence of indicators, or significant, or not indicators, but indicators pointing to a significant level as significant. The more that are there, the better in general. And then from that point, as I go through, so for me, I have a very good idea now of what the fundamentals look like. Stock in an uptrend is pretty easy to focus in on, especially when you're looking at a year to three, right? You can look at a weekly chart and know, right? That's not very difficult. But so once I have what I think are my relevant key pivot points and logical support and resistance areas, I then look and go, okay, where is the earliest point based on this chart that I could have entered this stock, and based again on my trading methodology, assuming that I employed my normal sell stop rules, assuming that where would my sell stop be, where would it, and I then, I'm playing Monday morning quarterback here, right? I want to see what would have been the optimal spot had I known in advance where to buy and what would be the perfect sell stop. So that, and I will tell you this, that in and of itself, not only are you ultimately doing a study to figure out how that lines up across a group of stocks, it's also going to give you a great idea on how you, right? It's really for you. This is your model book, how you would have been, because you're looking at it going, wow, this was the perfect buy area. I know I bought it here, or I was supposed to buy it there, but this really is the perfect spot because look, it worked, right? It's working. Here would have been my logical, my tight logical sell stop.
What I'll add is when I'm going through this process and analyzing and labeling a chart, as Ross said, you look for the ideal buy point and where you'd want to enter, but I always kind of try to take it a step further than that and think about, all right, if I want to enter here, how would it have gone on my radar? What screen could I have run every single day to look for this type of stock? Was it, a big move up on volume? Was it a daily closing range when the market was weak? You can look at it that way. So you're not just kind of looking and saying this is the ideal trade, I'm going to magically get that every time. You're kind of taking it a step further. It's like, going forward, how would I get this type of setup on my radar? How do I find launch pads in the future? And then you can incorporate that going forward, build some rules around it. That's all I kind of wanted to add, Ross, and I think that's pretty important. Yeah.
Yeah, and I think that's exactly where my brain was stuck. But yeah, because then you're showing yourself based on that, over and over again where those optimal spots are, and try that. Then you use to take forward into your trading, and you keep adjusting like that. Cycle after cycle, book after book. The major rules are going to stay the same. They haven't changed yet in any way, shape, or form. However, this is what's going to allow you to really hone in on your detail your process, right? Know exactly based on your eye, what works for you, the observations you would make. Like Richard's saying, how will you, once you've got down what that optimal spot is, how are you going to find those setups again when you find a similar stock in the future? Yeah, and that's exactly correct, because again, for me, after enough model books, I'm looking for, to be quite honest with you, I'm looking for leaders that not only match all of the criteria that we've discussed, but I specifically want ones that are liquid, that respect moving at like key moving averages time after time. They're the easier ones to trade. I've noticed, in a market where there's a plethora of stocks to trade, I'm always going to gravitate towards the one that trade in nice tight ranges, respect key moving averages and other logical areas of support, just because those are the stocks you can trade with the least aggravation and the least thinking. They follow your right. And so I'm developing rules around those. And I've realized that since the late 1880s until now, that same thing continues to happen. And yeah, it might switch a little bit. And, this is probably, definitely the way I continue to analyze what I'm doing versus what's working, what has worked in the past. And it really helps me tweak my process along with, doing post analysis. But doing the model book studies are key. Bill doesn't keep doing what doesn't work. I've never seen a guy cut faster what doesn't work. I don't care what it is, from losing stocks to layoffs in the firm. I mean, the guy is way ahead. He's super proactive. So anyway, again, I lost my train of thought there, Richard, and I'm really sorry.
Let's jump to the examples and just say jumping to the examples.
Okay.
And we'll do it that way.
All right. So jumping to the examples, let's actually take a hard or a detailed look at what's going on here, with some pictures in front of us instead of just imagining like we've been doing till now. So NVIDIA, so the three stocks we're gonna look at, are familiar with us and you're a growth stock trader, you're going to be quite familiar with. They were three of the best stocks in 2023. So NVIDIA, Abercrombie and Fitch, and SMCI, right? So we've got two semiconductor stocks and one apparel stock, retail clothing and apparel stock. And I like to show the mixture there. You don't have to always be top technology stock to necessarily be a top performing growth stock. And yeah, so anyway, that's how we got our mix there, right? I think we all know that semiconductors have been the big leaders, but we thought Abercrombie was relevant to this presentation. So for starters, right, I want to understand sector and industry, right? So in 2023, semiconductor equipment were your top performing stocks. NVIDIA happened to be one of the top semiconductor stocks, if not the top semiconductor stock. So we've got a little description about what they're doing. The NVIDIA is one of these big winners that is clearly disrupting the industry, right? They, from what I understand, and I don't read it every day, they've basically got a monopoly on the chips that people need, although, you know, that can change with time. And I know there are companies out there working on their own chips. This has been the monster in the group, and it continues to be for now. So we've got, just wanted to show you here, these are quarterly and annual earnings and sales, just an example of what I'm looking for there. So on the fundamental side, you'll see when we start moving on to the charts, this is some of the data we've got included with the price and volume. And so first, what I like to do is take a look at a weekly chart, okay, to get a look at the big picture over time, right? You can see here we've got just a little bit before 2021 to a little past the beginning of 2024. So you get the forest for the trees look that you're not going to get on the daily chart. And so there's nothing labeled here. This is just the big picture look and some important fundamentals. Now we go to the daily chart, and this is where we're going to start as if NVIDIA were blank here. How did we arrive at these lines, these labels? Why is any of this important? Where? So let's assume this stock was a blank chart. Like I originally said, the first thing I will do is, you know, we've already looked at the bigger picture, right? So we know this is the bottom. We're moving up the right side. As I mentioned earlier on in the presentation, launch pads, and I don't have them circled here, but we've got a very loose launch pad situations going on here where we've got moving averages crossing, but it's not anywhere close to the launch pad, the nice tight launch pad setup we've got going on here. So I just want to point that out, right? So that's what's pointing me to this area near the bottom, not to mention, you know, we already looked here and we know we're at the bottom. So we're starting there, well aware that NVIDIA is, you know, is the biggest winner in the strongest semiconductor group here. So I want to know, what are my important lines? To me, important lines are prior highs, declining tops trend lines, which are these diagonal lines, and pivot points. We've got base pivots, which those of us who trade the canceling methodology are all familiar with from Bill's book, right? If this were a proper cup and handle, which it's not, this is a consolidation pivot, but assuming this were, right, that would be a base pivot, the high of the handle. In this case, it's a consolidation pivot. Again, that is one of those things that was developed out of model book studies, right? And studying other model books and combining it with Bill's and Stan's methodology. But that is where we're starting, right? So starting at the left side, we can't see it here, but I know this is connecting to something relevant back here on the left. So my point is, and you'll see here, we've connected in at least 3 points, right? So the point is this is a significant, relevant, long-term declining tops trend line, as you see there, right? So we're pushing through, but again, we're doing this. This is Monday morning quarterback. We see that didn't work, right? So maybe we want to say we can go back and try and figure out were there flaws there. But that's for another discussion. So here's my first big declining tops trend line. Then as we move up the right side, where are my relevant trend lines and pivot points? So as we move up, right, we get the pullback, we shake out under the moving averages. And now we've got a new or a much tighter launch pad setup in the works here, right? We're now making higher highs, higher lows. We're turning back up through the moving averages as they've tightened up and began to converge and then expand to the upside just underneath the stock's price. And like I was saying, 9 out of 10, if not all of my model book stocks start out like this, right? And that's nature of the beast. I'm looking for stocks that have gone at least, 2 to 3, if not 4 or more base stages, right? And for those of us who aren't familiar, and I'm going to keep it very quick, Bill O'Neill counts base stages, base 1 being that first, bottom base. Stage 2 would be your next base after the bottom. Stage 3, stage 4. Stage 3 and 4 are what we qualify as getting into late stage and much more failure prone. So that's, again, one of those things that we're aware of, pay attention to, and see how things may change or develop around that, right? Our stocks now doing 5 and 6 stages more, these are things that you may make an observation of, or is it just the same thing? Your best bet is, putting your big bets on those first stage 1, stage 2, and then you've got to still be much more careful stage 3, which is how I continue to play things. I'm a big, I do it like I'm playing blackjack. I need a hot deck. If I'm not sure the deck is hot, I back away. So starting at the very bottom here, right? The first thing that sticks out to me, and this is going to be easier to me because it's something that, I guess has popped up to my eye over time. These early up the right side entries or consolidation pivots, I like to say, right? So we know from looking at the weekly that we've already got an uptrend here. So
you're looking for spots on the daily that you can enter and manage risk after you've identified that longer term uptrend, the launch pad, that consolidation pivot right over the launch pad. That's probably the ideal entry right there. You've also got maybe an outside day there. If you can point that out, Ross. Right there. Day. That's probably the ideal entry through the consolidation pivot. And that's before the base pivot, which is probably 10% higher there. But it's a spot where you can manage risk super easily. Saying your stops at just below the moving averages or below the consolidation. I know further on the additional buy points, you like to use the 10-day moving average a ton. So maybe you want to point that out as it keeps moving higher.
And that is a personality, right? So I'm going to choose stocks that respect those key moving averages. This is there. It's not right. So not only are we respecting prior pivots, but notice you got the confluence of a prior pivot roughly and that 10-day moving average. So, and it proves it to you. And when it doesn't hold the 10-day, it pulls into the 23-day and gets support. And look, you get that big reversal off the top, doesn't hold the 10-day, get supported. And it starts to show you its personality. Very often, this personality will be reflected on an uptrend on the left-hand side, and you will see it continue. So that's a big takeaway from these model books. Stocks have personalities. Those personalities can change, but I would never assume a personality change until the stock's personality actually changes. I've made that mistake one too many times, buying a whippy stock thinking it was going to break out and all of a sudden turn into a tight liquid trader. And that can happen and does happen, but you'd rather be late, a little bit late after it happens than early before it happens. That I've made that mistake. I like to, and I'm going to be honest with you, I like to anticipate trades like the anticipation trade. This is something I talk about in our, a course that I'm working on. But I mean, those of us that are familiar with just whatever breakouts, Oliver's wedge pops, you got wedge pop after wedge. Am I right, Richard? Here,
yeah, wedge pop off the bottom and then reconfirmations, kind of the first pop through, probably right before the launch pad pivot that we pointed out. That would be the wedge pop. So the range off the bottom there, that first consolidation pivot, the breakout through there would be Oliver's wedge pop, and that's something that I look for when I'm annotating. I look for the wedge pop, Oliver's cycle, pullbacks to the key moving average, which this one has multiple ones to the 10-day, as well as the your purple line, which I think is either the 21 simple or 23 EMA. So you key in on these things that show up every time in these liquid leaders, and that's what you kind of want to train your eyes to show. The tight ranges, the reconfirmations up from the ranges, the orderly pullbacks to the moving averages, the strength off the moving averages after the pullback. That's pretty much what you're looking for, Ross, and that's what you're trying to annotate here as you kind of go through here. And maybe we can move on to the next example after, unless there's anything else you wanted to cover here.
No, it's the same thing. And so you'll see that stock, right? We ended here, we'll pick up here. And this is its next run. And again, you can see those same personality traits hold. And what do you know? When we finally, for the first time closed, gap down close below that 23-day moving average, sold, right? And I mean, again, in general, I will wait a day. And that's why I say sell stops ultimately triggered, because you didn't close above here, right? You were 2 days below. And that's just my rule, right? Like Ray says, there's a point where you make a point where you say your trade is wrong, your sell stop is your sell stop, you don't move it. There's no moving sell stops around that. So that being said, you've got to consistently follow the same rule or it doesn't work, right? So my rule is second day it closes below that average, you're out. And like clockwork, it breaks the 50, ultimately catches support at that 65-day exponential, works in a similar way to what we saw before. Stock would break the 10-day and stop at the 23 or the 21, right? The 21 is the cayenne line, the 23 exponential is the purple. But you get you get out of the way here, and then you wait to enter again, and you see you're gonna wind up buying back just a little higher than you wind up getting out of the way. And getting out of the way here and waiting for reconfirmation here, and ultimately you see what happens. You're going to get stopped out. That's what your sell stops are for. But this keeps you, sure, you could have held and just ultimately had a sell stop at the 65. But based on the stock's personality, when it breaks that 23-day, second day in a row, you're selling at least half, if not all of your position here. And then it does it again below the 50-day. At this point, second close below the 20, second close below the 50. I don't care what happens anymore. At that point, I don't want typically, that black line isn't magic. And if I look back to the left and let's say I saw the 65-day to be just a key moving average for NVIDIA in and of itself, right? There are some stocks that are going to respect that 65 exponential, which is this orange line, much better than they will the 50-day simple, this black or gray line. And in those cases where the stock tells you, I respect the orange line, not the black line, base your sell stops on that. It's that simple. The personality will remain the same until it doesn't. And that has worked really well for me following that, personality trait rule. And it's something that I've model book after model book seems to hold as a really solid rule to follow consistently.
Yeah, there's a point to add, there's a point where the trade is over for you, where it doesn't necessarily matter if it continues higher after that point. By your rules, you should be out, and then you could enter on the next setup if it resets up again. But for the purposes of model books, you want to try to follow your rules and say, where would I have exited in the moment? Did that make sense within my rules? Maybe you have to adjust your rule after studying a bunch of stocks and say, that rule doesn't really make sense anymore, but you have to kind of follow your rules so you have a place to start. And this one, you exited it base for another few months. It did go higher, but then it pulled back. And kind of there are multiple spots along the way where might have been a warning sign. You note that heavy volume negative reversal, and this is kind of a more of an example. We don't want to get into the weeds of NVIDIA specifically, but heavy reversals on the upside, as well as big upside reversals at the bottom of bases. That's something you'll notice over and over again in the big names throughout their trends. The heavy reversals also often mean there's going to be a few weeks of basing, which ended up happening with NVIDIA before it had that another leg up, which we know. And then big upside reversals at the bottom of bases. That's gonna be a point where maybe it's the low for that cycle and it's ready to push up the right hand side. So those are some key things to key in on as you're annotating the charts. Anything else to add here, Ross, or do you want to move on to the next example here?
Yeah, no, that's absolutely. And I guess the only thing I'm looking back at going, the only thing I wish I had done here is, as you know, maybe pointed out the more relevant launch pads right down there in our stage one off the bottom. But here, as we get more extended, let's call it stage three, we got the big reversal. While we do have one here, right? We know we're now stage three breakout. Look,
It's
that
lower
breakout
quality.
just reversed and failed. That makes the, so if it doesn't hold this, that's telling you something. And it also tells you that even though that this is going to be less significant in the stage three base after a big run than it was back here, when it was 153, then up here when it's almost, $500, stage three base more or less. And so so while you do have that, now again, I think we all know what happens because we know where NVIDIA is from here. And again, we've got a
Launchpad, yeah.
Launchpad set up
and that's
there.
after more basing. That's after almost 5 months
Correct.
of basing. So what you were pointing out is that it's kind of a stub your base stage three, and then you just
Right.
kind of see those failures. It just needs more time at this point, and
Yeah.
obviously it does set up again.
This big undercut right here, that undercuts everything. This is something that I know when we used to look at all the charts with Bill and we were going back doing the Monday morning quarterback thing to apply to the future. I can't tell you how many times he would point to the shakeout undercut and just back to the left, everything that it undercut. That was kind of your in retrospect, that was your reset bar right there, buying in here. And you could even could have played this as a bit of a range undercut and rally trade like Ray does and bought it on the second day and look for that set, the buy, hold and hold that Ray uses. There's a perfect, that would have worked perfectly here and you'd be in before the averages even profit. So anyway, let's not get into the weeds and the details here. We're talking about how to
process.
Yeah. So
And
Abercrombie and Fitch we'll do next. We all know what Abercrombie is. One of the more popular stores at the mall, which I don't think I've been to in over 20 years. But anyway, they seem to have a very well-liked, popular clothing, I guess, right? And how do we know that? Just take a look at their quarterly earnings and sales, their annual earnings and sales along with their estimates. And, there's really no better indication of a stock than the stock itself. And here you go. You can take a look at that, weekly chart over the longer time period. So we get a feel for the forest for the trees, right? We had a prior uptrend here coming into 21. So we've got a big, long base forming here on the weekly. And it's a very similar thing to the last time. We have that loose launch pad, things try to get going. And no doubt all of this volume's below average. So we come back into support and now we've got that big volume, right? That giant push. And I don't know what the news was here, but it's clearly after earnings, unless I have a screwed up chart here and earnings. But regardless, we've got a news catalyst here, whether it be earnings or something else, and that big outside bar to go along with it. So this is where we're going to be starting on that daily chart, right? As the stock begins to form the right side of its base before it actually breaks out and goes on this super tight organized run on its weekly chart. So that's what we're looking at there, right? With some fundamentals highlighted that are important to the methodology. And then we'll go through on those daily charts. And again, assuming this was a blank canvas, like I had just discussed, here's the launch pad that kind of fails. Like on our prior example, it's kind of loose, doesn't really work. So we come in, we undercut, form a new bottom, right? Start building the right side. And again, you can see where the potential pivots are along the way, where your potential declining tops trend lines are. So that's the first thing I start doing. I would say I probably start with pivot points starting right at the very bottom. And I will tell you this, I might even start drawing one here, here. In some cases, I will start with too many and have to remove some. In some cases, I will start with not enough, or I will not realize that something was relevant when I was first drawing them. And as I'm labeling stocks, looking for, the most relevant tight logical sell stops for a potential entry, I'll realize that I missed an important gap or high of an important candle, low of an important candle, or whatever it is. So remember, you're not going to get it all perfect the first time. You're just trying to mark those most important spots, right? Long-term declining top trend lines as they're broken on the upside on big volume. You want to watch for that, right? Launchpad setups, you want to watch for that. Potential consolidation pivots. This one was irrelevant to this trade, so it's not drawn. And to be quite honest with you, I probably, going back, if I wanted to make it super clean, I could probably remove this line and another. But you get the idea. You want to lay down the basic lines, your basic circles, mark the important price and volume, highs and lows, and then start playing Monday morning quarterback, based on your methodology. What was the earliest spot that I could have, entered the position based on where earnings were, all of my rules. And if I entered there, where was my tight logical sell stop? How tight was that? What are my rules, right? So for me, my max sell stop, which I try to almost never get to, is that 7 to 8%. For me, I try to keep it 3 to 5, 2 to 3 ideally. So for me, once I'm getting near, I don't, when I'm making the model books, I try to keep it 5% or less on the sell stops, knowing that my max is 7 to 8%. I like to be inside of that. I'm always looking through the lens of risk management. That's the way I do things. So that's what I'm doing. So once I drop my lines and figure out where I think my ideal buy points are going to be, I then have to be able to find legitimate ideal sell stops based on my methodology. Otherwise, you don't have a trade, right? And that's a big deal and not what we're discussing now. But if you've got an entry point and no tight logical sell stop, your setup is no good, right? If you don't have a tight logical sell stop for that entry, it's not a good entry, especially if you're playing in hindsight, right?
Yeah, and just to kind of share kind of what I'm seeing with this chart is before the launch pad, a little bit to the left, when it kind of tightened up at the bottom of the chart there, Ross, if you could point that out, there's a lot of upside reversal bars off the bottom, even before that. So that's something that I would note. It looks like accumulation is coming into it. It did have a severe drop after earnings. That's a lot of red volume there, but it couldn't push lower than that. And then you've got those upside reversals coming in. Then, looking at this chart, how I would look at it, I would think about, again, when would it come on my radar? The launch pad, it would show up on that screen for me, but then also on that earnings gap, a big, I run a screen pretty much every day looking for a big gap up on volume. It would definitely show up on that earnings gap, and then I'd be waiting for a tight area to enter there. It kind of undercuts where I usually like to operate around the HVC. It pulls back a little bit further, Ross, if you could go up and to the right. It pushes up on earnings, goes sideways, and then kind of retests that HVC, but undercuts that 21 EMA, tightens up for a few days. There's not much volume there. And I look for the expansion up, and that lines up. We were talking about confluence. It lines up. Where does it line up? With that base pivot all the way on the right-hand side, or left-hand side, sorry. Yep. And then, that's kind of how I would label this chart and what I would be kind of looking at to give my perspective versus Ross, more of a position trade type interpretation. Ross, I know there's more examples to cover here. Was there anything else on this chart that you really wanted to highlight for everybody?
No, that's really it. I think the most important part is for me trying to express why I'm putting lines where I'm putting them, because after that, doing the analysis is like the fun, easy part. I'll call myself out on them, as I look at this in if I was just trading this in my personal account, I think, or my, one of the accounts I trade, I want to say I'd start it right here versus that 23-day exponential on a closing basis. And that's, or I'd start buying in here. But anyway, that's my relook at this. So if I were to go back and, edit this, I would note that in here. I actually like this for, on that big spike after. But anyway,
Yeah,
that's
and
relevant to what we're
if you
doing here, but
if you're doing this personally, don't feel like you have to put all the lines Ross does. Ross also puts a million alert lines every single day. Find what works for you, what works for your process. Maybe you only want to put base pivot lines. Maybe you're not putting any diagonal lines, you're only putting horizontal lines. Do how you trade and how you would analyze the chart. Um, this is just an example showing how Ross applies that. You can tweak this process to however you want to do it. So, Ross, maybe we can move on to the
yeah,
next.
and I think if we're not, yeah, see, so there's 3 charts here and we got another stock, so I don't want to go on and on. So again, so Richard, do you want to go through here? Is there any, going through here, you can see just addressing lines. These were dragged across from the left side, of the base that came across here. Another major declining tops trend line. And you can see I'm just marking the ones that didn't come across. I'm basically marking any potential pivot point, whether it be a base pivot, consolidation pivot, anything where it looked, a major support or resistance point I want labeled. And then, I may need to subtract and add as I go along and actually fill in the details, right?
Yeah, and you can learn a lot by going through Ross's annotations in terms of how he views the market and his view. And we actually have that as a free resource. If you guys have registered, you can kind of go to courses and look at our previous model books. So all these details are great to study. Don't feel the need like you have to screenshot these. They're all there for you to analyze however much you want. So Ross, I think let's move on to the next example.
And so, I think I just realized these are the same chart with different shots. I'm not so anyway, you've got 2 screenshots of the same chart here, right?
Yep.
Right. But so anyway, moving on to super micro. This is stock number 3 again. A little description of what the stock does, right? So you have an idea what industry group, what it does relative to Nvidia. Let's say it was a larger, this is from a larger model book relative to the other stocks in its group, right? You want to know its story. Again, quarterly and annual earnings, as well as earnings and sales, as well as
And
estimates.
in here, Ross, are you always kind of noting down what the N factor is for that company? You're trying to identify that here, right? The fundamental story.
Yes. Thank you. So yeah, that's the whole point of me. So at least I have an idea of, yes, why SMCI is being chosen. What is the story? How is it, so it's another one of those big, so AI is a big theme in the market over 2023 and a lot of this year. Nvidia is your leading semiconductor company as far as AI technology goes, right? In terms of processing power and speed, from what I understand. SMCI is another semiconductor company, different than Nvidia, but a big leader in what they do. So in the same sector and industry group, but a little bit different business. And you'll see as we look at the chart, it's going to also, it trades a lot more differently than Nvidia. And I wanted to put this in here as well, because SMCI may be, it's one of those
small
stock
cap
where
it's more whippy.
Yes, it's much more whippy, and I would the way I would enter this one changes relative to an Nvidia. So, and how do I realize these things? Experience, and then the model book, and then a lot of post analysis as well. The model books and post analysis go hand in hand, or almost you're cheating yourself to do post analysis without at least a small model book. So SMCI again, weekly chart, forest for the trees look, and you can see here, there is no prior uptrend, new base, right? We've got this stock's been in a pretty solid uptrend, again, more whippy than an Nvidia, but since before 2021 and up until this point, you can see it's held that trend of higher highs, higher lows. Taking a quick look at earnings, sales, and all, we saw on the other page, the big triple digits across the board in historical reported earnings and sales, as well as estimates. And so again, now we jump straight to those daily charts, right? So we're starting just before 2023. So right here is the beginning of our daily chart for reference. And again, so this is great because now we can see all the way to the left side where I started a lot of these lines and have dragged them across. And the funny thing is, when I get started, I'll be a little bit slow, but by my third stock after I've done one or two, it becomes really fast how quickly you'll start drawing the lines. And again here, I don't know why I didn't mark them. I only marked it on one, but we should have a circle right here at that launch pad setup that happens after, again, that big volume push outside day above all of those moving averages. The cross.
Look at the volume. Look at that volume on that tight area too. Nothing.
Yeah.
So that's
and you
a
can
characteristic to look for. Yeah, big up
right, look
volume.
how
And then,
tight that is. Volume disappears to nothing, right? Big blue, small red. This is exactly what you want to
Keep it
see,
simple.
right? Big on the way up, small red on the way down. But and unlike NVIDIA, this one doesn't hold its 10-day moving average. So it can hold its 10-day moving average, but it doesn't hold it as well, right? It shakes below, and when it does, you can see this one runs into trouble and it gets uglier much more quickly. So you want to treat this one differently than you would the NVIDIA, right? The way, and again, we're not getting into that, but that's what will help you with position risk reward, entry exit, and that goes all the way down to position sizing. And this is one of those things that would help, right? So when you have a stock like an SMCI, let's say it's just irresistible in every respect other than it's a little more volatile or choppy than I would otherwise like, then I will change my entry tactic so I can get a position on. And then Richard, anything you want to add or along the way, because we're coming. Okay, so
yeah, nothing too much. Just for me, SMCI, it's a whippy stock, and even the next base, if you go to the next slide, yeah, it had an amazing breakout there, but for a lot of that base, it looked like a stage 3 top almost. It was gapping down, downside reversals. So that's type of stuff that you can think about and remember going forward. A stock like SMCI that had come so far, it's looks like it's forming a stage 3, but maybe the next stock that kind of fits that profile, you stick with it, you keep watching it because SMCI had that amazing run out of this base and there's still that potential there. So those are just kind of little things that you can learn to stay in tune with the stock even if the base doesn't look the best because it has that strong initial uptrend. But yeah, nothing too much more to add on this one, Ross.
Yeah, so, and you can see I'm not really doing anything too different. It's just a matter of getting, starting with a blank chart and marking those where you think are the most important lines, starting with pivot points and trend lines. And then from there, playing Monday morning quarterback, right? Where would you have entered? Where have you entered in the past? If you've traded the stock and you start from there. And then as you detail your potential, as you're looking for your entries, your potential ideal sell stops, that's going to help you. That's going to further drive you to add and remove relevant levels of support and resistance based on the detail as you go. So again, it's not going to be perfect the first time. Expect to be adding and removing lines along the way as you go through and actually analyze the entry and exit areas if that's what you're doing, or the areas where your indicator is significant or whatever it is that you're studying, right? So again, this was my takeaway from, the model book studies that I did related to, my methodology, right? So it's not going to, again, the most common traits of the model book stock for me are going to be different for you if you're doing a different study, right? So just to be clear. So for me, again, and this is what I want to make sure this always exists, right? And this is, like I've mentioned a few times now, has existed since the late 1880s, right? Anytime I build a model book, these are the things that never change, that top-notch story, right? And that's why it's like one of the first things I put in the model book. I want to know, it should be clear what the company's doing, why are they there, how are they changing the way we work, live, or communicate. For me, that is a big deal. And then from there, the canceling fundamentals are what ultimately supports that. The better the fundamentals, or I should say, the better the story, typically the better the fundamentals are, right? When you disrupt like Apple does, then you have more money than many nations on the planet, I guess is how that works. So And then the other thing I noticed, and so tight, liquid, organized technical patterns, like I said, respects key areas of logical support, moving averages, highs and lows of gaps, important price and volume bars. So we saw I wanted to show, so you've got the NVIDIAs and ANFs of the world that trade liquid and a little bit tight, but you still can have an SMCI that is a powerful big leader that has a different personality. So for me, like my takeaway is, I guess, from the model books, there are enough high quality, big performing model book stocks that trade in this way, that have the tight, liquid, organized technical pattern, that what I call that have the aggravation free patterns, the NVIDIA pattern relative to an SMCI pattern. An SMCI can get more volatile than that. That was just my example for here. But so for me, unless it's an outstanding stock that I can't resist with a personality that doesn't really fit my definition of a model book stock, I'll tend to stay away. However, as you see, I will still include the whippier stocks if all else is perfect, because I want to understand how many of those stocks show up, right? I always want to know, as long as, can I stick to the tight, liquid, organized, aggravation-free patterns and not worry about missing an SMCI if I don't want to touch it? And the answer is yes, right? So for me, those are my ideal key model book stocks. I want to include reality. But for me, that was my takeaway as far as what I now focus on based on my model book studies. It's not going to be not only the highest performing, most fundamentally sound group stock in its group. It's going to be one that has a personality that, let's say there's two personalities of model book stocks. I prefer that one. That's the one that makes sense for me to trade. And I continue to prove to myself that there are more than enough of the, like Bill O'Neill will never trade, if at all, a biotech stock. If he's going to trade it, you bet your ass it's going to be, excuse my French, a Biogen, a company that you stick a shot in someone who, in someone's eye, who can't see, who's blind because of macular degeneration, and now they can see again. They made a lot of money selling that drug. It was extremely successful. If Bill O'Neill is going to be in a biotech stock, it's going to be one like that or not at all. So by the same token, I'm going to typically be in a super liquid, organized, aggravation-free model book stock, or I'm going to probably stay away, because the SMCIs of the world, no matter how good they are based on the way I trade, the way I see things, just a little more work for me. It's harder for me to perform trading those stocks. It's more work, right? So, and that's, you want to do the studies to see what's actually going on, but more importantly, to help improve your performance and improve your life, right? I'm looking for the easiest stocks where I can enter my rules, take care of everything. I have to do very little thinking, and I can, enjoy the rest of my life without too much stress and aggravation. So
there you go. Perfect. Was that? Yeah. So here's some.
Yeah. So again,
more takeaways. Yeah.
I could have changed slides here. We'll leave it. So again, my apologies. I forgot to click the slides. I went ahead in my thoughts, but again, this is and again, some of the individual key takeaways, right? So one of the original ones that I relate back to Mike and Charles is all of us sitting there asking the same thing on the same, going, why aren't we buying these stocks here and here and here? And, it was because it's too early. There's too much resistance from back on the left. But then I started then I incorporated Stan Weinstein, a lot of what his stage one top idea in many cases is what Bill O'Neill would consider junk off the bottom, right? So I'm not going to get into that, but that was a big aha moment for me and helped me develop early entry, right? Understanding that, you can get a stock with all of that resistance on the left side, and it does still work, right? So I'm very sure of that now. So again, like I said, especially now that I'm 52 and not 22, aggravation free trading is a big plus for me. If you told me about, hey, it's aggravation free when I was 24, I'd be like, I don't care. I want to trade MSTR and SMCI on margin anyway. I was there at one point. I'm far from that now. It's the last thing I want to be doing. Too old for that, as they say. And then again, in the beginning, when I was talking about how Bill will stick to the one biotech stock, the one that goes to the moon, that makes money, and who cares about the rest? Can't argue with that. But I made a lot of money in 99 trading biotech stocks with big stories and no earnings. However, I also learned if you walk away from your screen for an hour without sell stops, you can lose almost all your money in an hour. So again, just I wanted to be clear. You don't have to just be testing for entry and exits. You can be looking for a specific indicator, a new entry tactic, and then honestly, you don't have to do a big back testing study after that. You can test it with 10 shares, 100 shares. I like to test my observations in real time with real money in the market. That works really well for me. And again, the stocks having a personality, and trying to stick with those stocks that have the particular personality is another thing that I took away from the model books, right? Just how to make my life easier. I don't need MSTR and SMCI to have a huge year. And this, I think I started with, from the very beginning. I can't, and I'm not going to go on and on, but I can't say enough how important it is, how helpful it is to build the model books. So do yourself a favor, when you're doing your post analysis, figure out, what are the 5 stocks you wish you traded, or the setups that you wish you had that you missed it. Whoops. Did I just hit a button by accident, Richard? And
I think you put a timer on. I'm not quite sure.
Okay, yeah, I did that by accident.
Yeah,
I don't know where that came from. So sorry,
all
everyone.
good.
Okay. So yeah, just that process has done so much for my thought process, my entries and exits, developing my rules. It aids the post analysis incredibly. They go hand in hand. So, not only does it, the more you make, the better of a historical reference you have to go back, when you need it to use in the future. The process itself is more valuable than you can imagine, starting with those blank charts and ending up with a book that you can reference, going forward.
And Ross, do you print them out usually, or do you kind of keep them in PDF form, the ones you make?
So I will mark them up originally, but I have a whole model
Stack
book
of them.
layout saved, and then ultimately, yes, I will print them out. I like to see them in black and white and pretty, and it also forces me to look through it in hard copy, because I will look through it if it's sitting on my desk or near my couch, whereas I'm not going to open that PDF on my computer. I know I won't. And then what happens is, as I start going through, it's amazing how many things I want to change. And then I go back and I will update that chart in my model book layout, and I'll print it again, right? And once I feel like I have my final there, and I will look at that, and those get changed. And then as time goes on, I start figuring out I've already begun to make my list for this year's TraderLion model book. It'll be coming up in a hurry, right? So
yeah, going to the next slide. Key advice, like Ross said, just start with a basic Google search for top performing stocks. You can run a scan for stocks that were up the most that year. That's a way to find them. Especially if this is your first one, just kind of start small. Do 5, do 1 first.
Yeah,
and
do 1 or 3.
Yeah, there you go. And like Ross said as well, and I said, it doesn't just have to be how Ross does it, which is mostly looking at the top performers. It can be going back and study a come and handle. It can be studying a MACD cross, a moving average reclaim, undercut and rally, whatever setup or thing you want to study. Just find good, solid examples of those over a period, and that can be the way to go. Some people might be curious about kind of what software that we use. For the charts, DeepView is kind of what we use, and then you can go back and Google to find news. You can we use Canva to kind of put everything together. That makes it really easy. You can even add annotations in Canva, and that way it's kind of saved on a different layer than your charts. And you can kind of change them really easily, copy the same one over and over again. So that's kind of the stack that we use, and then from there you can make that into a PDF. So Ross, anything to add there about specifically making the model book? The logistics behind it, or is that kind of it?
That's really it. It's not hard. It just takes some time. It's a little bit tedious, adding in the detail, but worth every second you spend.
Yep. Perfect. And I think we just got one last slide, some key takeaways. Again, they can serve as a reference for historical precedent, and then going through the actual process kind of helps you find those edges. Notice the launch pad, notice the consolidation pivots, and the more you do, the better you get. I like how you end with that, Ross. Anything to add here on?
Yeah, and just one more thing. As you're making them, you can notice your rules changing. What used to work, right? You can go, holy cow, that clearly something changed there. But I need to change a rule, a sell stop rule based on X, Y, Z. That's another huge, that happened for me recently. So that's why I mentioned that. But the value is unbelievable. And if you talk to 10 different people, they'll tell you another 10 things that I didn't even think to cover, that it was because it helped them in a different way. So
I know another observation that you pointed out going through the recent ones is in recent years, there's so many breakouts, failures, resets, and then re-breakout. I know you've noticed that observation specifically from building these. So you can kind of notice stuff like that as you're building them. And like I said, you can go ahead and check out the model books that Ross has done over the previous, I think back to 2019. Definitely very useful to read through those. It's available on Amazon as well as a free resource if you've got a free account over on TraderLion.com. And I think we'll be putting the links to them right now in the chat. So Ross, I think that's pretty much it from my side. Any last, words of wisdom that you want to share with everybody, encouragement, anything at all?
No, not really that, again, pick your top stock, your top 3 stocks that you would think would be the beginning of a model book for you, and pick a weekend, sit down and do your first one. Other than that, that's really all I've got for you. Make a model book, even if it's just 1 or 2 stocks, get something under your belt. I'm going to bet it's going to make you want to do more.
Yep. There you go. There's your homework assignment for next weekend. We'll expect to see them posted on Twitter. Tag us if you do them. We'll retweet them, give them a look.
That would be nice.
That'd be cool.
All right. Yeah. Some marked up model book stocks would be great. So yeah, great idea.
Maybe we'll give some giveaways to people who do them. So hint, hint, go ahead and do that. So thanks so much, Ross, again for your time. To everybody watching, hope you enjoyed. And we'll be right back. Stay tuned. Bye.
Thanks, Richard.
All right, welcome everybody to the end of day 4 of the TraderLion conference. I hope you guys really enjoyed it. I know I certainly did. Next weekend, we have another group of fantastic presenters. Here are just a few key ones. Eric Kroll of the Life Cycle Trade team, Linda Rashke, Market Wizard, Pavel Kicek, discussing systematic algorithmic trading of cryptocurrencies, discussing a lot of different strategies. That is going to be fantastic. So there's a lot to look forward to. Hope to see you guys there. And you don't want to miss these presentations next week, which will start at the same time, 9 a.m. Eastern. Again, I saw this question a few times. How do I download the slides, access the slides? You can access them by signing up for the free VIP for the conference by scanning the QR code right here. It is also gives you access to special giveaways, free bonus resources, model books, classes, the ultimate trading guide. You don't want to miss that. So 100% free, as I mentioned, and you can sign up using this QR code right here. Also, if you haven't yet today and you find value in the presentations, please consider a donation. $1 is fantastic. You know, $5, $10, $20 and above, that's amazing. And you can donate by the donate button, which is right below the chat. Huge thank you to everybody who has and is currently donating. We'd love to see that, and it's a great way to pay it forward and get in the good books of, you know, the market gods, karma, whatever you want to call it. This is just a great cause that I think everybody can support. And with that said, thank you guys all for coming again. I really enjoyed today's presentations. I hope you did as well. Let us know in the chat who was your favorite. What was your favorite quote? We'd love to hear that. Tag us on Twitter with your feedback and notes. And thanks overall for coming. And we'll see you again next week with another great batch of presentations. So stay tuned, and we'll